The 3 steps that every trader must know to be profitable. There are 2 types of profitability. A trader can be profitable, but not consistently so, but still at the end of the day profitable. And then there's the profitability traders where you are profitable and you're consistent. And that is the style and approach that I encourage that you develop for yourself. I honored consistency as much as I honored profitability. Now, let me give you a quick example of that. There are some people who are wrong most of the time in their trades, but when they're right, it's big enough to overcome their losses. That is a style of profitability that lacks consistency, but because the ratio between their gigantic wins versus their many losses, they still wind up profitable. A good portion of profitable traders fall into that category. I never wanted that style of market play. Years ago, I never wanted that. I wanted consistency. Even if consistency meant that I would make less, I needed consistency because I needed to be profitable every single week of my life. Otherwise, my family did not eat. And so consistency, I adored consistency over big, giant gains. So what I'm saying is the 3 things that I'm going to share with you today are designed for not only increasing the odds that you're profitable, but your consistency should go through the roof. And I encourage you to honor consistency more than big, giant gains every now and then as if you're lucky. The first thing I want to cover with you are the basic tools that I use, my traders and I use, that I teach them to use. They're basic, they're simple, but they're powerful. And these tools fall into basically two categories. They're time frames or charts. They're charts, of course, but there are specific time frames that I think are important. And then there are moving averages that I feel are absolutely imperative to have on those time frames. So let's cover the broad basics regarding these tools. There are actually 4 main time frames that I believe is most appropriate when you're trading indices. Now listen to me carefully. It's slightly different when you're trading individual equities, individual companies, individual stocks. But when you move to trading indices, there's a slight change. And this change, in my opinion, calls for different time frames. And when you're trading an individual item like an individual stock, the smaller time frames can be more appropriate. When you step to trading an index, you're stepping back and trading something broader in nature. That broader item in nature oftentimes leads to the slightly bigger, broader time frame being better, more fluid, more consistent, more accurate. When you're trading individual stocks, you tend to get accuracy as you shrink or zoom in. When you're trading an index, you tend to get more accuracy and more fluidity and less noise when you zoom out. That's a very important distinction to understand. And I believe that a lot of people sloshing around in the markets, trading in the markets every single day, do not understand this slight difference between trading actions or trading stocks and trading indices. And that difference stems, traders, that difference stems from the fact that an index does not move based on supply and demand. It moves based on what it represents. So let me give you an example of this so that you know. This is very important to understand. I want you to understand and be a cut above the majority of market players out there who do not understand this. If you have a dollar index, like many of you trade the dollar index, right? It doesn't matter how many Brazilian people buy the dollar index. If the dollar is dropping, the index is going to drop. So even if every single trader bought the index, that's by demand, it would have no influence on the index going up if the dollar's dropping. So do you understand that when you're trading an index, you're not trading the people anymore that's trading the index. You're trading the item that the index represents. And because of this difference, the time frames that work best on it have usually a broader and bigger time frames. When you're trading something that people can influence, zeroing in a little bit more can give you slightly more accuracy. You're trading their emotions, you're trading people. A lot of people buying this stock will cause the shares to rise. A lot of people selling will cause it to drop. That's not the case with an index. This slight difference is very important to understand. The markets are not quite exactly the same. The same tactics and techniques work, but the time frames that work the best are a little bit different. Let's get back to this. I break the time frames up when you're trading indices into two broad categories. They're the micro time frames and the main time frames. So I call micro and main. Now, the micro time frames are the 2-minute chart, where every bar represents 2 minutes of trading, and the 5-minute chart. This is where you go to micro trade. What does micro trade mean largely? It largely means if you're looking for trades that last anywhere between 8 minutes and 20 minutes or so, this is where you're going. 8 minutes to 16 minutes, maybe as much as 20 minutes at times, but this is more micro trading time frame. 8-minute trades to 20-minute trades, more or less. And then you have the main time frames when it comes to trading indices, which I consider to be your 15-minute time frame is the major one, guys. And then you have the hourly time frame, which is the least used, but it's still a very valuable time frame for trading indices as far as I'm concerned. These two time frames, your 15 and your hourly, remove much of the noise that people experience when they trade indices. Indices have more noise oftentimes than an individual stock will. That's another thing people don't understand. The noise factor in an index is slightly higher than the noise factor in an individual stock. And you must account for this noise. There are certain things that you can do as a trader who trades indices to filter out much of the noise. And one of them is to step back in your time frame a little bit. That's one. And then there are other techniques which we will talk about that will filter out some of the noise. But keep in mind, an index trading has more noise in it than individual stock trading. Again, the 15 and hourly, stepping back to these time frames, require that you're looking for trades that last several hours with the 15-minute time frame, anywhere from 45 minutes to several hours when you're trading the 15-minute time frame. And I really like this time frame, guys. I really like it. So I would say 45 minutes to several hours. And this is most of the day and beyond. So the hourly chart is a great time frame when your index is really experiencing an enduring move throughout the entire day. The odds of capturing the entire move is higher on the hourly time frame. Now, every day doesn't flow, so that's why the hourly time frame is the least used. But when your market is flowing, the hourly chart gives you the highest odds of capturing most, if not all, of that flow throughout the day. The main thing I want you to understand is that there's micro trading time frames and then your main trading time frames. And yes, we're going to use them all. We're going to use all the time frames, all of them. It's not a matter of which one is better, it's which one is appropriate at the specific time. I'm just showing you an example of a 2-minute chart here. Every bar represents 2 minutes of trading. Obviously, I know you know this, the green bars are up bars and the red bars are basically down bars. What I am also showing you with this 2-minute chart is what the market does over and over and over again in a repetitive nature. A lot of people don't realize that this is the only thing a market can do. It has no other pattern that it repeats. It can only do this. And I break this into 4 parts. Part 1, part 2 is the upward move, the bull market. Part 3 is how you top. So here's 1, here's 2, here's 3. Part 4 is the bear market part of the phase. And then you go right back to 1. Guys, what a lot of people don't realize is that markets are like trapped on rail. All markets throughout the world, no matter what they are, they're trapped on rails. They can't do anything except do this pattern over and over again. What makes it difficult for some people to see this is that they're different sizes. So you might have a macro cycle, but inside of the cycle, you might have little ones. And they're the same ones. 1, 2, 3, 4, 1. 1, 2, 3, 4, 1. So there are micro cycles or micro full cycles in a macro full cycle. So for instance, here is a micro cycle, and here is another micro cycle, and here is another micro cycle, all within a macro cycle. Here is another micro cycle. Here's a little cycle. You see? So a lot of people get confused because there are microcycles within macro cycles. Another reason why they get confused is they see it upside down sometimes. So in this case, that's 1, 2, 3 is your bottom, 4 is your move back up, and 1 is moving back to your neutral state again. So you can have the cycle up, you can have the cycle down. And another thing that confuses people is that the cycle is not always flat and perfect like this one, where it comes all the way back to where it started. Sometimes it's on a slant like this. Sometimes it's flat. Sometimes it's like this, on a slant like this. And sometimes it's backwards. And sometimes backwards like this. A lot of people, they think that the market does many things, but the market can only do one thing. It does it in different variations, but it's just one thing. And we'll talk a bit more about this, right? Because I want you to understand that our best opportunities will be coming out of ones. You see? Coming out of ones. These are your ones. These are your 2s. These are your 3s. And these are your 4s. So your best opportunities will be coming out of ones, either up or down, up or down. Your second best opportunities will be coming out of 3s, down. And we're going to get to this because I'm going to teach you how to trade by location to increase your profitability and your consistency. But anyway, this is a 2-minute chart of one of your most popular trading items, obviously, the Bovesta Index Mini futures. Here is a 5-minute chart of the same futures contract here. Again, you see the same thing. You see the same pattern play out. 1, 2, 3, 4, 1. It's the same. 3, 4, 2, 1. All right. That's the 5-minute. You have the 15-minute. 1, 2, 3, 4. Over and over again. All right. 15-minute. Here's your hourly. Here's your 4. Here's your 1. Here's your 2. Here's your 3. Here's your 4. Here's your 1. So this one is on a slant, you see? And knowing where you are in the cycle is very important. Just over and over again. 4, 1, 2, 3, 4, 1, 2, 3, 4, 1, 2. It's just over and over again. If you don't understand this, it means that you don't understand where you are in your market cycle. You don't know whether you're in a 3, ready to come down into a 4. You don't know whether you're in a 1, ready to blast off into a 2. You don't know whether you're in a late stage 2, ready to top out into 3, or in early stage 4, ready to accelerate down. Like, if you don't understand this basic concept, you can't know where you are in your market cycle. And if you don't know where you are in your market cycle, you can't be consistent, because the probability of what's next comes from knowing where you are in your market cycle. 3, 4 is next. 1, 2 is next. You can't get good at knowing what's likely to be next unless you know where you are and understand this basic concept. Let's talk about the moving averages, because those charts that I showed you had nothing on it. I'm just showing you the different time frames. Now, let's superimpose the proper moving averages. These are the only indicators I use, people. I am not an indicator-based trader. I do not like my charts looking like a bowl of spaghetti. I don't need things to indicate about the truth. I just need the truth. You see, for me, traders, the item is the truth. The item I'm trading is the truth. And when I use an indicator that is indicating something about the truth, I remove myself from the truth. So the thing I'm trading is the truth. There's this indicator that's telling me something about the truth. I don't need a lot of things to tell me something about what I'm trading. So I believe there are a lot of traders who get distracted with a lot of indicators. So the most important thing is the item that you're trading. And an indicator makes you look away from the item that you're trading to the indicator itself. And if you've got 3 or 4 things pulling your attention to those, you've lost sight, you've lost the plot. You're looking at this indicator, that indicator, that indicator, that indicator. You've lost the plot. This is the thing that makes you money, not the thing telling you something about the thing, So I've never really been a very indicator heavy trader because I trade the item itself. The item tells me 95% of what I need to know. I don't need a representative of the item. I need the item itself. Now, the only exception for me is moving averages. And so let's talk a little bit about which moving averages I feel are indispensable and how they're to be used. You see, a lot of people don't use moving averages appropriately. And I'm going to teach you my approach to using moving averages appropriately. Moving averages, the only indicators that I use. So guys, there are basically 4, just like there are 4 major time frames, there are 4 moving averages that I rely on. The first 2 are the 200 period moving average. That's the granddaddy of them all. And then there's the 20 period moving average. They're all simple moving averages. Now, if you've fallen in love with some of the more sexy varieties, all right, fine, use them. But I have found no evidence that any of the sexier varieties, exponential, weighted, triangular, none of that does better than simple. And I've been using moving averages virtually my entire trading life. But if you're in love with the sexier ones, fine. It's not that much of a difference. All right, but I use all simple moving averages, 200 period moving average and 20. Now, these moving averages will always be on the chart. I will never remove them. In fact, I do not consider a chart unless it has the 20 and the 200 period moving average on the chart. So these are permanent staples on my chart. The 200 period moving average is the most powerful when it is flat. All right, write that down. The 200 period moving average is the most powerful, is the most effective when it is flat, relatively flat. Doesn't have to be perfectly flat, flattish. Okay. The 20 period moving average conversely, is the most powerful when it is trending, up or down. So what do I mean by this? Your 200 will tend to be a concrete floor if your item is above it. If it is below it, it will be a ceiling, a high percentage of the time. If the 200 is slanted, it's still the case, but less so. So it's a little bit less effective when it is slanted. When it is flat, it is in its most powerful position. Now, the 20-period moving average is the most powerful when it is trending. It will tend to be a significant area of support when trending. When the 20 is flat, it will tend to be powerless. Your item will crisscross like it's not even there. But when it is trending, it will be respected a high percentage of the time. So these are very important characteristics to understand about your two main moving averages. 200 is most powerful flat, 20 is most powerful trending or slanted, 45-degree angle, more or less. Now, there's this other group of moving averages I call the power trending tools. This is when you have an item that is power trending to the upside or downside. We bring in the 8-period moving average or the 13-period moving average. And I want to show you examples of when the 8 and the 13 replaces the 20-period moving average in importance. So the 20-period moving average is very important, but there are times when your item is trending so powerfully that you need to bring in a replacement that is shorter and quicker and faster than the 20. That's when we bring in the 8 or the 13. And so if I were to quickly draw that for you, let's say this is the 20-period moving average. Your stock or your item that you're trading starts doing this. So you see how the 20-period moving average here is irrelevant now. And the trend is steeper than the 20. So then I would have to bring in the 8-period moving average, which is more relevant, okay? So during power trends that make the 20 irrelevant, you have to bring in the quicker ones, 8 or 13. And I'm going to show you how to determine whether it's the 8 or 13 that you bring in to replace the 20 during these power trending periods. You have the 20-period moving average overlaid on the chart and the 200-period moving average. I told you when the 200 is flattish in nature, it is the most powerful. You will tend to get power surges off of the flatter the 200, the more powerful the surges off of it will tend to be. And when the 20 is flat, your item will tend to ignore the 20, not respect it very much because the 20 is flat. But when the 20 starts rising, look at the respect. Boing, boing, boing. You see? So the respect is there. Now, there's always a little bit of slippage, but slippage is not breakage. This is another thing that throws a lot of traders. They don't understand that moving averages are areas. They're not lines. It's not like the moving average is a sheet of ice that when you make contact, it cracks. It's not glass. It's like a rubber band that you can lean on. And so some people interpret a lean on the moving average as a break, and that's a mistake. And they get knocked out of a lot of great trades, not understanding that your moving averages are like rubber bands or fences, a fence that you can lean on the fence, but you don't break the fence. You can lean on it, but don't break it. All right. And so if we go back to this chart, you've got your index is leaning. It leans on the moving average, but doesn't break it. It leans on it a little bit, doesn't break it. It leans, doesn't break it. But this is true breakage right there. Boom. And one of the easiest ways to not get caught into this is you got a full bar under your moving average. You see how these bars are not fully under? They're not fully, there's no full bar under. There's no full bar under. But you get your first full bar under right there. Boom. Now you know you're coming out of 3, going into 4. Where? Back to your 200. Back to your 1. Simple but powerful. Simple but powerful. That's the 2-minute chart. Here's a 5-minute chart. All right. Notice how your 20 starts rising and starts being respected. You see it rising? It's starting to be respected with the rise. Okay. When do you know you have topped out 3? When do you know? When there's 1 full bar under. Okay. Same concept. Same concept here. Your 20 is starting to be respected. On the rise a little bit here, all right? When do you know you're truly left 3 into 4? When you get 1 full bar under. There's something else that had just come to mind. I hope you guys are taking notes with some of these things. Don't try to remember it. It never works. Got to take notes. Another thing, a lot of novice traders think that you need to be super early. You need to catch the tippy top. That's wrong. I need to catch the absolute bottom of a move. That's wrong. That is fanciful. That is only works in Disney movies. It's not real life. And you don't want the exact top and you don't want the exact bottom. And when you drop this notion, strangely enough, your accuracy goes up. So like this concept I told you, when do you know you've got the 4? When a red bar is totally under the 20-period moving average. Not the first one. It's usually the second one or the third one. Boom, that's the one a lot of times to know for sure. You understand? So there are a lot of traders who think their whole approach is trying to grab the tippy top of a move or the absolute bottom of the move, and they will forever be frustrated as traders their whole lives doing that. That's not where the accuracy is. Here is a 15-minute chart of the Bovespa. Again, 20-period moving average, 200-period moving average. This is a beautiful event off of your 20-period moving average to the downside. Here's another one. The full bar that's under the 20, that's the one. I teach my traders that when you are trending, you can do color change entries. So you see this green. When does green get taken out? Boom, right there. When does this green get taken out? Boom, right there. These are called color change plays. And I want you to take a look at this period, though. Notice how the trend is so strong that you want a shorter moving average. The 20 is irrelevant here. So you want like the 8. Notice when the 20 is flat, your item ignores it like it's not even there. But it only when it starts to trend do you start to get some respect. Here is the hourly chart. Now look to the left. Notice the flattish nature of the 200. Doesn't have to be perfect. Usually gets strong moves. Notice the move off of the 20. We'll talk more about this shortly. I also want you to be able to utilize your moving averages, not only in terms of them, when are they the strongest? Like the 20 is the strongest when it's trending. It's the strongest when it's trending. And the 200 is the strongest when it's flat. But I also want you to understand the concept of distance with your moving average. So when your item moves from the moving average to away from the moving average, you are likely close to a 3 top. And you see the space? And especially when you have what I call the 3-finger spread. So the 3-finger spread is your item is very high above the 20. Your 20 is high above the 200. So you have finger 1, finger 2, finger 3, all spread apart like this, guys. Look. Okay? Boom, boom, boom. Now like this, like that. So when you got all 3 items spread apart and your stock is the highest item, you're ready to fall back, right? Same in reverse too. If the stock is at the bottom, you're ready. You got all 3 items spread apart and the stock is the bottom one, you're ready to move back up. Moving averages are great guides for space. When you get that space, you're ready for a reversal. When they're all together, you're ready for an explosion. So when your moving averages and your item is like this, you're ready for an explosion up or an explosion down. You understand? But when you separate, you're ready for a reversal. Let's take a look again. Now, notice here where all 3 items are close together. Here's here's the Bovespa, here's the 20, and here's the 200, close together. Then they get wide apart. That has to come back in, all right? And you get wide apart again. That has to come back in. And then you get wide apart again. That has to come back in. So the 3 items can be great indicators of where you are in that cycle I told you. Wide apart, you're at the end of the cycle, the top of the cycle. Together, you're at the beginning of a brand new cycle. And so these are the 2 most important points, turning points in the market. So the trends between them, tight and narrow, and then wide. You run from tight and narrow, you run to wide. That run is a money-making run, but there are 3 things that make for the most profitable trading. When you can capture the narrow explosion, then ride the run and know when you got the 3 fingers spread, it's over. And maybe a play to the reverse side. These 3 things make for the most profitable market play. Being able to identify when it's tight and narrow and ready for an explosion, riding the move out of the explosion, capturing as much of that move as you can, and then identifying when it's likely over. Take a look once again, realizing that we're tight and narrow, grabbing the explosion out of the tight and narrow, riding this for as long as you can, and being able to identify when you are likely near top. This is the 3 elements of the most profitable that lead to the most profitability. 3 capabilities: identifying the narrow state, grabbing the explosion out of the narrow state, riding the move to the wide state, and identifying the wide state top. Do that, get good at this, and you will live a very, very pleasant trader's life, because that's all of trading in a nutshell. Trending moving averages. Let's look at the trending ones. Remember I told you that when your item is trending so hard that it makes the 20-period moving average irrelevant. What do I mean by irrelevant? It's just too far away to mean anything to us. What is that 20 doing for me except pointing the way? But it's not close enough to give me any guidance. It is here. Here's the explosion off the 20 here. But it's not this trend. I need more guidance on this. The 20 is too far away. It's almost as if the 20 is across the street and I need someone on the same street as my item. So I'm going to get a shorter moving average in here, which is the 8-period moving average, or the 13. Remember? So it's the 8 or 13. How do I know which one it is? Very simple. Listen carefully. You grab your first pullback in your trend, and whichever the first pullback reacted off of, that's the moving average. So I want you to see the first pullback here. Drop, pullback, boom. And it didn't break the 8. So that means that it's the 8-period moving average. If it broke the 8 and went Here, it would be the 13. So the 13 is like this. So which one does the first pullback kiss or come close to? That's the moving average we want to do. Now, why is this important? Because the moving average, in addition to us knowing that the 20 and the shorter moving averages give us direction, they also help us with space, narrowness, and space analysis. They also serve as trailing stop mechanisms. So if I'm in this powerful trend here, I should probably stay in as long as it stays within the 8-period moving average. Now, it appears as though it broke, but remember what I told you. A lean against the fence of your moving average is not necessarily a break. So I employ a 2-bar rule with these moving averages. You need a 2-bar break. You need 2 bars to break, not 1 bar. 1 bar is not a break. That's a lean against the fence. It's like a boxer leaning against the ropes, but the ropes don't break. But 2 bars is a full break. Let's take a look. So a 2-bar break would be, you see that's a 1-bar break. If you break the high of this bar, it would be a 2-bar break. You see? So if the next bar broke above, boom, that's your stop out. You need a 2-bar break with the moving averages. So since this is just a 1-bar, that's not a break, that's a lean against the moving average. And you get a 2-bar break here. You're out of this whole trend. Now we're gonna talk about how you would be in this bar. You would add on the green color change, boom, and you would be out here. If you don't understand it already, you'll understand this very clearly in short order. So here is the 8-period moving average being applied during this trend, see? Because look at the 20, it's irrelevant. It's across the street. It's not walking next to me or next to the Bovespa. That 20-period moving average is across the street. We need it walking side by side. So the 8-period moving average is walking side by side. And here is your 2-bar break right there. This is not a break. That's 1 bar. But remember, tight and narrow is where you get the explosions from, right? What's tight and narrow? 3 items, the Bovespa, the 20, and the 200 come together. 2 of the 3 come together. If you get all 3, it's extra powerful. But anyway, you get this closeness together. Also, flatness. Do you understand, guys? So when your items are close together and they're flat, whoo, the explosions are powerful. All right, take a look. Look at your closeness. You see? Close together and flattish. And look at the explosion. Boom! Now, remember I told you, yes, your ability to make the most money in markets lies in your ability to identify narrow and flatness. Grab the initial explosion out of the narrow flatness. You must ride the whole thing. Don't get shaken off. We're using the 8 for that, right? The 8 helps you ride the whole thing and know when you're probably near the top. The 200 is probably down here somewhere. I'm going over the tools that help you do those 3 things. Are you good at identifying the narrowness? Are you good at grabbing the initial explosion out of the narrowness? Are you good at sitting back and riding the whole move? Are you good at determining I'm near the end because look at the wideness? What else is there in trading? Nothing. Those are the 3 things you need. The best trades of your life comes out of narrow flatness. Those are the best trades in the world. The best trades of your entire career will come out of narrow and flat periods. You'll have to identify the explosion grab that. You want the initial explosion out of flatness and narrowness. And that's not enough, though. Too many traders get that, but get shaken off. You can't get shaken out of the move. You can't cut the move short. You got to maximize that move out, that trend. We're going to use the 8, 13, and 20 to do that. And then I need you to know, you know what? We're nearing the end. Somebody was like, how do you know? Like, how do you know? I know we're nearing the end because of space. 3-finger spread. If I can get you doing these things, these 3 things, well, I guess it's 4 things. Identifying narrowness, grabbing the initial explosion out of the narrowness. That's 2. Riding that trend, milking that cow. Milk it for everything it has. And the 4th thing, being able to identify when you're near the end, before the end. It's powerful. All right, guys, let's go back. Here's another 5-minute. Oh, here's the 13. I wanted to show you this reacted off of the 13, not the 8. Now, I don't think you can go too wrong if you get it wrong. Like, it maybe sometimes you realize you should have used the 8 instead of the 13. And the difference is not that great, but I still want you to be able to do it correctly. And you're out here. All right, you missed this last move. That's fine. But look at the left-hand side of the chart, traders. What did I tell you? Your best trades will come from narrow flatness, and I need you to be able to grab the explosion out of the flatness. I need you to not get shaken out. A lot of traders get shaken out here. No, you need 2 bars to be shaken out. You see? This is 1 bar. 1 bar, and then this would be your stop out if you use the 2-bar stop rule. All right, here's 1 bar, but the next bar does not break. You need 2 to break in a row. So you don't get shaken out here, and you ride this baby, and you're out there. The events, the only tradable occurrences, guys, you need trading events in your life. There are too many traders who trade without trading events that dictate their trades. And some of you might think you are trading an event, but you're really not. Let me give you an example. Most people are trading a feeling, but feelings aren't events. Most people are trading their thoughts, but your thoughts are not events. Most people are trading their beliefs, but your beliefs are not events. Here's a trader who's trading his thoughts. I think the market is about to turn here. That's not a freaking event. You think? Oliver, I think it's going to turn here. Like, nobody's going to let you trade their money thinking, I think it's a bottom. I think it's a top. I think it's a trade. I don't want your thoughts. Your thoughts betray you. Your feelings betray you. I feel we're at a top here. I can just feel it. Nobody wants to risk money on your feelings, but most traders are doing this. Most traders are trading their thoughts, not events. Most traders are trading their feelings. Most traders are trading their beliefs. I believe that when this does that, it's a buy. That's not a trade. What you believe, drop this. Catch yourself when you're trading a thought, trading a feeling, trading a belief. I'm going to give you what to trade so that you don't have to do this novice nonsense. Specific events, well-defined. And here's what they are. The only tradable occurrences you need. Elephant bar. If you followed my work for any period of time, you know this is the main event. An elephant bar is an elongated bar, a surge, if you will, something that is powerful, impactful, has a little bit of violence in it, and it's slightly bigger than most of the bars to the left of it. What makes the elephant bar so powerful is that you and I can't make one because it takes a lot of money to make an elephant bar. So why do I call it an elephant bar? I call it an elephant bar because it's the footprint of elephants. What's an elephant? Institutions. Big money, not your neighbor. Like your neighbors, your friends, your family's buying, they don't move anything. I don't want to see the footprints of your uncle, your cousin. I'm not interested in what your cousin is doing. I'm interested in what this multi-billion-dollar hedge fund is doing. You see, I look for big elephant footprints, not mice. Your relatives, not important. Sorry. Yes, they're important, but not when it comes to this. Your friends, not important. These elephants wish they could hide their activity from us, but we're elephant hunters. We're elephant footprint hunters. That's a footprint of a mice, not interested. That's the footprint of an elephant. That's meaningful. Here's something interesting about elephant bars. They represent 65% of all trades. Think about this. This represents 65% of all trades. You can literally make a living just off elephants. That is enough to make a living. 10% is not enough. 65%, you can just be an elephant bar expert and make a living just off of elephant bars. So this is the most dominant event you will ever trade. Now, the way you do them is you buy into the elephant bar, but in the latter part of the bar's formation. So if this is a 2-minute chart, you want to buy in like around 1 minute, 30 seconds, the latter part of the bar's formation. Why? Because if you buy into it too early, it could start off as an elephant and drop all the way back down by the end of the 2-minute period. So you want to get in to the bar when you know there's not enough time to turn it around. See, 1 minute, 30 seconds of a 2-minute bar, it's got 30 seconds left to reverse it. That's not enough time in most cases. But if I buy into this bar and it's 10 seconds and I've got 1 minute, 50 seconds left, that's a lot of time to eliminate this. So in the latter part, I use 1 minute mark is the earliest, but the best is 1 minute, 30 seconds. If it's a 2-minute. If it is a 5-minute, you want to do it in the latter minute and a half or so. The entry, that's the anticipatory entry. If you miss it, you can do the confirmation entry, which is the next bar as soon as it goes a little bit higher than the elephant bar itself. So if the next bar, I'll do it this color for you. If the next bar is like this, you can buy right above the bar. But in most cases, you want that anticipatory entry in the bar toward the bar's formation. Now, when is this best played? Coming out of tight and narrow. Boom! Here's an example of an elephant bar. How do I know this is an elephant bar? Visually, it's very clear that this is an elephant bar because look at all my green bars before it. On average, this is way bigger than most of the green bars to the left of me. That's an elephant. That's not my cousin. That's not my uncle playing around with his Charles Schwab account. That's big money right there. Now, you want to try to get into this bar, boom, before that bar finishes, and you can put a stop right under the event. That's called an event stop. Notice the narrowness, your 20-period moving average, your 200, and your item, tight, narrow. Grab the explosion out of the narrow. Make sure you get the whole move. Don't get shaken out. I would say this is a 13 moving average here, not an 8, and maybe out here. It's a beautiful thing. Look at the narrowness. Grab the first bar explosion out of narrowness. That's an elephant bar. How do you grab it? How do you grab the first bar out of the narrowness? You enter the bar itself, if it's an elephant, right before the bar finishes, 1 minute, 30 seconds, if it's a 2-minute bar, what have you. That's your initial entry. And I would like you to add to your play on what I call the first color change. What's a color change? When red eliminates a green, right here. Red eliminates green, or right there, red eliminates the green. That's called a color change. So my traders are always entering on the elephant and adding on the color change. Now notice that your 20-period moving average is a bit far away. So I would say that you want to use your 8-period moving average to capture the trend. And you're probably out somewhere over here. That's a freaking powerful thing, traders. You see what I meant when I said earlier, simple, oh, so powerful. We glorify complexity as human beings for whatever reason. I don't even know why. We somehow intrinsically feel like if it's not complex, it can't be that valid. But this goes against most truths in life. Most of the most powerful things in life tend to be simple. And also, the simpler your approach, the easier it is for you to consistently follow it. The more complex, the odds are you're not going to follow it consistently. Here, look at the narrowness and the flatness. Look at the flatness of your 200. Look at the elephant bar. Boom, get in that elephant bar before it finishes. You can put a stop above the high or a stop above the narrow state. I like that. All right. I prefer above the narrow state. Mandatory add on the first color change is a little late, but still, boom. And you're probably not using the 20 to capture all. You're probably using the 8-period moving average here and out. You're going to do the same thing over and over and over and over again. I'll tell you a quick story. I'll tell you something funny. I get invited every single year to a variety of firms that want me to train their traders. And every single year, there's this one firm, every single year. This is Oliver, we're glad to have you back. We've got 850 traders for you to train over the weekend. And just have a question. We just want to know, are you going to teach something new? And I'm like, no, there isn't anything new. So you mean it's going to be the same thing like, grabbing the move out of narrow state? Yes, there is nothing else. You want me to teach you something that doesn't work? Or you want me to teach you something that works? And this is a big flaw of a lot of traders. Give me a new tactic. Give me a new indicator, a new platform, a new mentor, a new technique, a new course, a new method, a new They're always newing. All right, that's not how you gain consistency in this game. You find what works 80 to 85% of the time, and you just do that the same way every single time, forever. You gain consistency by trading consistently the same way. You don't change, you don't tinker, you don't try to find something new, you don't try to make it better. If you got the 80 to 85%, you can't improve on that. Just do it the same way every single time and let the numbers fall where they fall, people. Stop tinkering. Stop searching. Stop looking. You understand? And dig in and build some freaking roots somewhere and let this thing grow strong. Stop moving all the time. Be still. Now, guys, that's the elephant bar. My told you is going to represent about 65% of your trades. This is going to give you an additional 10%. So if you add tail bar plays to your arsenal, you're going to be up to 75%. 75% of all trades are elephant bars and tail bars. How do we buy bottoming tail bars? We buy above the high of them. Boom. We buy above the high of tail bars. We buy above the high of tail bars. Now, it doesn't matter whether the tail bar, it has a green top, a red top, or no color. That's not the point. The most important part of the tail bar is the tail. That's why it's called a tail bar. The body, the little tiny body above the tail is not important. Now, stop calling this a tail bar, guys. Let me show you. Stop calling this a tail bar, please. That's not a tail bar. Tail bars like 80 to 85% of the bar's entire range is tail. That's a tail bar. This is a wick bar. If you've got to pull out a freaking magnifying glass, it's not a tail bar. If you have to think about it, is that a tail bar? It's not a tail bar. Tail bars are so in your face that there's no thinking. It's almost all tail. You don't have to think about that. But if it's kind of like there's a lot of body and there's a little tail, like that's not a tail bar. If you have to think, if you've got to squint one eye and tilt your head like that to the screen, it's not a tail bar. Stop being sloppy with your identification. This is how you make your money. No sloppiness, preciseness, exactness. So we buy above tail bars, and of course, there's the topping tail bars, which are the reverse. We know that. Then there's, guys, the almighty bull 180. This is where you have two large bars back to back of different colors. So the first, you get a bear elephant bar down, which suggests weakness, and followed immediately by an even more powerful bull elephant bar that takes out the entire red elephant bar, takes it out and moves higher than the high. Boom. Where's the entry on a bull 180? Boom, right there, anywhere above the high of the red bar. Stop below the low. Now, again, guys, this is best. This will be best. Remember I told you there's your wide here, right? Down here. Here was your narrow, your stop. Boom, came out of the narrow and is dropping. You get this there, you're going higher. If you get this there, see the tight and narrow, and then boom, you're going higher. We're going to start. I'll talk to you a little bit more about trading from the locations. Very important. But this, guys, this will happen another 10% of the time. 10% of the time. So we're up to 85% of all trades. Remember, elephant bars are 65%, tail bars, 10, and now 180s are 10. You got 75% of your trading is just 3 events. And this is the most powerful. Write that down. This is the most powerful event. Now, the last one, which makes up pretty much the rest, is your color change. Simple color change. Now, this looks like a baby 180, and that's basically what it is. It's just really a simple flip from one color to the next. So this is a bullish color change where your green bar trades above the high of a red bar, and that's your entry. Now, this will tend to be beautiful off of something like off the 20-period moving average. Beautiful. Or even off the 200, but I like bigger bars off the 200. The small color changes are best off something like the rising 220. Beautiful color change. Like your stock did this, see? Boom! And this makes up about 15% if you want to count it all. So think about it. Elephant bars are 65%, tail bars are 10, 180s, you got the full thing. So elephant bars are 65%, tail bars are 10%, 180s are 10%, and 15% are these 4 things. The only 4 things that you will ever risk your money on. But we're going to make it really powerful. This is what most people are not doing. They don't have 4 things they know they can describe for you in detail for you and say, I only risk money on these 4 things. How many traders you know doing that? No, they're trading their feelings. They're trading their thoughts. I think this is a buy today. The news says the earnings, the this and the that, the market, the government, the that, and that's how their trading results look. Their trading results are all over the place. There's nothing consistent, nothing detailed, nothing exact, nothing the same way every single time. The techniques that guide all trades. The narrow state, we've been talking about this. I need you to become great narrow state identifiers because the best trades of your life will come from narrow states. Look at the left-hand side. Look at the narrow state between your 2 moving averages and your item itself. Narrow, tight, flat. Grab Be able to grab the explosion, which is usually an elephant bar, out of the narrow state. Come from way over here, guys. Come from way over here. Boom! Grab that bar before it finishes trading. Grab that 2-minute bar. I know we're looking at a stock here, but I want to show you stocks and your market. We're going to look at your market too. I want you to grab that 2-minute bar before it finishes trading. 1 minute, 30 seconds. Boom, in the bar, stop under the low or stop under the narrow state. And the rest is history. Now, we know that it's not the 20-period moving average you should be using here, is it? No. That 20-period moving average is across the street. I need something walking side by side with my item. And that's likely the 8. How do you know that you are near the end? Well, look at how wide apart you are. Remember that 3-finger spread? You went from the 3 fingers being like this to the 3 fingers being like this, wide apart. You're near the end. Narrow to wide state. Be an expert, okay? Be an expert. Narrow state. Narrow state. Take a look. The S&P 500. Look at the narrow state. Look at the flatness of your 200. Be able to grab the bar exploding out of the narrow state. Get in that bar before it finishes trading, and the rest is history. We know it's not the 20-period moving average you should be using. It's too far away. You should probably now be bringing the 8-period moving average on there. Ride that thing. Beautiful. Flat and narrow state. Look at how flat the 200 is. You've got to wait for these periods to occur if you want consistency. Grab the bar that explodes out of it. Get in that bar before it finishes trading toward the end of it, and the rest is history. Don't use the 20 if it's far away. Grab the 8 or the 13. It's probably the 8 here. It's the same thing, guys, over and over. Oliver, but do you have something else? Do you have something? No, there's nothing. Look, if you have something that can make you a fortune consistently, you don't need, stop tinkering, stop searching, stop looking. You have the thing now. You have it. You have it. Just hit that nail the same way every single time. Don't deviate. That's where consistency comes from. Hitting the nail the same way every single time. Not trying to be fancy, not trying to tweak. I want to tweak it, Oliver. I want to tweak it. No tweaking. Same formula over and over again. Narrow state, boom, you come out of it. Boom. Not the 20, probably the 8. Same thing over and over again. I just want to show you the picture over and over again, guys. Over and over again. Boom. Not the 20, the 8. Same thing. This is going to be your life. Do you understand this? This is your life. Boom. Rest is history. Not. All right. Over and over again. Okay. PayPal. Narrow state. Come out over here. Boom. And color change. Boom. Add. That's fine. Color change. Boom. Add. That's fine. You can add on color changes. I love that sound. Don't you love that sound? That's how my profits sound. Some of yours sound like this. And some of yours sound like this. Silence. But we're going to fix that. We're going to fix that. That's what you want. All right, let's go. All right, guys, there it is. Position. I know I'm slave driving you here, but I want to cover everything with you. The 7 main trading locations. Do you know most people understand in the real estate world, right? That almost everything comes down to location. Like you can build the best home in the worst location and it will not fetch the value that it should because the location is bad. Many people in the real estate business will tell you there are 3 ways to make money in the real estate business. Location, location, location. Well, I am here to tell you that it's the same in trading. Whether you're trading your index or whether you're trading stock, it doesn't matter. Location, location, location. You can't just play an event without asking yourself, what location is the event in? Elephant bar, fine, but what's location? What neighborhood does that elephant bar live in? We need location. Here's how we do it. So guys, the narrow state is what I call the trap zone. That's the narrow state. Here's your 200. Here's like your 20. And right above the state, right above it, is what I call +1. This is where your most amazing buys will come from. Your most amazing shorts will come right below that narrow state. Boom. That's where you get that sound. If I can get you to be number one location experts, narrow state experts, number one location out of the narrow state, up or down, flat and narrow, position one above, position one below. My goodness. If I could get you to do that, you're going to have very beautiful lives as traders because your best trades come from position one. All right? So that's the number one location. That's the top location. Your second best trades, believe it or not, come from position 3 down here and position 3 up there, but betting the other way. That's kind of like your second best. And your third best come from position 2, where we can play up or down. You can play up or down. Because 2 is up or, it's a little more challenging than 1, which is only long. 1, I only buy. 3, I really kind of only short. Down here, 3, I only buy. 1, I only short. But 2s, I can do both. So because you can do both, it's a little more challenging position 2. Believe it or not. But you need to know these positions. And all I'm doing is showing you this. Same cycle. Your best plays come out of here. Boom. Come out of here. Boom. See? Come out of here. Boom. Or come out of here. Boom. Or come from up here. Boom. Or come from down here. Boom. It's all about position. Knowing your best position. Now, let's look at position. Look at the tightness and narrowness of my state. This is position 1. And look at the move out of position 1. Beautiful. Position 1, tight, narrow. Here's position 1. Here's position like 2. And up here is position 3. When you move from 1 to 3 and you've got the triple wide space, the 3-finger spread, you know you're near the end. But your best trades are going to come from 1. You must wait for the 1. Here's position 2. You see? So here's my state. Here's 1. Here's 2. And here's 3. How do I know I'm at 3? 3-finger spread. It's over. If you start at 1, you can get to 3. If you start at 1, you can get to 3. If you start at 2, you can only get to 3. Understand that concept, guys. This is 1, here's 2, and here's 3. If you start here, you can get to 3. But if you start at 2, you can only get to 3. See? That's it. But here, you can get all the way to 3. So 1s give you the biggest profitable range. Look at position 3. Okay? Grab your state. Here's 1. Here's position 2. And here's position 3. And here, remember I told you from position 3, your best bet is to bet down, but you need an event. Don't just guess. You need an elephant bar or a topping tail bar or a bear 180. You get an elephant bar. Get in that elephant bar before it finishes, and the rest is history. Guys, this is trading by the numbers. People ask me all the time, you think I can really learn how to trade? And I'm like, I think so. Can you, well, how do you know? He says, well, can you count to three? I said, what? Can you count to three? I can count to three. All right, well, then I think you can trade. If you apply yourself, there's 3 locations. There's 3 items. Your item, your tradable item, your 20, your 200. There's 3 locations. 1, 2, 3. Your best plays come from 1. Your second best plays come from 3. There's really 3 main events: elephants, tails, 180s. And the small version of that makes it 4, but with the color change. But the 3 main ones are elephants, tails, 180s. The 3 events are your tradable item, your 20-period moving average, your 200. Your locations are 1, 2, 3 up, 1, 2, 3 down. Your 3 results are profit, loss, break even. Can you count to 3? Yes, Oliver, I think I can count to 3. Well, then you can trade. It's not rocket science. It's not rocket science. Here is the trap zone. So here's your state, right? Your trap zone is when you are in the zone. You are in between the zone. I prefer traders to stay away from the trap zone. There are ways to play it, but for the most part, I want you playing ones, which are outside of the zone, outside of the trap zone. But I did want to show you, here's an elephant bar coming off the 200 in the trap zone, and it still works. Here is position 1, elephant bar, position 1, boom. You know the deal. I just want to show you over and over again. Here is position 1 to the downside, guys. We see it both to the upside and downside, topping tail bar under the bar, boom. So here's a topping tail bar. I don't know if you see that tail, but that's a tail right there. Anyway, under the topping tail bar, 2 lots. Grab the first color change, 1 lot. The rest is history. It's not the 20-period moving average. It's the 8-period moving average. It's the same freaking formula over and over again. That's where your consistency is going to come from, applying the same formula every single time, the same way, no deviation. Position 1, look at the flat 200. Look at how flat that thing is. I love it. Boom. The explosion out of position 1. The rest is history. It's not the 20. It's the 8-period moving average. Same thing over and over. Now, the last concept I want to talk to you about is this: the off trading concept. This is what I call it. The off trading concept. Off. What do I mean by off? Off the 20-period moving average. Do you have something coming off of the 20-period moving average? Do you have something coming off of the 200-period moving average? Do you have something coming off of position 1? This off something, off support, off resistance, off the 20, off the 200, off position 1. Woo! When you add off, so you can have these combinations, right? I am off the 200, elephant bar off the 200, which is also off the 20 because it's down there, which is also off position 1. 3 offs? What? 1 off is amazing. 3? So you can stack your offs, right? And that's how you rank your trades, by how many things stack on top of each other. This one has 3 things. This one has 1 thing. I'm going with the 3 thing. Here we are off the 200-period moving average. We are also off the 20-period moving average. We are also off position -1. Wow. That's insane. That is insane. You're off 3 different things. Off the right location, off the 2 items, the 20 and the 200. That's why this drop was so powerful. You had 3 offs there. All right, look. Off the 20-period moving average and off position 1. It doesn't have to be perfect, but Oliver, it's a little bit above the moving average. It's a little bit above it. That doesn't matter. Remember, I told you the moving average is an area. It's like a fence you can lean on. That's off the 20. Boom. The rest is history. You're off the 20, off position 1, off the 20-period moving average here. Boom, there's your 20, off it. Beautiful. Now, remember how you would play this? You would enter in the elephant bar and you would add mandatory add on the first color change. Boom. Off the 20-period moving average here and off position 1. Woo! How many offs do you have? Off the 20. Don't take something that's not off of something. We need it to be off something. Woo! Off position 1, off the 20, off the 200, off, you've seen this chart before, but off the 20, off the 200, off position 1, off the 200, off the 20-period moving average, off the right position. How would you play this? Get into that bar, add on the first color change. Boom. Love that sound. I can hear some of you saying it right now. I can hear it. Did you know that some of you I can see? Like you don't see, I can see you. So we have this special technology that allows me, not in everyone, but I can see through your camera. Yes, so cover yourself up. No, I'm teasing, I can't see. But what I can do is I can hear some of you. I can hear some of you. I can hear you saying, but Oliver, you're showing us stocks. We trade the Brazilian market. It's not the same. Your method is amazing, but it doesn't work on the Brazilian market. This is ridiculous. This is ridiculous. Is there fear in your market? Yes. Is there greed in your market? Is there ambivalence in your market? Uncertainty? Absolutely. Do human beings trade it or do Martians trade it? Human beings. All markets are primarily the same. Small variations, but primarily the same. And it is ridiculous to think that what I've taught you does not work on any market. Let me tell you, and I'm going to show you right now, not only is what I teach you applicable in any time frame, long-term time, short-term time frame, any time, any market on this planet. Now, I don't know about other planets. I have yet to do intergalactic travel. Do you understand? So if there are markets that exist outside of this planet, in the galaxy somewhere, I don't know. But on this planet, this green Earth that we call Earth, if it's a market, what I'm teaching you works on it. Let's take a look. Putting it all together in your market. Now, what I have to do, guys, when one of your items is far away, you can use 2 of the 3. So see how the 200 is far away? We can use 2 of the 3 now. The item and the 20. Flat. Boom. We're coming out of the flatness. Riding. Now we know it's not the 20. We have to put something shorter on there. And I'm going to bring the 8. Boom. There's the 8. So got the explosion out of the tight and narrow. I didn't get shaken out here. My stop, I want my stop really under the narrowness. How do I know it's the 8? Look at the pullback. It bounced off the pullback, off the 8. Boom. How do I know that I'm getting close to a top? Because now, like the 8 can sometimes confuse you, but look at your space. You went from no space to look at the space, and certainly here. So remember, 3 fingers wide apart. You're near the top and the bottom the other way as well. Here's the dollar. So notice that you were tight and narrow, obviously up and to the left here. And here you're coming out of it. But I want to show you, and your stop should be above up here somewhere. But I want to show you this. Here's off the 20-period moving average. Off the 20-period moving average. This is off the position 1 and off the 20 as well. This is off the 20, elephant bar, off the 20. Guys, I want you to understand that this red bar was a full red bar at one point. Boom. Stop above your state somewhere up there. First color change, add. So you did maybe 2 lots there, 1 contract or lot there, and the rest is history. And then you get another off event here. Enter, stop above the event. The rest is history. And you know, guys, it's not the 20 here. All right? So let's put the 8 on there. Boom. And you are out. It doesn't mean you can't take profits along the way either. I don't have time to get into that, but you should be taking profits along the way and stopping out on the 8 with your last position. And we can look at just, I want to show you coming out of things. Boom. You would definitely want to be taking profits up here. And you know that, look at the flatness of your 200. Now, you know that it's not the 20 here, it's the 8, and maybe you get stopped out here on your last lot. You're not going to always get the tippy top. Let's not be ridiculous. We live in the real world. We don't live in Disneyland. Remember I told you that there's just one cycle? Take a look in your market. Look at this. There it is. Now we start again, and this is a smaller one. It just repeats over and over again. You have to realize that you are in the top 3 because of the wideness. You see? You have to know that you are in the 1 because of the narrowness. And you're back in the 1 here. Why? Because you've gone flat again. Look at your 20-period moving average. It's flat. So if you were to take the dollar away and just look at the 20-period moving average, just look at it. Look at the 20 kiss the 200 right there. Look at it now. Move away and come back and go flat. That's like my drawing. You got to know where you are in your cycle, guys. And I can go back. You see how this elongated 1, look at the flat 200. And you finally emerge out of here. What is your most powerful event? It is the bull 180. Remember? Look at the bull 180. Look at what it's off of, the 200. Now it is in the trap zone, but still it's off the 200. How do you know you are likely near a top? Because of the 3-finger spread. Finger, finger, finger. Is it making sense? Are you seeing it in your market? Are you seeing, look at the cycle play out, guys. Look at the cycle. Look at the cycle backwards. Now look at the cycle upwards. It's the same thing over and over again. How do you know you're ready to move back up? When you're wide here. How do you know you're ready to move back down? When you're wide here, wide down here, wide up here. Now this is just one time frame I'm taking a look at here. You're wide now. And I don't know if you can see these nuances the way I can, but it may take some practice. But remember the cycle, right? So take a look. You see the flatness? Now, I know there was a tricky breakout here, but you come out of it there. You really come out of it here. It's where you clearly come out of the flatness. How do you know that you might be ready for, boom, topping tail bar? Okay. You're wide now, so there's likely not that much left. Moving averages have come back to being close. Grab the closeness. Anything that surges out of the closeness is your play. All right. Same thing. You need closeness or flatness. So you see how your 20 goes flat again? This is a brand new period of flatness. You come out of the flatness, boom, first color change, add, boom, and the rest is history. You see how your 20 comes flatness again a little bit here? Boom, that's off the 20, out of flatness. And you can keep going until you get a little too wide, and then the accuracy of that starts to break down. But as you can see, color change off the 20. But when you start to get really wide, look at the wideness here. Now you're at a 3 down here. And it's better to play back this way. And you get your most powerful event of all. Bull 180 away from everything. Boom. And you grab the bottom. Here is coming out of, I think we looked at this already, coming out of flatness, not getting caught here because it's not 2 bars down. But look at from position 3. Remember I told you, once you get a full bar below, you're absolutely certain now you're in 4. And this one looks like you can ride the 20 straight down. There's no 8 needed. Just ride the 20 straight down. And boom. I mean, I know that's the next day, but you get the point. It's powerful, guys. It's over and over again. The same thing. Look at your 3-finger spread down here, guys. The Bovespa is way below the 20. The 20 is way below the 200. 3-finger spread. And you get an event. You can't guess. Bottoming tail bar. Boom. Look at the 3-finger spread this way. And you get your color change up there. Boom. Notice your flatness. Notice your flatness. Now you get some false breakouts here. The reason why I would prefer the break from flatness down is because look at the space. See, when I get space like that, I'm looking down, guys. I'm looking for the event down, not the event up, because I'm up there near position 3. This is why knowing where you are in your cycle, boom, that's the one. Then the first color change, boom, that's the one. Right back to the 200. If I want to play this position 3 up here, this 3-finger spread crack, I can't guess that that's the top. I have to wait for an event. That's an elephant bar. I get in that elephant bar. Before that elephant bar finishes, put a stop above here, and the rest is history. Don't let the wiggles shake you out. Another flatness here. Boom. Boom. Space, flatness, position 1s. This, a gap way up here, I might initially play that downward if it's high enough. Your market is quite predictable at times, very fluid if you're in the right time frame. Like, look at this beauty right here. This gap is born out of flatness. Boom, boom. It's a beautiful thing. Most traders don't know what to wait for off the 20-period moving average. Most traders do not know what to wait for. This is off the 200. This is an 8-period moving average ride here. You understand? Ride that 8, ride that 8, ride that 8, ride that 8. You can take profits along the way. You do not get a 2-bar break here. Ride that 8, ride that 8 out here. Most traders do not know what to wait for. You know, guys, I will tell you that if I had to change the name of this activity, this wonderful activity, we currently call trading. I would call it waiting, because our job is basically to wait for what we know. Understand? What do you know? I know the best trades come from flatness, right above or right below. I know that the elephant bar out of narrow flatness is the most common trade I'll make. I know when it's exploding and trending that a lot of times it's not the 20, I got to apply the 8 or the 13. I know when I get the 3-finger spread, I am near a top and reversal or a bottom and reversal. I know that the best plays are always off of something, off the 20, off the 200, off the right location. Waiting for what you know works is the hack. And notice that I'm using the word waiting, not searching. Novices search. Let me try to find an elephant bar. Let me try to find a narrow standard. No, you wait. The professional waits. The novice searches. You ever see like a leopard or whatever wait for his prey? Stalking his prey. He's waiting. He's not roaming around searching. He's not going to get anything like that. Sits and waits. And it's easier for Brazilians who trade the Brazilian market to wait. It's harder for Americans who trade the US market to wait because there's so many things. You trade 2 things. You can just literally have 2 windows up and just wait for the narrowness, wait for the flatness, wait for the explosion out of it, wait for the 3-finger spread, wait for elephant bars, wait for bull and bear 180s, wait for color changes off the 20, wait for explosions off the 200, wait for position ones to occur, and leap into action. It's a wait game, not a search game. A trader searching, I know he's a novice. I'm scanning for opportunities, Oliver. That's a novice. Oliver, do you have a scanner? That's a novice. Pros don't need stuff like that because they know what to wait for and what to strike for. And let me just say this. Some of you, when I say this, you might feel like, well, Oliver, is that enough to make a living? How often do these things happen? More often than you have money to play. This is one thing you do not have to worry about. You do not have to worry about, well, I'm waiting and waiting and waiting. And no, there will be far more opportunities than you can ever take advantage of because you don't have enough money or enough eyes or enough time. Be in the trade and another one will happen. So don't worry about that. It's enough. It's frequently enough to make a living in the markets. Exactly what I've taught you. What I wanted to talk to you today is about a question that my team has told me comes up incessantly, and it's regarding candlesticks. And what my team told me is that the most predominant question relating to the topic of candlestick charting is whether or not the traditional candlestick format is inferior to another type of candlestick, a more modern, a more recent formation or version of candlesticks, such as, I think it's the Heikin Ashi. And I think that's the number one question. Oliver, I see that you use traditional candlestick charting in all of your work, but what about Heikin Ashi candlestick sticks? And what about this version and that version, what have you? And I'll start off by saying this before we go to charts so that I can show you a difference here. The first thing I will tell you is that any form of charting is better, any form of candlestick charting is better than nothing. So I feel that the candlestick version of charting is far better by orders of magnitude than your regular bar charting. It requires more thinking and analysis. And so the candlestick drops the need for thinking and analyzing as much as the regular bar chart requires. So I like that. So any form of candlestick charting is better than bar charting. Any form of candlestick charting is better than line charting. I wanted to get that out of the way. Candlestick charting, in my opinion, is superior to all the other major forms of charting. Now we get into splitting the hairs. Is the traditional form of candlestick charting better or inferior to Heikin Ashi? Is the traditional form better or inferior to volume candlestick charting, and so forth and so on? And that's what I want to talk to you about today. In particular, the difference between traditional candlestick charting and Heikin Ashi charting. They both have benefits, but I'm going to tell you why. I'm going to explain to you why I prefer the traditional form over the Heikin Ashi form. But I will also show you what's superior about the Heikin Ashi form of candlestick charting. So let's do this right now, if you'll allow me. Okay? So what you are looking at right now is a 2-minute chart of strategy. It was formerly known as MicroStrategy, the Bitcoin treasury company run by Michael Saylor. All right, I'm a big fan. Every bar represents 2 minutes of trading. You have 2 main moving averages. If you followed my work for any particular time, you know that I do not look at a chart unless it involves or includes the 20-period moving average, that's the blue line, and the 200-period moving average, that's the red line. 2-minute chart, 20-period moving average, blue line, simple. 200-period moving average, red line, simple as well. Candlestick format that you're looking at are the traditional regular candlestick, which involves all the data points of a period. So if we're talking about a 2-minute period, your 2-minute bar, for instance, this 2-minute bar is going to show you the high of the bar, the low of the bar, the open of the bar, and the close of the bar. And if we take another example, I'll blow this up so you can see a little bit more detail. If we look at this 2-minute bar, the traditional candlestick is going to show the low of the bar, the high of the bar. It's going to show you where the bar opened and where the bar closed. Now, the close and the high on this bar happens to be the same. But one more time, I want to take a bar that has all 4 data points very clear for you. If we take this bar right here, you have the open of the bar, the close. How do we know which part of the box is the open and close? Well, if it's red, the open is the top of the box, and the bottom of the box is where it closed. If it's green, the open is the bottom of the box, and the top of the box is where the bar closed for that period. We're looking at a 2-minute period. We also have, in the traditional candlestick format, the showing of the low. That's going to be at the lower extreme of your bottoming tail or wick, and the high, which is going to be at the upper extreme of your tail or wick. Okay? So in the traditional form, you have all 4 data points. All 4 data points. Okay? In the Heikin Ashi, if I were to show you this and flip this to the Heikin Ashi, you're going to see a more smoother version of the bars. Why is that? Because it doesn't give you all 4 data points per se. It averages those 4 data points into a general average. So it takes the highs and averages the highs. It takes the lows and averages the lows. It takes the opens and averages the opens. And it takes the closes over a certain period and averages the closes to give you a more smoother, cleaner look to the chart. Now, here's the important thing. That's the difference. In the traditional form, you have all 4 data points every single bar. When you average those data points, you lose the specific detail, the precision You lose precision every time you average. I want you to think about what a 200 period moving, what a 20 period moving average does. It averages all the individual bars over the past 20 bars. So you lose the detail of each bar in exchange for seeing a smoother representation of all of the individual bars. Now, that doesn't mean that it's worse than the other when you lose the detail. It just, you have to pick your poison. What are you after? Because there are benefits to smoothing the data out. But there are also benefits to seeing precisely where a specific point is. All right? So listen, when I need to know, I want my traders to know exactly to the penny where you hit this thing up. I need you to know. It can't be vague. It can't be, it's in the area. Oliver, I'm entering in the area around here. No, not around there. I need you to tell me to the penny where you're going to risk your capital or my capital. Not, oh, I'm going to risk your capital around this, in the vicinity of this price. No, there's no vicinity when it comes to you risking my money. I need you to tell me to the penny where my money is going into the market, where your money is going into the market. I want to know precision. I need the regular candlestick bar for my entries. I need the regular candlestick bar to know my precise stop out point to the penny. I don't want an average stop out price. I don't want a general area where I get out to protect my money. So when it comes to entries and exits, it is regular candlestick, hands down. I need that precision. I need that precise high of my entry bar, or I need the high price of the previous bar if I'm going to enter 1 penny above the previous bar. I need the precise low of this bar or this event if that is where my stop is to the penny. I don't want it vague. I don't want it average. I don't want it freaking smoothed out. All right? So when it comes to entries and exits, I need that precision that the classic candlestick chart gives me. Now I'm going to go to you, and I need to make sure before I move on that you understand this point, that you understand the difference. Let me know, yes or no. You understand the difference between what the Heikin Ashi does. It averages and smooths it out like a moving average, and the classical doesn't. It gives you the precision, price per price, bar per bar, period by period. There's no smoothing out of the data whatsoever. I need you to make sure that you understand me when I say, when it comes to entries and exits, there's nothing more superior than that level of precision. Make sense? I'm looking at your charts. Just want to see a few yeses. Make sure we're still on the same page. All right? Make sure everybody understands what I'm saying. Excellent. Very important to understand what is going on here. When I say that I need the precision when it comes to entries and exits, I want to give you an example of this precision. My traders playing MicroStrategy would see this bar in particular being what's considered to be a clearing elephant bar not too far away from the 20-period moving average. So here's an elephant bar, that bar right there. Why would they consider it a clearing? Because this is the bar, there's a little one there, but we throw little ones into the big bar, okay? So what's really happening here is that you're getting a complete clear. This is the first bar that is really clear of prior price data. That's what makes it clearing. It's clearing price data. So if you look to the left of this bar, there is no conflict or colliding with former data. You have to go back a ways to see former data. There's no former data right next to it in the recent vicinity of this bar, making it a clearing elephant bar. Very powerful short signal on the downside. You can have clearing elephant bars to the upside as well. But this clearing elephant bar to the downside would suggest there's going to be follow through, especially since you have an overhead 200 above you that is bearing pressure on the stock downward. You also have an overhead 20 period moving average bearing pressure above you, and the space between the two is also like a concrete ceiling of resistance. You see that? So that block of concrete there, guys, above this clearing elephant bar that's dangling down there like that, means that an upward move, you don't have to worry about anything. That ceiling is going to keep that upward move intact. This should have follow through to the downside. Now, I'm going to show you where the precision comes in, okay? You see, in addition to whacking this bar, my traders would be taught to enter this bar. Come from way over here. Boom! Enter that bar before it closes. Enter your clearing elephant bars before they close. But also, they're taught that you must also enter on the first color change. Now, if you followed my work for any period of time, you understand this. You must additionally hit your play up on the next color change. So you enter the igniting event and you add on the first color change. Well, if we go back to the chart here, what's the first color change? It is right here. When you get green, is taken out, sorry about my puppies, excited here, taken out by red right there. So your next color change add is here on that follow through red point that breaks the low of green. I need the precision of the low of that green. Do you understand? I need to know when that green finishes, where's the low? And if a red bar breaks that low, 1 penny below that green bar is my next entry. So I enter 2 lots on this one, 1 lot on my add, and boom, I've got my 3 lot position, or in some cases, my 4 lot position, 2 and 2. So that's the kind of precision that I need that is offered by the classical candlestick, the classic candlestick variation. If I change this to Heikin, look at what happens to this point there. Watch this. Look at what happens to my color change opportunity. Heikin Ashi, it disappears. Do you see that? Even it becomes a little harder to know where's my clearing elephant bar, but where's my color change? There's a hidden one here if you want to get very specific, but that's a little bit more advanced. My color change is not there. The next color change reality is way down here. So I miss this opportunity here that was there. I get a late color change all the way down here. And I get another late one down here. When in fact, if I went by classical standards, I would have made a lot more money. I would have made a lot more money doing this. Let me change it back. I'll show you. I would have entered this bar, boom. I would have entered that color change, boom. And where you see the next entry point, my entry point is here on classical, but my entry point on Heikin is here. Look at the difference. Look at the profit I gave up by entering that late. Instead of my second entry there, my second entry on Heikin is here. I want you to see the huge difference in price here. Let's call that 387 to 385. So that's like a 2-point difference. On 1,000 shares, I just gave up $2,000 in profits. And because it's 2 lots, that's 2,000 shares. I gave up $4,000 in profits. just because I wanted my bars smoother. I want my bars smoother, Oliver. No, man. I need exact precision. I make more money when I have exact precision that way. Did you understand that example? Let me know. All right, I'm going to take a look at you, look at your comments here. Make sense? I'm looking at your comments here. Does that make sense? Last point I want to make for you. Let me explain to you when Heikin Ashi, or under what circumstances Heikin Ashi can shine over classic candlesticks. Like I told you, they all have their strengths. This is where it shines. Let's go to the charts again, okay? Anytime you are averaging something, it is always better during a trending market. When you average during a sideways market, you get killed. All right? Look at the average. Look at the averages. Look at your 20-period moving average and your 200-period moving average here when the market's sideways. It's kind of disrespecting the moving averages. The stock is acting like the moving averages are meaningless. I can spend time above you. I can spend time below you. I can sear through you anytime I want. That's what the stock is saying. You make no difference to me. I can sear through you anytime you want. Here I'm below. Now I'm above. I'm above the 200. Now I'm below the 200. I'm above the 200. Now I'm below the 200. When they're flat and not trending, when they're trying to average a sideways movement, moving averages are horrible. But look at when they start to become obeyed, right? So for a period, your 20 starts to trend. And now it's obeyed a little bit more, you see? You see how the 20 is trending and now it's obeyed. So moving averages become, the 20 becomes more powerful in a trending state because it's an indicator that averages. Anything that averages becomes superior in a trending state. When it's not a trending state, it's horrible. So likewise, Heikin Ashi candles are an averaging, it's an indicator that averages, which means that its superiority lies in a trending market. Now, I want you to look at how this is the classic trend to the downside. You see the noise there? So this is your whole movement to the downside in classical. All right? I want you to look at the jags, the jigs, the wigs, the zigzags back and forth. Boom, 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 boom. Now, if you don't know what you're doing, these can fake you out, cause you to panic out of your play when you're trying to maximize the whole movement down. Well, Heikin Ashi candles can help you when your stock is trending smooth that out a little bit. So now you get a smoother, all right, it still couldn't smooth this out because that move up was too big, but you get a smoother move during the trending markets. Why? Because it's averaging out the noise. So if I were to say, use Heikin Ashi, and I'm not, but if I were to say it, if I were forced to make you use it, I would say only when your 20-period moving average is trending. Meaning, only when your 20-period moving average is doing this on a stock, and only when it's doing this on a stock. Oh, I did it the wrong way. So when your 20 is trending, Heikin Ashi candles can have some superiority in helping you hold on. But in truth, you don't really need it because that's the purpose of the 20-period moving average in the first place. I could hear the 20-period moving average saying, bro, what are you doing? I got you. I do that. I do the averaging for you. You don't need something else. Relax. I got you. You understand? So the 20-period moving average takes care of you. Let's go back to the classical. And if you're rocking with the 20 and taking profits away from the 20, entering at the 20, taking profits away from the 20, entering at the 20. So you're taking profits away from the 20, entering on the color change or the event at or near the 20, entering away from the 20. You see? We exit away from the 20, enter near the 20. So the 20's got the average for us. We don't need the bars averaged themselves. We need a separate indicator outside of the bars that's giving us a smoother picture of the bars. So we have the precision in the bars, but the smooth out version of the bars in the moving average. So we have both, but they're separate. With the Heikin's trying to give you the smooth aspect of it in the bars, so you lose the detail in the bars. But the details we need for entries, exits, and stops. So we lose that. So I say, whenever you want to know the answer of whether I believe something is superior over another, just look at what I use, because trust me, this is as certain as night follows day, people. Do you understand? This is as certain as night follows the day. If I find something that is superior to what I have, I'm going for it. If I'm not using it, it means that I haven't found it to be superior to what I have, to what I use. I've decided that I would show you the 15-minute time frame. Now, remember, this is applicable on any time frame. So the first thing you're going to do is look at the state of your stock. Notice that you've got this flat 200, you've got the flat 20, and the 200, these are so flat, but the 200 is basically on top for the most part. And look at when you got a fat, elongated elephant bar igniting from the area of the narrow state. Boom! Now, here is what you do. We call this a clearing elephant bar. Why? The bar is taking out 5 or more. It's taking out the lows of 5 or more bars to the left of it. Remember that concept, clearing elephant. It's taking out 1, 2, 3, 4, 5 or more. So we're clearing the lows of the last 5 bars or more. Boom! That's where you clear the lows of the last 5 bars. My traders are taught, once you have a narrow state, the 200 is above everything, and you get a solid red that clears the lows of the last 5. Guys, solid red that clears the lows, boom, of the last 5 bars. So here's the last 5 bars, and boom, 1 bar wipes out the lows of 5 or more. That's when you've got a clearing elephant bar igniting, being born from a narrow state. Woo! You dive into this bar. Do you understand? You dive into that bar with whatever money you have. You want to be inside that bar. And this is where the gift starts delivering. Once you are inside of that bar, the rest should be history. You want to protect yourself because nothing's 100%. We jump inside the bar. I want my stop somewhere up here above the narrow state. I don't want it in this case above the bar, because if I don't want to get stopped out right at a perfect location. I need my stop above this narrow state. So make sure you get that stop if you can. If it's not too far, get that protective stop somewhere above that narrow state. just in case this turns around and doesn't work. But it should work, and the rest is history, guys. Look at what happened on the clearing. They don't all work because you had a clearing here. But the problem with this clearing is that it's not quite the elephant bar size. I mean, this is more of a normal size bar. Do you understand? You have to make sure it's not just the color that you want, it's the size, power, and violence that you want. This bar, people, is not a normal bar. And one of the things traders start to do is they start to get sloppy with defining what an elephant is. I'm not talking about the footprint of a cat or a footprint of, oh, Oliver, here's a red bar and it looks like a footprint of a little a mouse. No, I need a footprint of an elephant. Show me an elephant. I need to make sure this bar is an institutional bar. I don't care about a bar that your neighbor can form or your relative or your friend, all right? Those form little bars, but institutions form, boom, they're the elephants in the room. And they can't move without forming elephant bars. They can't really dive in or exit in large amounts without forming an elephant bar. So by our scouring the market for elephant bars igniting from narrow states, what we're really doing is spotting when the institutions are getting in, green, elephant bar from a narrow state, or when they're starting to come out, red elephant bar from a narrow state. This red elephant clearing bar from the narrow state on American Express, that's not your friends coming out of American Express. That's not your neighbors. That's not anybody you know. That's billion-dollar firms exiting, and they can't hide from us. So, boom, dive into the bar, get that stop above the narrow state. The rest is history. I just love that sound. Let's do it again. As a matter of fact, I gotta see this, guys. Do the sound for me, guys. Just do it for me. Indulge me, please. George, I want to see it. Show me the sound. Show me the sound. Some of you, that's a $100 bill counter on your trade. Some of you have that machine, right? But it goes like this. Oh, Oliver, I have one too. No. We need. That's what you're going to get from the narrow state, elephant bar, narrow state. These two gifts together going to deliver forever. 70% of the time, you more than, oh, I forgot to even mention that. So you know how I told you that the elephant bars have 70% follow through? All right, 7 times out of every 10. And remember I told you that 85% of your best trades are going to come from a narrow state? When we put these two together, guess what percentage of success you go to? 92%. Holy shit. Are you kidding me? But Oliver, how is that possible? It's possible. Trust me, 92% follow through rate when you put these things together. I can't believe I freaking forgot that. That's what makes it so powerful. 92% follow through rate, which means that there are, so some people say, Oliver, how can you be right not more than 9 times out of every 10? Isn't that 10 times? Yes, the way you get 9.2 is that for many sets of 10, it's 10 wins out of 10, 10 wins out of 10, 10 wins out of 10, 10 wins out of 10. And that's how you get. Sometimes it's not. Sometimes it's 8 wins out of every 10. Sometimes it's 9 wins out of every 10. And it averages out to 9.2 wins out of every 10 tries. Elephant bars igniting from a narrow state, 92% follow through rate. I am telling you, this combo is responsible for more of my traders' gains every single day, every single week, every single month than anything that I've ever taught you. And you can ask them. Some of them are here. Some of them are watching this present. Ask them right here. They're right here. Some of them are watching right here. They will tell you, my best trades are coming from what Oliver's talking to you about right now. Now, remember what you do, right? Look, narrow state, moving averages close together, and clearing. You're not going to get all of the narrow state and clearing. So 1, 2, 3, 4, 5. It is clearing the lows of 5 or more bars coming out of your narrow state. But remember what version this is? Remember, you have two different versions. You have this, you've got this version where you're coming from the narrow state, but it's not quite up against the narrow state, but it's still close. So that's version 1. Version 2 is you're coming off of, let me clear this up a little bit. So that's version 1. Version 2 is you're coming from the 20 period moving average. And version 3 is you're coming from the area of the 200 period moving average. That's the one we have here. It's igniting from the 200. And this tends to be the most powerful. They're very close. You don't even have to rank these, just take them all. But the one igniting from the 200 does have the edge in terms of power. Some people might point to this and say, Oliver, but look at this. Look at the green clearing that I got over here that failed. And this is true. These moving averages are relatively narrow. But remember when I told you it's best if your 200 is below you? You see how the 200 is above you? So it's not the most ideal. See, when you're going long, it is best that that 200 is the one below. You see, the 200 is above in this case. And so that makes this one the better play. That order means something. Here's your play. Boom. Dive into that bar. You can put your stop above the bar's high in this case because that high is above the narrow state. So you're fine. Putting my stop above this bar does not get me above the narrow state. So I need another stop above the narrow state. But when the high of your entry bar gets you above that narrow state, that's fine. Use the high of the bar. So look at what your risk is. My risk is this. This is my risk. This is what I would lose if this happens to be one of the few that fail. And this is what I win. You see that snowman? That is how you stay in business, people. You see that? You want the snowman effect, right? I used to do this when they were kids, snowman. These 3 buttons represent 3 push profit taking. But this is how you stay in business, people. Do you understand? Take a snapshot of this. Hang it on your freaking wall. Show it to your kids. Your risk should be the head. Your profit should be fat like a snowman's body. Do you understand? This is how you stay in business. The head represents the loss. The body represents the fat gains. Make snowmen and you're in this game forever. You will have a very comfortable life. I promise you. It's the snowman effect. All right, let's go. Look at UAL from yesterday. Look at the narrow state. Guys, can you get any more narrow than that? The moving averages go from relatively wide to narrow. And look at how your elephant bar ignites right from the narrow state. Boom! Dive into that clearing bar. Add on the first color change. That's a different session. But my traders know to always add on the first color change. And the rest is history. There's that sound again. But Oliver. That's how all the doubters sound. Have you ever noticed that? And they always do their thumbs like this. But Oliver, I'm confused, Oliver. But. They can't get their butt out of the way. But Oliver, this is what they're going to say, right? But Oliver, what about the clearing on the bull side? What about the clearing elephant here? Well, if you look again, it's a true clearing bar. It didn't work, but Does it have the most ideal order of the moving averages? No. I'm not saying that's not a clearing. It's beautiful, actually, but the order is not. So it's not perfect. If you can stick to the perfect ones, guys, your odds are going to be so much better. Where the 200 is the higher one and the state is narrow and you ignite from that. Boom. Boom. Now, what I want to show you in a video, look at the wide state. So we go from wide to narrow. Narrow state. 200 on top, 20 on the bottom. We ignite from the narrow state, and we dive. It's a clearing bar. It clears the lows of the last 5 bars. Boom! And the rest is history. There's that freaking sound again. You see? Are you starting to see? Guys, are you starting to see how powerful this is? Talk to me. Are you starting to see how powerful this is? These two gifts combined. Tell me. I just want to see it. Type it for me. Indulge me. Are you starting to see? All right? Do the Trump dance. Now, what I like about the Microsoft, remember I told you the different versions, right? So remember I told you that you can have the 200, the elephant bar ignite from the 200, the elephant bar ignite from the 20, or the elephant bar ignite a little bit lower. Now, the only thing here is that the order is not perfect. You got the clearing, you got the move out of the relatively narrow state. The order is not perfect here. It still worked, but I do want you to note that. All right, the better ones are when the 200's on top. This is so powerful that many of the opposite order still works. I need you to be aware that there's a slight difference in the success rate, okay? This one was one of the ones that worked, but it's better to have that 200 above you. Now, if we take a look at JPM, we've got the version of your clearing elephant bar igniting from the 20. Now, remember the 3 types again. You've got the ones that ignite from the 200, ones that ignite from the 20, and ones like this. They're still in the vicinity of the narrow state. They're just not igniting off of it, off of the 20 or off of the 200. Still works. The 3 different versions still work. Okay? So how do we play this? How are my traders playing this? It's very simple. They're diving into this bar, getting that stop above somewhere. So they would use maximum loss per trade. I can't go into this today, guys, but they would use maximum loss per trade somewhere up there. They would enter on the first color change. I've taught you this. Always add on the first color change. So 2 lots in, 1 lot add. The rest is history. Okay, beautiful. All right, let's keep going. Because now we can really roll, guys. You know the deal. Here's the Dow Jones Industrial Average, or the diamonds, igniting off of the 20-period moving average, clearing the lows of the last 5 bars or more. Dive into that bar. Get your maximum stop loss somewhere up there, and the rest is history. All we're doing is combining the 2 reliable gifts, elephants and states. Elephants and states. Boom. Clearing the last 5 bar lows, getting your stop up there. First color change. Boom. Here's another clearing. This is this version of your clearing, guys, because remember this bar was down here. This version of your clearing, it's still close enough. If I missed all of those, I would grab that one too. Just remember, clearing elephants trading lower than the last 5 lows in one fell swoop. trading lower than the last 5 lows in one fell swoop. Your order's not perfect here, but it gets perfect here. 200 on top, 20 on the bottom. So, some traders ask me, Oliver, should I just limit myself to the best order? In the beginning, yes. I believe you should. Now, if you limit yourself to the right order and you only take the right order at first, but you note the non-right orders, you see them and you track them too. If the non-right order are still working way more than not working, then you can start venturing to take both. But make sure if it's the non-correct order that it's small risk. So your stop is closer than normal, I would say. So just make sure that every non-order play you take, that stop is tight. Okay, you can be a little bit more liberal when the order is correct. Guys, McDonald's represents one of the types. Remember the 3 types again. This is the one coming off the 20. There's a version coming off the 200. And there's a version like this one, you see, that's in the vicinity of the narrow state. It's still close enough to take. But this one is igniting off of the 20. Dive into that. You know what to do with this. You're clearing the lows of the last 5 bars all in one fell swoop. You're igniting off of the 20-period moving average. You're diving into this bar before it finishes trading. You're putting your stop somewhere up here. You're adding on the first color change. Boom. And the rest is history. And I love this measured move. My traders know this, guys. My traders know the measured move. Get in, and look out. So look at the distance between this and the distance between that are almost equal. Boom. That's called a measured move. We love those measured moves. When you get the same distance between these two on this side, it's time to take profits. It's called a measured move. Citibank, beautiful. We've got the perfect order. We've got the relatively narrow state. See, wide state is here. Narrow state is here. And boom! Dive into that bar. Get your stop up here somewhere if you can. If you can't, go over the high. It's fine. My traders know this as a hidden green color change, a hidden color change. So they're going to come in here and boom, add. So they would do 2 lots in, 1 lot add, and the rest is history. There's that sound again. I love it. MS, perfect order, 20 above, 200 above the 20. All right. What bar in one fell swoop cleared the last 5? Well, you got 2 here. The only thing I will say about this one is that it's more of a regular bar. Here is your real elephant. Boom! Get in that bar. Get your stop up here above that narrow state. Add on the first color change. Boom! And the rest is history. I'm using yesterday because so many of these happened, and I just wanted to drill. Guys, when you see image after image, play after play after play after play after play after play, it builds your confidence. It sears the tactic, the event in your mind, so that when you see it forming live, there's no doubting, there's no guessing, there's no over-analysis about it. It's just boom inside that clearing bar. But this can only come as you see thousands upon thousands of these, and you see how reliable they are. You see how they almost all work. So the more you see, this is the purpose of showing you one after the other, after the other, after the other, after the other. So drill it, to sear it in your mind. Because at the end of the day, it's all about how you do when it's in your face, real. See, these bars are not moving, but the bar in real life is going to be moving. Who are you then? What do you do? Do you rise to the occasion, or do you double guess yourself? But wait, I see the clearing elephant bar. I see the narrow state. But let me check the planetary alignment of Saturn first. Let me check what the S&P is doing. Let me see what my friends are doing in the chat room. Let me check with my best friend. He's a good trader. You know, like the more you see this, the more none of that nonsense is necessary. You see it, boom. You see it, boom. Up, clearing, boom, narrow state, boom. No thinking, no guessing. Like your name. What's your name? Oh, let me think. Let me check with my best friend. He knows my name better than me. No, none of that. My name is Oliver. Square, beautiful. Boom. You know, guys, I'm bored now. All right, we've seen this over and over again. I'm bored. Here's the clearing off the 20 period moving average. Boom. Stop. First color change. Boom. Rest is history. All right, it's boring now, for real, seriously. I don't even know if I should have given you all these examples. It's just obvious now. Boom. Stop. First clearing. Rest is history. Those are your two gold plays. Intel, beautiful, guys. Beautiful narrow state here. So beautiful. Perfect order. Look at that clearing. Boom. Stop. Hidden color change here. Your topping tails are green, guys. Don't forget that. Your topping tails are green. Once green is taken out, boom. And the rest is history. Boring, but that's how it needs to become. Nugent, boom, here's your gold play. Off the 20 period moving average, you got that version. This is not so narrow though, but that's your orphan narrow play. I'm not going to get into that. My traders, that's something I teach my traders, so I'm not going to get into that. But here is another igniting, clearing. That's your 20 MA version. Here is your hidden green. Guys, it's the same thing over and over again. Add on the break of your green right there. And the rest is history. Over and over again. Guys, if I could just get you perfect order. Look at how tight and narrow the state is. This is the one that's igniting off of the 200, your most powerful one. Look at the clearing of the last 5 bars to the left. Boom! Get in there. Stop. Add on the first color change. Your tails are green, guys. So once the green disappears, and the rest is history. It's the same formula. Do you see the same formula? There's no different. I don't care if it's Monday. I don't care if it's Friday. I don't care if it's raining. I don't care if it's sunny. I don't care if it's a full moon. I don't care. It's the same thing. I'm like a freaking robot. I'm boring. Same formula over and over again. Enter, stop, first color change, add, profit take, repeat. Clearing elephant bar from a narrow state, enter the bar, stop above, add on the first color change, profit take, repeat, repeat, repeat. The 2 trading gifts. That's the elephant bars, the narrow state, and the narrow state. The elephant bars, which produce 70% follow through, they represent 65% of your trades. The narrow state, 85+% of your trades will ignite from a narrow state. Putting these 2 gifts together, you get a 92% follow through rate or success rate when you combine those 2 gifts. It is an unbeatable tactic that will reward you for the rest of your life. I have covered this in a variety of YouTube videos across the year, but I wanted to pull them out, put them together as one last presentation for you at the end of the year, and put it in a concise, neat little package for you. I believe I've done that. Let me explain this to you guys. This is very powerful. What's a market pause and what's a market turn? Do you know that there's a huge difference between a pause and a turn? And you have to be able to know the difference. How can you ever be successful if you don't know what a pause or a brief interrupt in the flow of a move is versus, is this a turn of direction entirely? Because there's similarities between the pause and the turn. And you've got to be able to know. So knowing the difference between pauses and turns, that is paramount. If you know how to determine what a pause is, then you automatically know what is likely to happen next after the pause. And now it's about, let's take advantage of what's going to happen next 8, 9 times out of every 10. Step number 1, guys, understanding the 3 different types of market moves. Now, before we get into the specific legs of a market, I have to define for you what is a move. There are 3 specific types of moves. These are the 3 types of bull market moves. The period of the bar doesn't really matter. So if you're a 5-minute chart trader, this is a 5-minute bar. If you're a 2-minute chart trader, this is a 2-minute bar. If you're a daily chart trader, this is a 1 full day bar. Time doesn't matter. Everything that I talk about is universal across all time periods, okay? The first type of bull market move is a violent, powerful, sudden, unmistakable surge to the upside in the form of 1 bar. Type number 2 is 2 powerful bars, not as elongated as type 1, but very powerful. Individual bars are powerful, but when you take them together, they're just as powerful as type 1. Now, type 3 is similar to type 2 in that it's not just 1 bar, but it's multiple bars. Now, it's not a specific number. Type 3 is not a specific number. Type 2 is. Type 2 is specifically 2 bars. If it's 5 strong bars, it's type 3. If it's 8 strong bars, it's type 3. Do you understand? Anything beyond 2 is type 3. But type 1 is 1 bar, type 2 is 2 bars. They're strict in terms of the number. And type 3 is any solid move where the vast majority of your bars are the same color and they're solid. It's not that you can't get a pause bar or a neutral bar in between. You just don't want a lot of them. So what makes a bull move is that it's fluid. What you see across all 3 of these types, guys, is a solidity in the color of the bar. Type 1 is a very solid green bar. Type 2 is 2 solid green bars. Type 3 is a barrage of solid green bars. Those green bars might be shorter, but they're still solid. There's nothing shaky about them. There's nothing unmistakable about them. There's nothing kind of wishy-washy about them. They're solid, powerful bars, the majority of the bars that make up type 3. Of course, this is the reverse. This is the 3 types of bear moves. So when I say look for a market move, you're looking for a market or a stock or a financial item that is producing either one of these 3 moves: a single powerful bar to the downside, a 2 bar power move to the downside, or a multiple bar move to the downside. The market can only produce a move in one of these 3 ways to the upside, and a market can only produce a move in one of 3 ways to the downside. This is building block number 1. It's very important that we understand this. There's only 3 moves the market can make. Now, step 2, there are 3 types of market pauses. Just like there are 3 moves, there are 3 types of pauses. And here's how they work. Remember, guys, the move up can be any one of these 3. 1 bar move up, 2 bar move up, or multiple bar move up. The first type of pause is usually a pullback, a retracement, a giving back of a portion of the move up. All right, that's pause number 1. Pause type number 2 is not a give back of price. It is a marking of time pause. You see, pause number 1 gave back price. That is a price-oriented pause. You're sacrificing gain to the upside to give the stock a chance to rest. The rest for the stock or the financial item is occurring because the stock is backtracking. In pause number 2, your stock or financial item is not giving back price. It's marking time. Type 3 is just a brief pause. It is not as elongated in time as type 1 or type 2. It's literally like a hiccup of a pause, almost as if your runner temporarily bumped into someone by mistake. That bumping into someone caused them to hiccup, hesitate, break their stride a little bit, boom, but they're off in the same stride relatively quickly. The bump into someone that was walking slow in front of them interrupted the flow a little bit, but didn't stop the movement, the subsequent movement to the upside. And so these are your 3 different types of pauses. Now, the market moved down. Now, remember, that market move down can be any of the 3 types of down moves. It can be 1 bar down, it can be 2 bars down, or it can be a barrage of bars down. Remember, move is one of the 3 types. All right, doesn't matter which one. So after a move down, a pause 1 is a give back of price, remember? So we retrace a portion of that downward move, a brief move to the upside. And pause number 2 does not give back price, but it marks time. And pause number 3 is very brief, a hiccup. Boom! Broke my stride a little bit, but not for long. Boom! Got my rest. Now I'm off and running to the races again. Boom! Had to jump over a little small wall, so had to back up. And now I'm off to the races again to the downside. These are your 3 types of pauses. Step 3, knowing the importance of the numbers 3 and 5. One of the most frequently asked questions I get on the technical side is, do I have a belief or faith or use in my trading Fibonacci concepts? All right, now, and the answer is yes and no. I believe in the efficacy of Fibonacci. I believe that it is a force in the universe that is very real. And remember when I told you that the markets are a microcosmic version of the universe of life. And so whatever is true for life or the universe has to be true for the market because it's a mirror image, albeit a smaller mirror image of the more cosmic universe or life. That is my philosophy. As above, so below, as below, so above. And so if we can find some measure of truth in Fibonacci in the universe and in the various sciences that are designed to basically study life in the universe, then of course it has to be true in the market. So yes, Fibonacci has been proven statistically and scientifically to be true in the universe, in life, in the world. We see Fibonacci increments and cycles in seashells and plants and planetary alignments and stars and da 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 da. I believe that there are many traders who take Fibonacci too far. They take it to the extreme. And just like anything else in life, you can take something so far that it starts to lose its importance. Now, what I'm about to explain to you is rooted in the concept of Fibonacci. There is something magical about the numbers 3 and 5 in the markets. What you're going to find and what I'm going to reveal to you is that markets will have a high tendency to turn around 3 or 5 cycles or somewhere in between. This number 3 and this number 5, and in the middle, which I obviously would say with 4, all right, 3, 4, 5, that zone is a very important market zone. In fact, I can say that that market zone 3 to 5 is responsible for my whole trading profitability. That everything I do is usually in between or at or in between those 3 numbers, those 2 numbers, 3 and 5. I'm doing something after 3. I'm doing something after 5. I'm doing something in between them. And I know that my timing is going to be better if I'm doing something around 3, 4, or 5, 3 to 5 in that zone. All right. And so what I'm about to explain to you is the basis of it is Fibonacci, because obviously we know that the number 3 and the number 5 are Fibonacci numbers. The number 1 and the number 2 are Fibonacci numbers as well. But 1 and 2 become important with different concepts. The concept that I'm explaining to you today has its importance rooted in the numbers 3 and 5. So just wanted to give you a little background behind these two numbers here. Let's get on with it, guys. Markets tend to turn, or have a tendency to turn, after it's done something 3 times in a row. And if it continues, it has an even more powerful tendency to change after it's done something 5 times in a row. So 3 is the first stop, 5 is the second stop. Let me show you what I'm talking about. Remember, I told you that there are 3 ways a market can pause. So check this out. Here's market move number 1. Here's pause number 1. This is one move, interrupted by a pause. Boom! Here's move number 2, interrupted by another pause. Remember these 2 pauses. And boom! Here's move 3 that is more likely now to have some type of change. Why? 3 legs have been achieved. And this is what we're talking about today. How to read the market's legs, the market's beautiful legs. All right. And if you traders can count to 3, you're going to be okay. And for you advanced types, if you can get all the way to counting to 5, you're even going to be better. All right. So many people ask me, Oliver, do you think that it's possible for anyone to really learn how to trade? And I says, well, can you count to 3? You say, well, yeah, of course. Well, then I think yes. But can you count to 5? Well, yes, of course I can. Then you're going to really be okay. All right. Because 3 would capture about, guys, 70%. 70% of your turns, your changes in trend, your changes in the nature of the stock, in the nature of the move, in the nature of the momentum, in the nature of whatever the stock is doing, 70% change after 3 legs. Let's look at 3 legs on the downside. All right, I'm going to do it with the red, right? So you got move 1, pause 1, move 2, pause 2. Remember the 3 types of pauses. Boom! Move 3. So do you see the 3 legs? You see the 3 legs? Beautiful 3 legs. The market's not a 2-leg animal. It's a 3-leg animal sometimes. Sometimes it produces a 4-leg animal. Sometimes it produces a 5-leg animal. But most of the animals that the market produces have 3 legs, 4 legs, or 5 legs. 3 legs up to 5 legs. Typically, 70% of the time, your turn's gonna happen in some way, or your change some way happens after the 3rd leg. So just knowing how to read legs and pauses and being able to count to 3 to 5 can have you playing this concept like a freaking pro. Do you understand? You can have one type of pause. Boom, pause, boom, pause, boom. So you got leg 1, leg 2, leg 3, and the pauses are identical. But you can have the pullback pause, boom, the sideways pause, boom, or you can have this, boom. And so each one of these are 3-leg moves. 1, 2, 3. 1, 2. Do you see it? Don't get tricked by that brief one. 3. And these are all 3-leg pause. Now, it's not
necessary for me to demonstrate for you a 4 pause or a 5 pause. It's just another pause after 3 and a continuation. It's just that I want you to understand that 70% of your changes come after the number 3. So only 30% come after the number 4 or 5. So understand that most things can't get past 3 legs. They can, but most things can't get past 3 legs. That's the most important thing I think you should understand here. Look at the relatively fluid move to the downside and look at, I know it's not perfect. In real life, it's not going to be perfect, guys, but this is the relative pause. Now, your pauses in real life, they're not always like a drawing, right? Not going to be like, oh, Oliver, that didn't happen at a right angle. That's not a pause. That happened a little slanted to the downside there. That doesn't count, Oliver. We can't be that specific freaking strict, right? Your pauses sometimes are going to be pauses like that with a slight upward bent. Sometimes the pause is going to be a little like that, slight tent, and sometimes it's going to be perfectly flat. We've got this drop basically and this pause of sorts here. All right. Now, leg 1. Fluid, unmistakable move number 2. Pause 3. Pause 2. Right? So we got leg 1 and 2, pause 1 and 2. Leg 3, and pause number 3. Now remember what I told you. 70% change in some form or another after how many legs? Let's see, boys and girls. 1, 2, 3. Is it possible for a 4th leg? Of course. Are the odds that we are at or near the bottom? Are the odds higher than not? Yes. Isn't 70% higher than not? Doesn't make another leg down impossible. All I'm explaining to you based on this concept is that we've got a 70% chance that this is the bottom. Being able to count to 3 to 5 and being able to read the legs and being able to determine whether something's a pause versus a turn is so paramount to proper market play. You've got to get this under your belt, and it has to become almost second nature for you. You should be able to look at a chart. Ultimately, you should be able to look at something and say, okay, it's on its 3rd leg. I've got distance far away. My 2 moving averages are wide apart. And I've got time. That's another concept we will cover. So I've got 3 legs down. I've got wide space from where the 20 is and the 200 is. And I've been going down over time. Wow. All of these things are lining up to say we're likely the bottom. Anyone who tells you, traders, that it is possible to be certain without any shadow of a doubt, do you understand? Anyone who tells you that is either being intellectually dishonest or they're an idiot. There's nothing in between that. You can't know something 100%. This is not a game of certainty. This is a game of probabilities. And this is one of the things that makes this art, if you will, for lack of a better term, this art we call trading, so difficult for people because the vast majority of people are out here in the markets searching for certainty, and it doesn't exist. They're searching for the Holy Grail, and it doesn't exist. They're searching for something that can give them absolute assurance. And they fail to understand that this is not a game of absolute assurances. that it doesn't matter how long you study, how long you read, how long you practice trading, you can't ever be certain. And many people have a problem with this. Yet they understand in regular life that nothing is certain. But somehow when it comes to the market, they can't understand it. Like, for instance, we don't ever really truly have certainty if it's going to rain 2 days from now. We might get a weather report that says it's going to rain, but we can't be certain. But we can come up with probabilities. All right? I'm in the midst of a freaking rainstorm right now that is projected to last for the next 6 days. So yeah, 2 days from now, it's high probability it's going to be raining. That is not certain, but it's pretty freaking high. We live our everyday lives with uncertainty. We live the life of playing probabilities. All right? It's everywhere in our lives, but somehow this level of understanding, this intuitive intelligence is lost when it comes to trading as if it's possible to know. You can't. And so we can't ever know if 3 legs down is the end, but we can know that it is highly likely. We can't know for sure if there's another leg after 2, but it's probable if certain things are in place. And so I always want to remind you of this, because I don't want you to take what I teach you and think that it is going to lead to absolute certainty. No, this is why you're going to have to become an expert at managing the scenarios that don't work out according to plan, so that those that work out according to plan can reward over and beyond you protecting yourself for the few that don't. As long as we can keep the few that don't work according to plan contained, we can let those that do work flourish in a far more marvelous, spectacular way than the ones that don't. Before I close, I want to show you another time frame. We looked at the daily chart of Bitcoin. We're going to look at the weekly chart of Bitcoin. And we're going to take the ultimate high price of 69. That's where Bitcoin topped out in November of 2021. It's a few months ago. All right. Now, let's take the bigger time frame and count the legs. 1, 2, 3. I don't know if you see it. 4. So we got 1, 2, 3, 4 on the weekly. Now, you might feel like, Oliver, I didn't see this pause and I didn't see this one. Here's something interesting. When I'm looking especially at macro phases, I like to see 5 bars create a pause, right? When I'm looking at a bigger time frame like this. So count the bars. Look, let me open this up a little bit so you can see it a little clearly. Count the bars. 1. What bars are part of the pause? 1. I know it started here, but this is part of the pause. This starts at 1, 2, 3, 4, 5. Pause. All right. Here, this starts the pause. 1, 2, 3, 4. It's way more than 5. Remember I said that they're not always perfectly sideways. All right. And 1. Well, let's do. I'm sorry. 1, 2, 3, 4. Boom. 5. 1, 2, 3, 4. Let's see. But I believe there's good odds that we've got it. Not that this means this is going to turn around and go immediately to all-time new highs or anything like that. I'm just saying that we're closer to the bottom than we are to the top of this thing. We're closer to the bottom than we are to the top of this life-changing thing right here. And remember, in one of my prior talks, I told you my bands were going to get it. Did I tell you? Did I tell you my bands? Oliver Velez's band. Did I tell you it was going to get it? Did I tell you? Do you see what's happening now? Remember that? Remember my friend? All right. These bands are catching again. Let's see. All right, guys. There you have it.
How to identify the market top. Now, this is the market top in all markets. We're talking about the market top in all markets and in all time frames. One of the major keys to market mastery is being able to identify when a market has topped. But not only when it is obvious that it has topped. One of the very great master keys or major keys to market mastery is being able to identify when a market is about to top. We're going to go over specific characteristics that are going to help you be able to know almost in advance when a market is likely to top. And I'm going to teach you how to nail it virtually every single time. The players that really do super well in the market, they know how to identify tops. They know how to sidestep them. And more importantly, they know how to turn market tops into fast, powerful profits. Profits are faster and they're bigger and they're harder for market tops. And this is why traders who have the ability to identify market tops, they tend to be the more profitable traders overall. The 4 characteristics of market tops. Number 1, a major market top is usually preceded by very dynamic 3 to 5 leg runs. Now, I'm going to show you what this means. In essence, a stock can run from a low point to a high point, but it will do so in segments. So it might run up, pause, run up again, drop a little bit, and then run up again. All of these are individual legs. Leg 1, pause, leg 2, pullback, leg 3. But this is an entire run to the upside. But every run to the upside is really comprised what I would call different legs or segments. And you have to be able to read the segments and know where you are in the dynamic run to the upside, because statistically speaking, runs that lead to major tops, they happen over a 3 to 5 leg run. And a trader who does not understand that tops come between 3 and 5 legs, they often get caught at the top buying leg 4 or buying into a leg 5. So if a stock runs up over several legs here and a trader's going to buy this leg when it is leg 1, leg 2, leg 3, leg 4, not knowing that there's a lot smaller upside from here than there is downside to go, because you're already buying into a very mature multi-leg run to the upside. The best odds for maximum profitability, guys, is when you are buying leg into a leg 1 or leg 2 move to the upside. You're riding leg 3, you ride leg 3, You start taking profits in leg 4 and leg 5. These are your profit legs. But if you don't know how to read a market's legs, how do you know where you are in that market's dynamic run-up? We buy legs 1 and 2. We ride leg 3. We take profits on legs 4 and 5. Look at my face here. 3 to 5 legs up. We buy leg 1s, we buy legs 2s. You got to know how to read what's leg 1, what's leg 2. You ride leg 3, relax. Don't tinker, don't touch leg 3. You take profits on leg 4, leg 5. Leg 4 and 5 are not entry legs. They're profit-taking legs. Characteristic number 2, near vertical acceleration toward the end. So if you've got this multi-leg run-up, 1, 2, 3. If this leg is the most vertical of all the other legs, here's leg 1, here's leg 2, here's leg 3, and leg 4 winds up being the most vertical, that's high odds that that's the final leg. If the most recent run-up after a pause, after a rest, because pauses and rests, they separate the legs, right? This one is the most vertical. That's the one that's going to be the top most of the time. The most vertical leg is mostly the top. I'm going to repeat that again. The most vertical leg of them all is usually the top one. You've got the top. So 3 to 5 leg run up, near vertical acceleration, that's usually your final leg. If I were to isolate the run-up in leg 4, this run-up is made up of multiple bars. So that fourth leg could look something like this. Boom, 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 and boom. So I'm saying that could be that leg right there. Oftentimes, the final bar of this multiple bar leg run-up is the biggest one of them all. When you've got that scenario, you've got vertical run-up, and the last bar of the vertical run-up is the biggest bar of the entire run-up. You've got your top, baby. You got your top. You're at or near it. We call this an exhaustion elephant bar. It's exhaustive in nature. The bulls are shooting all the bullets they have at the market, and they've just emptied the clip. They've emptied the gun. There's no more bullets left. There's no more buying power left. They put it all in that last bar. So that's the third characteristic. So remember, we got 3 to 5 legs up. You're likely near a top. If the last leg is near vertical acceleration, you're very likely near the top. And if the final bar of that near vertical acceleration is the biggest bar of that last leg, you're almost certain that you're at or near the top. And the last characteristic is what I call the 3-finger spread. I have spoken about this before, or what I call dual space. Here's what's important to understand with these 4 characteristics. You don't need them all. You can really just have one of them. Oftentimes, they are stacked. You may not get all 4. There are times you'll get all 4, but you may not get all 4. You only need one, but oftentimes, you'll get 2 or 3 of these stacked at the same time. I have rarely in my whole career seen a major top in any stock, any market, any index, it doesn't matter, that did not have at least 2 of these. I can probably count on one hand in 44 years. These 4 characteristics usually come in pairs. You usually get 2, sometimes 3, and every now and then you'll get all 4 of these, and you're like, whoa, all 4? You better watch out below. Here is the 3 to 5 leg plus vertical blow-off image. I'm showing you 2 of the 4. Remember, characteristic number 1 is the 3 to 5 legs. Now, legs are usually fluid runs that are interrupted by a pause of some type. Sometimes that pause can just be sideways movement, and boom, you're off to the next leg. Sometimes that pause can be a mild pullback, and then boom, you're off to the next leg. Sometimes that pause can be very brief, just in a little stutter.
a little flickering, which I demonstrate with a circle, and boom, you're off to another leg. There are separators. These are separators between legs. You see, this is a separator between legs. This pullback is a separator between legs. They're really pauses on the way to the upside. If you know how to read the pauses, then you automatically can see that there's leg one, pause, leg two, another pause, leg three, another brief pause, and you're into leg four. So you're already in the zone of 3 to 5, which is characteristic number 1. This means that you're in a mature up move. It's not fresh, it's not new. In addition to you being in the range of 3 to 5 legs to the upside, you've got the second quality, which is the last leg is the most vertical one. So this was a nice angle to the upside. 2 was a nice angle to the upside. 3 was a nice, but 4, I tried to show you, is more vertical. That increases the odds that you are at or near the top. If the last leg is more vertical than all the other legs, jump the odds that you're at or near the top in a very big way, right? So these are 2, the 3 to 5 leg run up plus vertical blow off move. The third characteristic is that out of this last run up, the most recent bar is the biggest bar of the entire run. So not only is leg 4 the most vertical, inside of that vertical run up, the most recent bar is the biggest one of all. Now, guys, when you get the last bar of the vertical last leg, if that's not only the biggest bar of the last leg, but it's the biggest bar that ever occurred during the whole run up, OMG. You're talking about the mega top of all mega tops. You've got the most vertical leg of them all. Inside of the vertical leg, you've got the last bar is the biggest bar of that leg, but you look and see it's not only the last biggest bar of that leg, it's the biggest bar of the whole freaking run up. Do you know how many traders are trapped and piled into that bar? And that creates a top heavy market. You understand? You understand what a top heavy market is? That most people are committed at the top, which means that they're vulnerable to a move to the downside and will start bailing ship at a heartbeat. It's powerful when you have this deeper reading ability, this deeper ability to almost see inside of the market and to know what's going on, to give you that refined feel with these characteristics. And I know when most traders are trapped at the top. These are the characteristics that let me know that. And I know they're susceptible to move to the downside now. It's taking your analytical skills to a very, very high level. There are not many people walking around in the markets today that have this ability to read like this. So we've got the 3 to 5 legs, characteristic number 1, characteristic number 2, all right? The last leg is the most vertical. That's characteristic number 2. Characteristic number 3, the last bar in that leg is the biggest bar. That's characteristic number 3. And characteristic number 4 is the 3-finger spread, or what I often call sometimes dual space. So what is this? This involves the 20-period moving average and the 200-period moving average of your item. Now, when your stock leaves the moving average in the dust, so when it starts to just skyrocket away from the nearest one of these two, you create what I call the 3-finger spread. Your stock is way above the 20-period moving average. Your 20-period moving average is separated and well above the 200, creating dual space between the 3 items. This space tells you there's a lot of room to fall. And guys, the reason why I call it the three-finger spread, because I tell traders, look, just spread these three fingers out as wide as possible. Your stock, your 20, your 200. When you've got that wide spread, that stock or whatever you're looking at is very vulnerable. It's on thin ice up there, and any crack will cause an avalanche of traders to just leave the stock, accelerating the move to the downside. Now, there's reasons why this makes the stock vulnerable. I want you to think about how many people are holding profits. Think about this, traders. Let's remember, you're not trading stocks, you're trading people. So stocks don't move unless people act. It's really the actions of the people that are moving the stock, right? So in essence, it's a psychological game. It's playing the mindset of your players. Now, if a stock has had 3, 4, 5 legs up, there's a lot of people holding profits. If you get way above those moving average, there's a lot of people who's got hefty, unrealized gains. That last big bar exploded their profitability. And now their profits are so fat, so big, that they want to protect them. So any amount of red freaks them out. Uh-oh, wait a minute. I'm getting out. I'm cutting half of my position. I'm doing that. And it causes an avalanche. Somebody yells, fire, in the theater, and all the traders start rushing to the exit sign, trying to get out of the theater before it completely burns up their profits. So when you can technically read this point where you know the stock is on thin ice now, it's very susceptible to profit taking. One little spook, one little scare, one solid red bar is going to send everybody from up here in Pluto with the three-finger spread. It's going to send everybody running for the exit signs. Tell me if you understand the psychological part of this picture and why it typically leads to violent drops to the downside. When you understand it from the people side, it's better. You don't have to understand it from, well, the company's products are not that good anymore. That's why it's going to go down. What? The PE ratio was too high. Isn't that why it's going to come down? No. If you read it from the people side, do you understand? Look at this 4-leg run-up and the violence of the last leg. They're holding huge profits here. They're going to be taking those profits soon, and any scare is going to send this stock reeling. That's the proper view, not the PE ratio, Oliver. It's crazy. Unreal. The PE ratio. How to survive chaotic pullbacks. I'm first teaching you how to identify high odds market tops before they actually drop. How do I know if from that top, this is just another pullback that will lead to a continuation, or is it the actual final one drop? What I'm taking you to the next step now, how to identify a pullback versus a collapse from a top. A collapse from a top is not a pullback. A pullback is buyable. A collapse from the top is not buyable. So you need to know the difference and how to read the difference. That's what we're going to go over next. Not only how to survive chaotic pullbacks, but I want you to know how to profit from them as well. In order to do this, I'm going to have to teach you my personal, basic, but very powerful trading division. And I use this concept, I call it 1/2 and thirds. So what I'm diagramming here is a strong run up in the stock. Now, that's not one bar. That's a multiple bar run to the upside in your stock or your underlying item, right? And I want you to note that, okay, it tops and it starts to pull back. Now, what you need to do is you need to divide the run up in half. So from start to finish, where did this run up start from? Started here. Where did it peak from? Temporarily, at least, it peaked there. Now, divide it in half. Just draw a line straight in the middle, just like I did here. You got to split that entire run up. Find the halfway mark. Guys, I don't want you going out to your local convenience store and getting rulers and, right angles and geometric tools. Oliver, is this halfway? Like it's a general thing. You don't have to be very, very precise. Just cut the thing in half. Like you would a banana. Boom. Okay, that's the halfway mark. You're not measuring it and trying to get it so perfect, okay? What we're also going to do is cut it in thirds. Now, what this is going to do is give this entire run-up 4 zones. Now, I'm going to show you the 4 zones. I know you see them, but the top third zone, you've got this next zone, you've got this next zone, and you've got the bottom zone. So coming on the way down, you got zone 1, you got zone 2, you got zone 3, and you've got zone 4. So you have to be able to know how to zone out your run-ups and your rundowns. Everything is applicable in reverse. But we're talking about the run-ups now. Here's the key. When your stock stays in the top third, you've got 80% odds of a new high. So we're dropping like this, you're dropping, but you turn, boom, without severely violating that top third. That's 80% odds you're going higher, and you're going higher by a decent amount, not just a peekaboo high. You're going to shoot way past that high. So let's get these odds straight. The pullback stays in the top third of the entire last run-up. You're going higher, buddy. Now, I call this a color change, right? Right? I've gone over this many times in my videos. This is a color change. Red, red, red. And then all of a sudden, boom, green reverses everything. Boom. Right there, that's your color change. We're looking for a color change in the top third to get that 80% odds we're going to new highs by a decent amount. If your color change happens in the top half, your odds drop to 65%, still good odds. But you go from 80% to 65% that you're going to move to a new high. Still better than flipping a coin. Still profitable. Guys, remember what 65% means. It means that 6.5 times out of every 10 you win, which means that in order to get 6.5, sometimes you get to a new high 9 times out of every 10. Sometimes you get to a new high 8 times out of every 10, 7 times, sometimes 4 times, sometimes 5 times, but it averages 6.5 times out of every 10. You're going to a new high as long as you get that color change. Remember what a color change is, guys. Red, 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 then green reverses the red. Boom. That's your color change. This is your color change. Green takes out red. So if you get this in the top half, you're dealing with 65% odds of a new high. If you get this in the top third, you're dealing with 80% odds that you're moving to a significant new high. How many people, guys, know these odds, know these stats? How many people have this so precise this way? Very few. Most people are out there guessing, rolling dice, rolling bones, calling up the psychic hotline, checking up on other losers in Facebook chat rooms and stuff like that. Not you. You're playing by the numbers. You're playing by specific, precise concepts and strategies. If your pullback falls to within the second, third zone, remember these zones, your odds drop to 35% of a new high. So now we're going into the other way. It's better not to bank on a new high if your pullback is this deep into the last run-up. See, this is your last run-up. This deep into the last run-up, the bounce is probably not going to make the new high. That's what the odds suggest. And if you drop to the last part, remember these 4 parts, right? Your odds are 15% that you bounce all the way back to a new high. That's almost saying it ain't happening, bro. Do you have these odds? Talk to me. I need somebody to talk to me. You have these odds. 80%, top third. 65%, pull back to the half, around halfway or less. 35%, you break the half. 15%, You break the bottom third. Tell me you've got this. Nice. I can feel your intelligence rising rapidly. I can feel it. I can feel it going higher and higher and higher. Your understanding. Wait till we look at examples here. Oof, it's coming. I'm going to show you. I told you I'm going to blow your mind with this. All right. The pullback versus the collapse. If you just get this down right now, what I'm about to cover for you, if you can just get this, this is going to take you to a different stratosphere. Just this one thing, because most trouble in the market, not knowing if this pullback is a buy or should I run for the hills. I'm telling you, like 70% of all problems, all lost money in investment world, in the swing trading world, in the day trading world, is not knowing how to read the difference. Not knowing whether this is a gift. This drop, is it a gift? Or should I be running for the hills? Or should I be betting the other way? If you can just get this, you're going to go to a completely different galaxy in your trading. Promise you. Probably the most important thing I'm going to explain to you here today. Let's go. Pullbacks versus collapses. The healthy pullback, the gift, the one that you should be thinking about buying. Here are the characteristics. Number one, first of all, I want you to know we're talking about after a nice, strong run up in your stock or your underlying item. Okay, nice, strong run up. Remember, you're supposed to always cut it in half and thirds. Don't forget that. Everything is going to come from you knowing the area of the half and thirds, knowing the four zones. Your pullback into these zones, if it is more of a drift, it's healthy. So look what I'm saying, a 45-degree angle drift. Now, the way I explain it to my trading kids is this. I draw a little mountain and I draw a little hang glider here. He wants to hang glide off this mountain into the meadow, but he wants to jump off the mountain and glide down the mountain. You see? Gracefully, smoothly. But you see, he doesn't want to trip and fall straight down. Your pullbacks that are healthy, they drift down the mountain. They don't starkly trip and fall straight down from the mountaintop. There's a difference between a drift and a trip or a collapse. Now, again, don't start telling me, but Oliver, it was 42 degrees. That's why I didn't buy it. Please. All right. Please. It's a guideline. As long as it's not straight up and down, you're good. But Oliver, it's 41.3 degrees. If this drift remains anywhere above the halfway mark, you're good. So what are you buying here or there? You're buying the color change. You're buying the first time a red bar gets taken out by a green bar. Boom, right there. There's your buy, right above the high. Boom. That's what you want to see here or there. But only if you have the 45 or so degree angle drift. The color changes don't count if it's a collapse. Now, the last thing I want to point out to you, there's usually no violent elongated bars in your drop, especially the first one. Let's say you have this run up and you get something like this. Boom. That is too violent of a first bar drop. Usually your color change here that might happen will fail. It'll trick you into it. Why? Because this is too violent. It's too powerful. It had too much velocity. I don't want to see that in a pullback. To me, that's a collapse. That's not gracefully coming off this mountaintop. So no violence to speak of, and no breaking the half, and 45-degree angle drift. no vertical drops. And that's when you know that this pullback is a gift. It is not a reason to be concerned. It is not a reason to run for the hills. It's not a reason to be nervous. It's a reason to add. The $64,000 question on Wall Street is always, is this the top? Does this pullback mean that we've topped, or is this a buying opportunity? That's it. Every financial show on CNBC, Bloomberg, it's the same question. Are we near the top? Have we topped out? Is this pullback just healthy? Is it normal? Is it a gift? Is it a buying opportunity? They have entire financial shows around this one question. And I'm giving you the keys to being an expert on those shows, being an expert in your play, how to identify collapses that you should be concerned about versus gifts that you should be trying to find more capital to put into the play. Now, the collapse, elongated vertical drop. This is not a hang glider gracefully coming off the mountaintop. Nope, that's tripping off the mountaintop. Something wrong happened there. He didn't gracefully come down. He tripped and fell. Even if, guys, you get the color change here, don't fall for it. Do not fall for it. Do not fall for it. The drop was too vertical. It was too elongated, too violent, too much sudden, powerful, abrupt momentum to the downside. What you must understand is that pullbacks are just pit stops. They are rests. Your athlete can't run without having some type of rest between races. Each leg is a race. And so it pulls back to rest, to get rejuvenated, refreshed. In NASCAR, they don't keep running around and never have a pit stop. They get a pit stop. It's for a couple of seconds, of course, but it's still a pit stop. It's still a rest. It's still a refresher. And then they're right back on the racetrack. These pit stops, these rests are healthy. They allow your stock to refuel and go higher. But there are some drops that are not rests. They're warning shots. They're signs you better get the heck out of Dodge. They're signs of dumping. They're signs of institutions leaving the stock right now. So understanding this difference and knowing how to play them both just takes you to a completely different level in your knowledge, in your level of sophistication, in your entire market play. Let's talk about my famous crash play. And I think after this, we start looking at some examples. It involves a violent bar crash, elongated, powerful, bigger than normal. What does that mean? I can't give you a specific number as terms of size. All I can just say is look to the left. And if this bar is bigger by orders of magnitude than all of your recent bars to the left of it, here are your recent bars to the left. Now, look at the size of this one versus the average size of these. That's a crash bar. So crash bars are elongated, powerful, violent. They have a velocity that is through the roof. These crash bars, they can come from a top. So you can get something like this. Let me show you. You can get something like this and boom. Now here's your crash bar. Boom, right? So you get a crash bar from the top. You can actually get a crash bar from a gap. So let's say your stock was trading here yesterday, and this morning, the stock, let's say it ended here yesterday, and the following morning, your stock opens here on a gap and crashes right into support, but it's still a crash bar. You can get a crash bar from the 200. So there are a variety of scenarios where this violent bar crash play can materialize, and they're all profitable, all of them. Some people will say, well, Oliver, if it crashes to the 200, isn't that in the buy area? No, not if it's a crash bar. The crash bar cracks the 200 significance. Sort of like this was ice, so the 200 was ice, right? Was a frozen lake. But this crashed so hard into the frozen lake that it cracked the ice. And now any bounce is a sucker's play. Boom!
Hi, traders. Colombian coffee, the best, the best. Listen, I have something that I want to speak to you about. Come with me. Traders, my traders, my Bitcoiners, my team has recently brought something to my attention that actually blew me away. My team told me, hey, Princesa. My team told me that a very small percentage of you who come to my YouTube channels every single day to watch my content are actually subscribed. That a very minute percentage of you who are dedicated enough to take in the content every single day, that a very small percentage of you actually have taken the step to subscribe. Now, I want to explain something to you. My team and I, we spend a great deal of time every single day, hours, making sure that you, each and every day, receive something of extraordinary value, something that, in my opinion, will raise your level of market sophistication and will increase the odds that you take an additional step every single day toward that ultimate goal of trading mastery, the thing that we are all striving for every single day. Now, subscribing to the channels is absolutely free to you. It costs you nothing. But at the same time, it's very valuable to us people, traders. It's valuable because it helps the algorithm help my powerful content and education get out there to more people who truly have a passion for this wonderful activity we call trading. And all you have to do is click subscribe. It would mean the world to me. It would also mean the world to me if you even went the extra mile by clicking the bell in the upper right-hand corner to ensure that you never miss a single piece of content. Do this for me, traders. Do this. It would mean the world for me. In the meantime, trade well, and I will see you in the next video. Boom, boom, boom. Ciao for now, traders. Love you to death.
So what do I mean? Remember I told you that there are legs to a run, right? So that's a leg. And if it starts doing this, remember what you're supposed to do with your leg. You're supposed to cut it in half and thirds. If your item has run up and it stays in the top third, remember what the odds are? 80% you're going higher. Remember that? That's one of the slides of the presentation. If you go down here, you're 65% going to a new high. Remember those odds. Bitcoin does a lot of one-thirding. It does halves too, but it does a lot of one-thirding in the bull run. So let me show you. Let's look at the one-thirds, all the one-thirds. This is just from April. So we run up and then it one-thirds on you, right? So that's leg one right there. Then you run up and you one-third. It just doesn't come back to the halfway mark often. And you run up again and you one-third it. It does a lot of one-thirding. So now it gets into this pretty predictable trading range here. Then right when it has this 20 MA halt play here, it starts one-thirding again. Run up, now it's one-thirding again. You see? And see how you can read the legs? What's the odds of a new high? Tell me, what's the odds that we go now into the 120s toward the 130s? So I wanted to show you the one-third concept. On Apple here, guys, take a look. Take a look at the left-hand side of the chart. I want you to grab the beginning of the move. I want you to grab the top of the move. Now, sometimes it's very subjective, guys. Reading the different legs, you know? It can be subjective. I get it. You get good at it, though. You get good at it. All right? So you're really concentrating more on either fluttering around doing nothing is a separator, pulling back is a separator, so that's a separator. Fluttering around in a sloppy way is a separator. Even a brief little 1 or 2 red bar thing here like that is a separator. It takes a while, but it starts to get clear what are separators. Boom, separator. Boom, separator. Boom. So you've got multiple legs here on the run up. 1, 2, 3, 4. You're mature. All right. We don't have the characteristic of the fourth leg being vertical. We don't have that. Remember, you don't need all of them, but we do have the 3 to 4 legs up. We've got the 3 fingers spread, and we have, boom. I'm taking that as a bar that's elongated and powerful enough to where if I were to split this in half in thirds, you see how it bounces up right there and then collapses again. Now, my traders know I would be shorting up here. But what I really want to also show you is I'm showing you how to do it with a bar, a single bar, where you take a single bar that's powerful and you split it in half and thirds. You know that the bounce is a sucker play. So the people who think that you're bouncing back from here and buying that, they get suckered in. But also, I want you to be able to do this on a full run. You see, that's a full run. Now, I want you to look at this like one move, and I want you to split this too, half and thirds, so that your macro sucker play can be played. So this is the micro sucker play. Drop, sucker play, drop. But this one is the macro. Drop, half, and thirds. Sucker play, drop. Do you understand the micro and the macro? Let me know if you understand. Micro is the one bar attempt to move up, and boom. That's the micro. The macro is the full move. Drop, you look at the full move as like it's one bar, then you split that in half and thirds so that the multiple bar sucker play bounce, boom, you know how to profit from that too. So my traders know to grab the micro and the macro one. I want to make sure you understand this. I just want to see your comments. Do you understand the difference between the macro and the micro? Let's continue. Let's continue looking at these examples here. So guys, where is... You got your micro bounce here into the collapse bar. You've got your macro bounce here. Remember, you're waiting for a color change. Red eliminates green, eliminates this green one right there. Look at this violent bar, half, thirds. You kind of come right up to the third sucker play. Boom! It's crazy. I do a lot of these crash plays, guys, a lot of them. Now, I want you to take a look at Tesla. A lot of my traders had this play. I want you to look at, this is the 25th, all right? This was the 24th. This is the start of the 25th. Now, I want you to look at the pullback here. Now, I told you that one of the keys to mastery is knowing, is the pullback in this play buyable? Is it a gift to add or initiate a play or get more, or is it a problematic drop? And I'm going to tell you that, remember the characteristics. If it's straight down like that, it's not. If it's a drift and it stays in the upper half, preferably the upper third, you're good. Now, some people say, well, Oliver, in this play, this drop, it's a 45-degree angle, but it's deep in the run-up. No, it's not, because I teach my traders, you must fill in the gap. When your stock gaps, I want you to fill in the gap and make that gap part of the move. You see, if the market were not closed, it would not have gapped, it would have traded there. So it's only gapping because the antiquated equity market is still closed. It's not 24 hours. So all of the built up demand over the night just gets immediately priced in at the open. But if the market was open, it would have traded there. So I want you to fill it in as if it's part of the move. Right from yesterday's close, fill it in as if it traded there. Now, take this whole move and split it in half and thirds. Voila! Color change, baby. But you got that? Fill in your gaps, guys. You got it? You got it? Fill in those gaps and then do your division. This is going to work like freaking magic for you. I promise you. The light with which you see everything now is going to be brighter with these concepts. You must keep coming back to this presentation as well so that you don't lose it. But I'm telling you guys, take you to a brand new galaxy. Now find the crash bar. What are you supposed to do with a crash bar? Divide it in half and thirds. Half and thirds. Now I want you to see the bounce. Look at the bounce, the next bar into the crash bar. So we bounce up because, guys, remember, this is not there. None of this is there yet. So what's happening here, guys, is that you've got the first bar as a crash bar. Now the next bar is moving up into my zones. So I got zone, the first zone is achieved, the second zone is achieved. Now I'm shorting there. I'm more advanced, so I'm just going to short in those zones. I'm not waiting for anything. So I'm short. I'm coming in here. Boom. Boom. I'm shorting because what's the odds of it going all the way? 15%. I'm going to be right shorting in those zones 85% of the time. I'll have some stop outs every now and then, but not very often. Now, what you can do is you're supposed to wait for the green to disappear and then strike. So when does green disappear? It disappears now. Watch. Boom. Uh-oh. Most of the green is gone. Boom. All of the green is gone. Wait, I did the wrong thing here. All of the green is gone right there. I don't know if you can see that. It was green first, but right here, I'm going to draw this line here. This was green. We were green first. Green, and then the green disappeared. Boom. A lot of my traders strike right there. Bam. My green disappeared. Stop above the high. And the freaking rest is history. For me, this was like a $9,000 play. So crash play, bounce, drop. Some traders did another color. Some traders of mine did another color change here. Some of my traders said, well, Oliver, this is a crash bar too. We got two back-to-back crash bars. And look at the bounce, sucker bounce, and boom, back-to-back crash bars. Powerful. How do you know that this is likely the bottom? Oh, that should be simple. Your multiple legs down. I know this is from yesterday. 1, 2, 3, 3-finger spread. The move did start the day before. 1, 2, 3. Remember, it's 3 to 5 legs. So we've got 2 of the 4 criteria telling us this is likely the bottom, at least for now. Remember, it works the other way as well. Same thing, guys. Remember what I told you what to do with the gap. Fill the gap in, guys. Always fill your gaps in. All right? Fill them in as if it didn't gap there, that it traded there. Fill the gap in. That's your full move. I want you to look at the pauses. And guys, even this is a pause. It's a hidden pause. My traders know this is a hidden pause because you fell back so hard, that's still considered red. So it doesn't matter if you got that or not, but all you know is that there are multiple legs up, right? You got multiple legs up to the upside. 3 to 5 legs up with your separators. Do you have the 3-finger spread? Yes. Look at all that space between the 3 items. Tippy top of your stop, 2,200. 3-finger spread, the wide apart. That's why I call it a 3-finger spread. What are you supposed to do when you have a full move and it starts to drop? What do? Go all the way, fill in the gap. You split it in half and thirds. If you try to profit on the downside on the first color change here, that's fine. But remember how many levels I told you to go for? Go for 2 levels. So level 1, level 2 inside of this. You understand? That's how we come up with targets. We go for level 1 and level 2. We don't count the top one. The top one is the entry level. And then you go for 1 level down, 2 levels down. And this trading by the numbers this way, guys, really makes your approach very systematic, far more precise. But if you wanted to short here, remember, you're shorting on from this 3-finger spread point. If you want to short, we don't get a violent bar up here, but we do get a color change where you can give it a shot. When does red truly take out a green bar and right in this area? Anywhere there is fine. Anywhere here is fine. 2 levels down. Boom, boom. Don't forget to do your trading division on everything, guys. Everything big, do the trading division. Look at Palantir on the 25th. Now look at the gap. See the gap? What are you supposed to do with that? Fill it in. Fill in your gaps, guys. Let's act like they really traded there. Now, look at that big giant run up. Split it in half, in thirds, and voila. Boom! 80% chance of a new high. The pullback stayed basically in the top third. This is going to have you seeing so many things much clearer. My traders know this is a clearing collapse play, right? So what is clearing? Let's say your stock is doing this. It's kind of in this range here. And then all of a sudden, a red bar just clears everything. Boom! It just breaks through everything. That's clearing. I want you to take a look at this. Look at the clearing. You see it? Then boom! Solid red just clears everything to the downside. Sucker bounce. You do get to the top third, but a sucker bounce here. You get the sucker bounce into the collapse. Color change right here. Boom! And traders can just keep doing the color changes if they're near something. Color change here. Boom! Color change. Boom! It just keeps going and going and going. This crash play and the sucker bounce is a huge moneymaker for us. All right, Coinbase. Remember I told you can crash into support too. Look at your support from the day before. But you gap and you crap out and collapse right into support. And you get that miniature sucker play bounce right here. Bounce, that's the micro version. And you drop to new lows. Now, these don't look like big drops, but these are big drops. That's like $5 drop right there. Even on a macro level, remember I told you, take your full moves down and also do your division. So here's the full move down. I'm drawing sloppy here, but you get the point. And even it couldn't even break any decent amount to the upside after a collapse like that. You have to remember, guys, there are people who bought here not knowing how to trade and play. And these people are left holding the bag and they're not happy. They're sad. And like they're stuck up here, sad. So they're instantly a loser. So any bounce, they're like, I got part of my profits back. And they just sell into the bounce to get at least some of their profits back. Boom. And that's why these crash plays work. You're getting a lot of pressure from people that are hurt from above. And the bounce is a gift for them to just get out. So they're applying a lot of get out pressure on the stock. That's why there's 15% odds of coming back. It's all about trading people, guys. All about trading people. This is another play, guys. I'll be honest with you. I got a tiny bit nervous with this one. I think this is the last one to show you. I got a tiny bit nervous with this, guys. Just a tiny bit. Because remember, when I get these hard drops like this, I split in half and thirds, and I'm already going to be shorting in these zones. Now, you're going to wait for the color change, but I don't wait for the color change. So this bounces and I start getting short more, and my stop is here. So I'm like, but now my orders are there in advance. I start to say like, wow, this is a strong bounce. It's trying to get into that upper portion. Then the collapse came. Love that sound. And then we took this color change. My traders can tell you. So this was more like the macro one. Drop, boom, profits. Then bounce. This is a sucker play too. Why is this a sucker play? Because remember, guys, don't forget the macro move down is the whole thing. And when you know how to divide, this is sucker two. Boom! This is the closest thing to kind of taking candy from a baby, guys, in the market. The bounces into crash drops. It's powerful. It's consistent. It's freaking highly profitable. Look at the crash play in Hood. You gapped. You crashed into support. Now look at that 200 there. It tried to hold on, but the crash was so strong that the 200 is weakened. But look, more importantly, is look at the sucker bounce into the crash. You see the sucker bounce? And the rest is history. It took a while, though. That 200 tried to hold on and eventually gave through because the ice was cracked by this. The ice was cracked. And each subsequent tap on the 200 just weakened it more. Boom! It just finally gave through. The ice finally gave through. And it all started from this sledgehammer coming into the ice. All right, guys, I told you we don't trade Bitcoin, but if I did, I would use the hourly chart. And you see all the concepts here. Leg up, stay in the top third, we're going higher. Leg up, stay in the top third, we're going higher. Leg up, stay in the top third, we're going higher. You see? Boom. 1, 2, 3, 4. You're pretty wide here. You need to rest. But now look, the macro move as well needs to be split. And we stay in the top third. Do the macro rest. We're going higher. Now we get the full 3-finger spread. And that's when you have to sell off. You didn't really quite get it here as dramatic as you would like. That's still more like parallel railroad tracks. But when you start to go vertical, you see, you started to go vertical here and into a 3-finger spread. You just got to come down and rest. You have to. And that's exactly what happened. That these 3 concepts I shared with you today, they're going to pay dividends to you forever. They don't stop working. They're going to pay dividends forever for the rest of your living days as a market player. I have been using these for 3+ decades. They are just as reliable today as back in the 1990s, as back in the early 2000s. You don't have to be overly complex to really play the market successfully. In fact, the simpler your approach, the more powerful it is. Complexity weakens the power. I shared nothing that a 12-year-old can't identify and know. Anyone can do this. I know there's a high failure rate, but it's a high failure rate because of lack of knowledge, lack of understanding, lack of guidance, lack of the proper mentorship. I want to be that for you. And also lack of the proper amount of money. That's a big one. And so I try to help traders know the right thing. I try to transfer all of my knowledge to the traders and also give them the proper amount of capital to do it with and give them the constant day-to-day training every single day and have them grow every single day in knowledge, awareness, understanding, and have the right amount of capital at their disposal to take advantage of them so they're not risking their own family's money. No one on Wall Street does that. No one who gets hired out of school to go work for Goldman Sachs or JP Morgan or whatever on the trading desk, they're not trading their family's money. And this is a huge advantage they have. They're also under guidance. No one's saying, oh, here's $50 million. Go knock yourself out. They've got guidance. They've got a head trader overlooking them. They're being taught. They're not trading their own capital. Do you realize that you are better when it's not your money? Everyone is better when it's not their capital because you're held to a higher standard. You're more stupid with your money. You're more careless with your money. But if you know I'm watching, if you know Goldman Sachs is watching your performance, you're going to be on point. This is why billionaires form hedge funds, because they need the money? No, because they're even held to a higher standard. These billionaire hedge fund managers are held to a higher standard because other people's money is mixed in with their money. They're better. It's one of the secrets on Wall Street, guys.
25% of the way back up. Look what happens. Boom! So look, if you go after 25% of the way back up, you're right 9 times out of every 10 tries. Now you're super profitable as a trader. So where do you think a scalper wants to live his life? To grab a quick pop in the markets, you're going after 25% of, this is 100% all the way back up. So if your stop had the ability to come all the way back up, that's 1 time out of 10, or 2 times out of 10, or halfway, 6 times out of 10, but 25%, you're going to get that 9 times out of 10 tries. And we utilize this tactic all day long, every single day. 50%, 25%, 50%, 25%. And I want you to do that as well. Welcome to another presentation. Of course, as mentioned, my name is Oliver Velez. What I'd like to share with you today is a very interesting topic. It's the topic of scalping. Now, the definition of scalping has basically changed over the years. What scalping used to be, very much in vogue back in the early 1990s and mid-90s, is completely different from what I'm going to call scalping today. And I'll explain this as we develop more throughout the presentation. But scalping is a form of short-term trading. So listen, there are several forms of trading, right? There's investing, or what I call wealth trading. Wealth trading and investing, same thing, wealth trading. Then there's core trading. That's not quite as long as investing, not quite as long as wealth trading. Core trading, several months down the line, okay? Then there's what I would call swing trading. Swing trading is a style of trading that I helped coin in the early 1990s, right? So the term swing trading came from an interview of mine back in the early 1990s, and it caught on, and people began to call this shorter term style of market play swing trading, okay? Then there's day trading. Now, day trading or short-term oriented micro trading is really divided into 2 parts, right? So the 2 parts of day trading is actually day trading, and then scalping is a subset of day trading. So scalping is very, very micro. If day trading is micro, scalping is the little brother of day trading. It's even smaller than the day trading space. And that's what I want to talk to you about today, because a lot of traders, professional traders, actually make their living in the scalping world. And there's a tremendous number of professional traders, guys, a tremendous number, not a tremendous number of people in the industry that don't understand the differences between a trade and a scalp, or a day trade and the scalp. And you're going to know the difference and how to do each one by the end of this presentation, okay? All right, guys, let's talk about the tools we need to do scalping properly, okay? Let's talk about this. First thing we need a 2-minute chart. Yes, a 2-minute chart. You can alternatively use a 5-minute chart, but I prefer that you use a 2-minute chart for this, okay? 2-minute, 5-minute, your choice, but I lean more a little bit toward the 2-minute chart. Let's take a look at a 2-minute chart. This is Microsoft's 2-minute history, looks like for up until midday. So this is a 2-minute chart of Microsoft where every single bar represents 2 minutes of trading. Obviously, the red bars represent the 2-minute periods that were down, all right? So it started higher, ended lower. And the green bars represent 2-minute periods where the stock started lower, ended higher. Simple. The next thing we need to overlay a 20-period simple moving average. Now, I have been
trading for a very long time, studying markets for a very long time. And I will tell you that I've experimented with all types of moving averages. And in my experience, the sexier varieties of moving averages have no real distinct advantage over the simple. Now, if you want to go to, the 20 period exponential, the 20 period weighted, knock yourself out. It's not that different anyway, right? Moving averages are areas. They're not specific little skinny lines as your trading platforms would have you believe. But I use simple, and I use those simple moving averages on the closing prices of the bars. Okay. Here's a 2-minute chart of BABA. I am overlaying a 20 period moving average on the chart. This is averaging the last 20 closing bars. So now, guys, just so you know, and I know many of you know this, what a moving average does is help you to iron out the wrinkles in a stock's trend. So in the old days, they actually used to call moving averages trend lines because their purpose is to really keep you focused on the prevailing trend. So if that 20 period moving average is declining, it doesn't matter if there's a green bar or two in the midst of the stock's performance, the trend overall is down. It doesn't matter if there's a green bar here. See these green bars? The overall trend of the moving average keeps you honest in your overall assessment. I don't care if there's green, that trend is down. The green is not going to affect me. The green is not going to trick me. As long as that 20 period moving average is down, I'm thinking down. I'm thinking negative. You understand? So that's the purpose of a 20 period moving average. Here's the 20 period moving average started to rise, right? So it says, I don't care right now if there's some red here. The overall prevailing trend is up. So that's the overall purpose of moving averages, to keep you honest in your assessment of what the overall prevailing trend is. Is it a perfect indicator? No, there's no such thing as a perfect indicator. But as a general guide to trend analysis, you can't beat moving averages. And the 20 period moving average, in my opinion, is amongst the most important. There are two really key moving averages. The next thing we need to overlay a 200 period simple moving average. So whenever you're using moving averages, guys, you want to always have a short one and a long one. You should never really look at just a one moving average chart. You need a longer term view, the 200, and you need a shorter term view, the 20 period moving average. And that's what we have here. Moving averages are best utilized in the form of a buddy system. You understand? A buddy system. So short, long, 20, 200, or 13, 200, or 8, 200. We use a variety of them, but 20 and 200 are the basic two. And I would go as far as saying you don't really have a viable chart that you're looking at unless you have these two moving averages on the chart. So let's take a look at the 20 period moving average on BABA overlaid. So now we have a 2-minute chart, each bar representing 2 minutes of trading. And you've got a 20 period moving average overlaid, and you've got a 200 period moving average overlaid. And these two moving averages are operating in a buddy-like system. So whenever your stock, your 20, and your 200 are spaced apart, you are looking for a reversal. Okay? And this can happen on the downside as well. You can have the stock way down here, separated from the 20, separated from the 200, and you'd be looking for a reversal back to the upside. But notice how BABA opens separated from its 20, and the 20 itself is separated from the 200, leaving behind what we call a dual space reversal event. My traders would be taught to actually go bet to the downside on a play like this, but they would first have to see green get eliminated by red. And so here's the last green bar. Red eliminates green. They would short here, betting on the downside, stop above the green, protect themselves above the green, and benefit all the way back to the 20 period moving average, where now the stock, guys, is closing the gap between itself and the 20 period moving average. Gap close, done, trade over.
But that's actually a different topic. We're going to talk about scalping. We got a 2-minute chart. We got a 20-period moving average on the 2-minute chart. We got a 200-period moving average on that chart. Now we need a strong move. What do I mean by a strong move? I have to demonstrate this for you. Let's do it red. So a strong move down. Boom! In this strong move, guys, if you're going to play against this strong move, what do I mean by play against this strong move? What I mean is that if you're going to look to buy somewhere after this decline, if you're looking to buy, your odds are not very great because of the power of the down move to the left. So think about this, guys. Think about this. This move to the downside is very powerful. All right, this move to the downside is powerful. So it means that any up move that you make, right, any up move after this is going to have to fight what's to the left of it, which is red. All right. So now some moves will actually make it all the way back to the beginning of the drop, the decline. But how many out of 10 tries will the bounce after a strong drop? How many times will a move come all the way back? I'm going to tell you, 1 time out of 10 will go all the way back to the top of the move. This is very important to understand. And then we're going to go to charts so I can show you this, right? So strong drop, rally all the way back, recuperating the decline 100%, 1 out of 10. Let's say 75. Let's do this. 75. So this is the 100% level, right? 75% instead of 100%. How many? 2 out of 10. Let's do it like this. So 100% all the way back, you're going to get 1 out of 10. All right? 1 out of 10. So 1 out of 10 goes 100%. 75%, 2 out of 10. Now check this out. Something interesting happens here at 50%. Now your numbers go big. At 50%, your numbers go 6 out of 10. Wow. So 6 times out of every 10 tries, the bounce back up after a decline will retrace 50% of the decline. So now you're a profitable trader if you control your downside, just going for 50%. Wow. You're not a profitable trader going for 75% of the way back up. You're not a profitable trader going 100% of the way back up. You're a profitable trader if you control the downside. You're a profitable trader at 50%, only going for 50% retracement. A stop drops, buy it, 50% back up, out. 6 times out of every 10. But check this out. This is the most interesting. This is the most interesting, traders, right? So now let's go to 33%. No, let's go to 25%. Now, 25%, right? 25% of the way back up. Look what happens. Oh! So look, if you go after 25% of the way back up, you're right 9 times out of every 10 tries. Now you're super profitable as a trader. So where do you think a scalper wants to live his life? Where do you think he wants to dedicate himself to? 100%? Going after the 1 out of 10? Going after the 75%? Going after 50? No. He lives in that 25% move back up. 25% move back up. 25% move back up. 25% move back up. Boom, 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 boom. 9 times out of every 10, you're going to get that 25% move back up. And so that's what scalping is. It is sacrificing, right, the possibility of a 100%, which is going to come every now and then if you're lucky, living in that world where I get the time 10. I just got to control that one time that it doesn't work. 9 times out of every 10, 9 times out of 10. This is scalping. Same thing on the downside, same concept on the downside. But let's go to charts now. My trading platform here, right? So what I need to do, guys, I need to put, I told you, I need to put the 20 period. We're going to put a 20 period simple moving average on there. I'm going to make that blue. Let's make that blue. Do it right in front of your faces. All right. 20 period moving average on Microsoft right there, right? Then I'm going to put the 200 period moving average on there. Let's do that. It's not really relevant to us today, but let's just do it anyway. All right, I'm gonna do that. I'm gonna put that 200 on there. Keep that red. Boom. Okay, good. Now, look, I want you to know, remember what I told you, right, about space? That was a different talk that I did on my concept with space, but I just want to bring your attention to that real fast, right? Like, look at Microsoft opens, where it opens in relationship to the 20 and how 20 is separated from the 200. So you see those layers of space, right? That space, dual layers of space, space 1 and space 2. And whenever we get these dual layers of space, we bet the other way because the market doesn't like space. It narrows space. So now, see, there's no space. So once there's no, we started off with space. Now we go to no space. Look at all 3 items. Look at your stock, look at your 20 period moving average, and look at your 200. There's 0 space now. Now we go back the other way, but that's a different topic. We're talking about scalping now. I want you to take a look at this drop. This is one fluid drop. It's interrupted by a certain number of green bars, but the fluid move to the downside is down. If you want to try to buy the bottom of that, you can't expect more. If you want high accuracy, you can't expect more than, remember those levels, right? 25% if you want your accuracy. So scalping is a counter trend approach. To grab a quick pop in the markets, you're going after 25% of, this is 100% all the way back up. So if your stop had the ability to come all the way back up, that's 1 time out of 10, or 2 times out of 10, or halfway, 6 times out of 10, but 25%, you're going to get that 9 times out of 10 tries. And so the scalper goes against that flow, but just for 25% out, and can literally make his entire living on a scalp. All scalpers do is look for a drop, all right? A sharp drop, boom. So boom, look at the bounce, you see? Not all the way up here. You're not gonna get that. That's the sucker's play. Bounce, drop back. Now, look, drop, bounce, 25%. Look at this. Look at the next one. Look at the next one. Let me show you. All right. Drop. Here's one fluid drop. Bounce. There's your 25%. You're not getting 100%. You're not getting 75%. You're not getting half. Boom. Now, here's something really interesting. When you get a drop that goes way past the 50% level, now this is way past, not 100, but it gets really high past 50%. The next drop usually will not be a new low down here. This drop will turn, and that's when you trade. You don't scalp this bottom here. You see, the scalp play, if you want, is there. The trade is here, where you want to hold on to that one longer than the scalp. This is going to go further than 25%. This is going to likely go bigger than 50% of the way back up. You understand? So let me demonstrate this again. This is important to understand. Drop 25%, new low. But drop 65, 70%, no new low. And this becomes a trade, not a scalp. Okay? Very different. You got to know what's a trade and you got to know what's a scalp opportunity. And knowing the difference between these plays does increase your accuracy, guys. Does increase your accuracy. So look, we drop, boom. That does not get past that 50% level of this drop, right? It doesn't. So we're going to new lows. Now look, drop. Here's now an up movement, up movement, up movement. That up movement does not get past 50%. We're going to new lows. But wait a minute. Check out this last one. Check out this last one. Look at this drop. Now, take this drop, split it in half. It goes way past the 50% level. You see? We break through the 50% level, right? Now, this drop does not make a new low. Now, we want to think about a trade, all right? We want to buy green when it takes out red. We want to buy green when red. We want to buy green. Boom! Very different. So here's a scenario, guys. Here's a scenario that I need you to understand. When you have declines, right, you got to watch how they bounce, right? Because if they bounce marginally, that's a new low scenario. But if your drop bounces way past 50%, this down here becomes a potential buy opportunity for a trade. Now, this is your scalp trade for a quick 25% if you want to try that. Or this becomes your real longer term trade, intraday, longer than a scalp, more than 25%, when your rallies break significantly past that 50% level. And so you need to keep these percentages in mind. I can show you this on another chart. Check this out. Let's go to, I don't know, Baba. You've got separation, separation, separation. We're betting this way. But check this out, guys. This is amazing. We drop. Look at the bounce. This is the halfway mark, right? Here's your halfway mark. Here's your 25% mark. Boom, new lows. Now check this out, though. This is interesting. Now, let's take this drop. Now, let's split that in half. You go past the 50% level, so now there's no new low. This green taking out red can be a quick buy, if you like. So I just want you to be able to understand the probabilities are very important, traders. After a drop, all right, if it's a sharp drop, there can be a buy opportunity there, but you can't expect more than 25% if you want to be consistent and accurate. If that bounce is less than 50%, odds are huge that the next decline goes to a new low. If that rally goes further than 50% by a lot, then that pullback sets up a nice trading opportunity for you. And we utilize this tactic all day long, every single day. 50%, 25%, 50%, 25%. And I want you to do that as well.
Are you ready for what the trifecta is? Are you ready for this? I don't even think you're ready. It's 3 of them. It's 3. Oh, it's not one surge off the 200. No. It's not one, which is powerful enough, up to 92% accuracy rate. Oh, no. The trifecta is not 2 surges off the 200. Oh, no. Trifecta insinuates 3. It's 3 freaking surges off the 200 simultaneously. A surge off the 200 on the 2-minute time frame. At the same time, it's a surge off the 200 on the 5-minute time frame. At the same time, it's a surge off the 200 on the 15-minute time frame. That is the creme de la creme. That is the trifecta. That's the closest thing you're going to get to guaranteed money in this game. The trifecta. Beautiful, beautiful, beautiful thing. All right, let's get back. Let me show you this. Smoke on this. This is crazy, guys. This is crazy. This is my personal platform setup, guys. I trade on a laptop. Believe it or not, it is something that I am always strongly encouraging my professional traders to do, to get used to trading on a laptop. Because as I mentioned in one of my last live sessions, the last thing I want you to do is to turn the best activity on earth that is designed to make you independent financially and free from a time perspective is trading. This is the last bastion of total independence, trading. You can't be independent as a doctor or a lawyer or a major corporate CEO. They don't have control of their time. They're slaves. A doctor is slave to his clients. It's 2 a.m. in the morning. What do you want? Doctor, you have to come to the hospital. That's freedom? That's freedom? That's not freedom. Lawyers are bossed around by their high-paying clients all the time, and they work around the freaking clock. I don't care how much they make per hour in their legal careers, they're still slaves to their high-paying clients. No matter what activity you do, you're ultimately a slave to someone. Trading is one of the only things on earth that gives you the ability to be free of any other man. Do you understand? If you are a man, women too, but more specifically a man, it would be a much higher life if you ever got yourself to a place where you don't answer to another man on planet Earth. And you taught your sons, I don't answer to other men. I am the backup. I am the ultimate man in my life. No other man pays me. I pay myself. This trading can deliver for you. No, entrepreneurship cannot, because you can open up a restaurant and it can be successful, but you're freaking chained in that restaurant with a big giant ball and chain to the same place every single day. That's freaking boring to me. I mean, we need restaurateurs, trust me, and I respect them. I love them, but I don't want to do it. I want you to be independently free. You are not, even as a trader, you are not free if you've got 18 freaking monitors. You've just created another ball and chain. And I can't believe that there are so-called professional traders out there bragging about their 18 monitor setup as they sit there and get radiation poisoning. That's freaking ridiculous to me. That's like going backwards in time in the 1980s when we had multiple monitors we were looking at. This is going backwards. You should be getting accustomed to trading from a laptop so that you are in business from everywhere on earth, every four corners of planet Earth, with a laptop computer and an internet connection, and you can pull out your living without the help of a team, without the help of another man, without the help of another freaking human being. That is freedom. Trading offers the last bastion of that high level of freedom. Some of you got yourself used to so used to trading on big giant monitors, you can't possibly imagine being free today. That you like your little ball and chain attached to the same place every day so that you are out of commission if you're not in that specific location. That's like a 9-to-5 job as far as I'm concerned. But some of you love that. Look at my 18 monitor screen setup and look at my ball and chain. I even painted the ball and chain. I paint the ball and chain my favorite color. You got Post-it stickers and little photos and drawings on the edges of your 18 monitors. You make your little prison cell nice and beautiful. Oliver, look at how beautiful the walls of my prison are. Look at my ball and chain. Do you like that color? No, laptop professional. When I show up for trading, people see my laptop and say, Oliver, for real, like seriously? All of that money you make comes from that thing, that little thing right there? And let me just say this. I know I'm beating a dead horse here, and I know I'm pounding the table too hard on this, but I'm passionate about it because I went into this to be free, not to be a desk jockey again, to be behind a single desk all day. No, not doing that. Let me just end this rant with this. If you can't make money consistently with one screen, you ain't gonna make it with 2 or 3 or 4 or 18. In fact, if you can't make money with one screen, you're just gonna lose money faster with 2 screens. Let the one screen be your litmus test. No, Oliver, I need 18 screens. Bull. We're bombarded by too much information in our lives already. You don't need 18 screens. You need one. And if you can't make money with one, you're not making money with 10 or 18 or 4 or even 2. Yeah, Oliver, but laptop computers run out of battery. Are you serious? Seriously? That's it? That's the reason for not doing it? My laptop is low on battery. That's it? Like you don't have a freaking plug? A battery? There's no walls in your worlds with electricity, no? Come on, no excuses. Oliver, my laptop is low on battery. This is my laptop screen. This is what I trade off of every single day. Let me just show you the parts, guys, because this is important. Let me show you the parts. So let's look at the left-hand side of the platform screen. My platform setup is predominantly chart-based. So I want you to look. We're looking at Google. This is a 2-minute chart of Google. So this is my 2-minute chart. This is the 5-minute chart of Google, right? And you can't see it there so much, but this is the 5-minute. I have them side by side. This side-by-side nature is important to me. My 2-minute and my 5-minute are my battle time frames. They're the time frames that I place the majority of my trades on. I place like 80% of my trades based off of what I identify on the 2-minute. 80% of my trades come from the 2-minute. The other 20% come from what I identify on the 5-minute. These are my 2 battle time frames. These are my 2 advisors. So my 2 advisory time frames are the 15-minute. They advise me on what I see on the 2 and the 5. And here's the daily. It advises me. This is my longer term lookout. This is my medium term lookout. So they're like kind of snipers looking out. One has a high-powered, the daily has a high-powered scope to see very far. The 15-minute has a closer scope but sees far. And I've got my battle time frames to see what's really near. Now, I place trades based on the 2-minute and or the 5-minute, but I take advice from the 15 and the daily. This is a very important distinction, all right? Not the session to go do it in a deep dive with that, but as a general point of view, this is how I want my chart structured. On top are my battle time frames, my trading time frames. Right underneath them, my advisors. Okay? I don't trade off of the 15 and the daily. I take advice from them. We'll get into that in just a moment. Now, on the right-hand side, you see an independent chart here. This is Amazon. So this section is is an independent. These are all connected together in one thing. So when I change a symbol to Google, the symbol changes all 4 of these simultaneously. So if I type a symbol in Google, it's going to change the chart to 2-minute Google, 5-minute Google, 15-minute Google, daily Google simultaneously. So these 4 are linked together. This has no link. Do you understand? It is independent. So sometimes when I'm taking a trade here, I still want to watch something develop here. I'm watching this, but I'm trading this one. I'm trading Google, but I'm watching Amazon develop too. So this is sort of like my watch chart. So watch chart, 2-minute trading, 5-minute trading, 15-minute advisor and daily advisor, and my watch, just in case I have a stock that's developing, a play that might be developing that I'm watching, or even a play that I'm already in, watching it while I am doing action with this one. Okay, this is the chart part of this. Now, the other part of this is, you can see this is my activity today. I did trade Google today. I don't know if you can see that. It might be too small. I made like $3,800 on the trade, but I made that in a few minutes, guys. That's a few minutes of trading. 3,800 done, finish. So here's where my open and closed positions are. This is my level 2 execution module. Here's my time and sales. And on the right-hand side here, you see my watch list of stocks. So I'll take a look at some of these as I'm looking for specific plays and setups. Okay? If I click any one of these, all right, so let's say, for instance, guys, I click Microsoft in my watch list, all 4 of these change to Microsoft because they're linked. So everything is linked. If I click on Google here, all 4 of these, anything I click on affects these 4 windows: the 2, the 5, the 15-minute, and the daily. This window is independent of any clicks. It's static. All right, so those are the components of my execution screen or my platform screen. Of course, I have the time, which can come in really handy when you're understanding how far inside of a 2-minute bar you are. Do you got 10 seconds left in the bar, 20 seconds left in the bar, 30 seconds left in your 2-minute bar? The time or clock is very important for precise trading. Okay? Now, this is not a session to go over structuring your platform, but if you want a head start on that, because I do plan on having a session like that, if you want a head start on that, you can start off right here by just mimicking mine. All right, notice I don't have a whole lot of fancy indicators on the chart. Don't need them. I got, each one of my charts has 2 moving averages. The 20-period moving average, take a look. 20-period moving average, 200-period moving average. So the red is the 200, the red is the 200, the red is the 200 on all time frames. The red is the 200, simple moving averages. The blue is the 20, all right? Blue is the 20, 20, simple. Blue is the 20, simple. Blue is the 20, simple. These are the only indicators I have on my chart. Now that we have that, I want to take you into the concept, a concept that I call, that my traders and I call the trifecta setup. The trifecta, write that down. The trifecta. The trifecta. I even like the way that sounds. Trifecta, say it. Trifecta. I'm not even going to go on until I hear somebody, I see somebody type it. Trifecta. Somebody type it for me. I just want to see the word. Type it. Trifecta. If you have been following my work for even a little bit of time, you understand that, which I just explained, I rely on 2 moving averages on every single chart, irrespective of the time frame. That is the 20-period moving average. I'm going to mark this, which is the blue, the 20-period moving average, and the 200-period moving average. Of these 2 moving averages, this is by far the most powerful of the 2. The 200-period moving average is the most powerful when it is relatively flat. The 20 is more powerful when it is trending, up or down. So your 20 is more powerful in this state, and your 200 is more powerful in this state, flattish. It doesn't have to be perfectly flat. Like I consider that a flat 200. You see that? It's a little curvy, but it's flat enough. Let's not start bringing out geometric tools. But Oliver, I use my ruler and there's a little curve to it. Let's not be ridiculous. Flattish, okay? Flattish. As long as it doesn't look like a freaking 45-degree angle, it's flat. It can be a little bit angly, but not a lot. So my general guideline is if your 200 doesn't look like a freaking 20, then it's flat enough. But if it looks like a 20, because 20s are typically slanty, if it doesn't look like a 20, then it's flat enough. Let's not be ridiculous. Now, we've got a flattish 200, and that's when the 200 is the most powerful, when it is flat-ish. The trifecta is based largely off of this powerful, flat-ish 200-period moving average. So let me explain something to you. When you have a 200-period moving average and you have a move down from the 200, it doesn't have to be touching it. It just has to be near it. So all of these count. This one started here, right from the 200. This is the 200. This one started here. Boom. Same thing. This one started here. Boom. Same thing. Do you understand? So it's almost like it's in the area of the 200. It doesn't have to be touching the 200. Let's not be freaking ridiculous again. Oh, but Oliver, it's four or 5 centimeters away from the 200. No, that's not what we're talking about. If it's anywhere in a small stone's throw away from the 200, that's near the 200, that's close enough. But Oliver, it's a few centimeters off. No, we don't trade that way. You can't force the market into very precise things like that. It doesn't work. So anywhere near the 200 is fine. Now, if you drop from anywhere near, notice whether it starts a little bit above, a little bit below, or right on it, the odds are you're gonna be, that powerful 200 is gonna send this. Because not only is the 200 powerful, it is the most powerful. And not only is it the most powerful, it is the most powerful when it is flat-ish. Now, you can get the same thing like this, guys. Here is starting here, boom. Here is starting here, boom. You can get the move up. Here is starting right on it, boom. All good enough. Whether you start a little bit below it, a little bit above it, or just on it, these surges off of a flat-ish moving average to 200 moving average to the upside are just as powerful as the ones that surge downward from a flat 200. Now that you know the 200 is the granddaddy of all moving averages, now that you know that even though the 200 is the most powerful moving average in existence, it is even more powerful than that when it is flat-ish. You now know that surges up or down from that flat-ish moving average are likely to soar. All right, I'm not going to babysit you long. These are things you should be writing down. I'm not going to repeat them like 100 times. I'll just repeat them like 20 times. But you're going to surge more often than not if that surge originates from the flat-ish 200 period moving average. Whether it starts a little bit below or above or right on, doesn't matter. Let's take Google. Now, for those of you who want to look this up yourself, you can go to Google on August 28th. This is August 28th, where we had on a 2-minute chart for Google, G-O-O-G, you had on a 2-minute chart, you had a drop that originated from here. But Oliver, it's a few centimeters under the 200. No, that's good enough. Because remember, the 200 is really more like a zone. It's not a skinny line. Your platform's lying to you. Moving averages aren't skinny lines. They are zones like this. So that is close enough. It is in the zone of the 200. And you drop. Now, let me give you some statistics. Surges that downward from an overhead. Guys, listen to me carefully. Surges downward from an overhead flattish 200. Boom, boom, from an overhead flattish 200. The odds of follow through can be as high, let's put it this way, can be as high as, are you kidding me? No, I'm not. 92%. It's not always. There are different versions of this, which I'm not going to cover that today. There are different versions, but they're all high. So it ranges between 88% and 92%. Still high. But there's a version that is 92%, and there's a version that's closer to 88%. But just think of that range, 88 to 92% accuracy rate, consistency rate on follow through. And look at what it freaking did. That is insane. Are you ready for what the trifecta is? Are you ready for this? I don't even think you're ready. It's 3 of them. It's 3. Oh, it's not one surge off the 200. No. It's not one, which is powerful enough, up to 92% accuracy rate. Oh, no. The trifecta is not 2 surges off the 200. Oh, no. trifecta insinuates three. It's three freaking surges off the 200 simultaneously. A surge off the 200 on the 2-minute time frame. At the same time, it's a surge off the 200 on the 5-minute time frame. At the same time, it's a surge off the 200 on the 15-minute time frame. That is the creme de la creme. That is the trifecta. That's the closest thing you're going to get to guaranteed money in this game. The trifecta. Beautiful, beautiful, beautiful thing. All right, let's get back. Let me show you this. Smoke on this. This is crazy, guys. This is crazy. You've got this drop. Now, remember, guys, I like to count the drops from the start. So I want you to take a look at this 2-minute chart very carefully here. The first bar of the first 2-minute bar on the 28th is green. It starts off going green, and at one point, it looks like a sharp, solid green bar right under the flat-ish 200, which we ignore. But if you notice carefully, the green starts to fall back. So the green starts to fall back and back and back and back. Do you understand? I want you to understand that if green is falling back, red is taking over, because green is the color up and red is the color down, right? Well, that tail, if you had to paint it a color, is red because it's moving down. It continues to move down in the next bar. So what I like to look at here is I like to look at one fluid drop from the peak. And there's my surge. I come from way over here, guys. Look, this is OV. Ready? Ready? I am ready. Boom! I am inside of that surge. Protection, I need to get my protection. My stop loss above that 200. You got to be able to deal with that. You got to get that stop loss above the 200. The 200 is the ceiling. You got to be above the ceiling. And I've got up to a 92% chance of follow through. And listen to that sound. That's our favorite sound. Now that's off the 2-minute. I want you to focus on this part of the play. That's your identifying the surge downward off the flat 200. That's the 2-minute chart. Look at the 5-minute at the same time. On a bigger time frame, look at your surge downward off the 200 on the 5-minute on the 28th. You're getting the same picture on a completely different time frame. Surging down off of a flat 200 on the 2, surging downward off of a flat 200 on the 5. Are you kidding me? Here I go again. Boom! Get that stop loss above that 200. The rest is history. But we're not done yet. That's the bifecta. See, the bifecta is the surge off the 2 and the 200 on the 2, the 200 on the 5. But we've got the trifecta, which is also the surge off the 200 on the 15-minute time frame. Oh my goodness. Surge. Boom! So where they all start, look at where they start. Right under the 200 on the 15. Let's go back again. Right under the 200 on the 15. Right under the 200 on the 5. There's your 5. Right under the 200 on your 2. Ding, 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 ding. The trifecta. It's a freaking beautiful thing. It's a beautiful thing. I need to know if you understand what the trifecta is, because this is your assignment. 2, 5, and 15. You got it. That's the trifecta. Surge off of the 200, and it originates from a flattish 200 on each one of those time frames simultaneously. So that now go out into the real world, people. I want you practicing identifying trifectas. Make sure now. So in order to do that, people, look at this. You're going to have to make sure that you have some type of setup here, right? Where you've got all three of these time frames close together. Whether you put them side by side like this. So here I've got the 2 minute, here I've got the 5 minute next to it, and here I've got the 15 minute next to it. Now, because I have the daily on this, I stack them, as you saw, 2 and 5 above, 15 and daily below. You don't really need the daily for income producing trading. You can leave the daily off and put them side by side like this. If that helps you see them simultaneously, that wow, we're falling from the 200 on the 2 minute. We're falling from the, let me do this even fatter. We're falling from the 200 on the 2 minute. We're falling from the 200 on the 5 minute, and we're falling from the 200 on the 15 minute. I've got Oliver Velez's trifecta here. So if having them side by side like this helps you see it better, then by all means, structure your screen that way. And this is very powerful, guys. Now, I've only shown you one. I want to keep it simple. This is not a master class or anything like that. Now, it is up to you, people, to move this. Let me explain to you before I leave you what I mean by move this. What I mean by move this, it is up to you to move this from the intellect into the heart. The heart is the center of understanding. It's symbolic for the center of understanding, the center of your being, right? Information here does not translate into experience. You can't keep it here. You now intellectually understand this trifecta concept. That does not mean that it can produce for you. Information can't produce for you. It's the start, but it can't produce. You need experience added to the information to make it yours. It is still mine in your mind. It becomes yours through experience. It's very important to understand this. Gaining experience with this. Look for surges. You might not be able to see the trifecta, but look for surges off of the 200 on any time frame. And just identify, wow, that was a surge off of a flat 200 on the 2 minute. Wow, this was a surge off of a flat 200 on the 5 minute. Individually is fine. Every now and then you're going to see the trifecta. That's great. But you don't, to make this concept yours, you don't need to find the trifecta. You need to find surges off the 200, even if it's just one. This is building your opportunity spotting skills for surges off of a relatively flat 200. Wow, Apple had a surge off of its flat 5 200 period moving average. Oh, wow, Oracle had a surge off of its 2 minute flat 200. Oh, wow, this stock had a surge off of the daily time frame. This stock had a surge off of the 15 minute. Even identifying the surges off of relatively flat 200s on any time frame individually will automatically build your trifecta spotting, opportunity spotting skills. Because the trifecta is just simply made of 3 surges. So if you practice even identifying 1 at a time, sometimes you'll see 2 at a time. Every now and then you'll see the trifecta come, which is really, truly special. Make this your theme, and I promise you, if you do this every single week and make the next week the theme that we cover here today, in a couple of months, you're going to be head and shoulders above everyone else.
Today, I have a very dynamic presentation for you, a talk on a topic that I actually get millions of questions on, and many of them come in week by week on the best moving averages. Now, and truthfully, I get a lot of questions on, because my approach to the market is primarily technical, I get a lot of questions on a variety of different indicators, if you will. And while I'm not a very, very big indicator heavy trader, I do rely on moving averages predominantly, and for good reason. As far as I'm concerned, moving averages are the most important indicators you can use to help you determine what the best direction of your trade should be. The moving averages can help you with timing, and the moving average can help up your level of consistency and profitability. And I'm going to show you not only the best moving averages to use in your trading, irrespective of your style of market play. I'm not going to show you the best ones to use. I'm going to show you specifically how each one of those best moving averages should be used to increase your consistency and profitability in your trading. What do we need to understand? What do we need to understand, and what do we need to actually start knowing how to use the key moving averages properly? First of all, we need money. We need a $50,000 to $100,000 account. Guys, you can't play this game with baby money. You can't show up to a gunfight with a dull knife and think you have a chance. You can't. You have to be well capitalized. I help traders become well capitalized. In fact, I tell traders they should not be trading with their own capital. They should be trading with my capital or someone else's capital. But this is one of the key secrets on Wall Street. You are a better trader when it's not your money. This is a fact. You are not as smart with your money. You are not as disciplined with your money. You're more disciplined with my money or someone else's money. This is what the hedge fund industry operates on. This is what Wall Street operates on. No one professional uses their own capital. So why is that? First of all, you do better with other people's capital. In addition to that, traders, there's more of someone else's capital than you have. So why limit your talent only to your capital? So I start traders off with $50,000 to $100,000, right? My capital, we share the gains, but I'll take care of that. We need a candlestick chart, 4 key moving averages, 4 key. There are more, but we're going to talk about 4 today. And I'm going to talk about my space concept with these moving averages and my directional rolls. Now, 50 to 100,000. All of my traders start off with $50,000. They have to show me with the things that I teach them their ability to make $3,000. It could take several weeks. It could take several months. But whenever they top $3,000, that is when we go into business together. I completely fund them. They never have to risk a single penny of their own capital. We divide the gains. If they lose my capital, it's my fault. All right. They are not responsible for the losses, but we do share the gains. I take care of the capital. Candlestick charts, guys. I am showing you a chart of Microsoft's trading activity today. And what we're looking at right here is a 10-minute time frame. Each bar represents 10 minutes of trading. Green bars obviously are 10-minute periods that have gone up. Red bars are 10-minute periods that have gone down. Now, these concepts I'm talking to you today about can be utilized on any time frame: 1 minute, 2 minute, 5 minute, 30 minute, 60 minute, daily, weekly, monthly. Time frame is irrelevant. You pick the time frame based on the duration of trades you're looking for. So I like the 10-minute time frame for traders who are trying to capture monster trends intraday. I don't like the 10-minute if you're holding stocks over days. That's more of a swing trading approach. But if you're looking to take a big chunk out of the market inside of the same day by capturing a stock's enduring intraday trend or move, the 10-minute is a wonderful time frame. Now, if you're looking for more frenetic day trading, 2 minutes is on 5 minutes is a more appropriate time frame. But we're gonna look at the 10-minute for now because moving averages are trending items and they're best utilized to capitalize on a nice trending market. Now, Microsoft, here's a 10-minute chart. We're going to superimpose a 20-period simple moving average on this chart. Now, all this moving average is doing is averaging the closing prices of the last 10-minute bars. It's smoothing out the data for us. It's giving us a lagging picture that is smoother than the jagged price movement of the bars, okay? And this is important. It's important to understand that moving averages are lagging indicators. Understand this. They lag the price activity. That's a good thing, by the way. Notice that on the left-hand side of the chart, you have Microsoft declining and the 20-period moving average is declining. On the right-hand side of the chart, you have Microsoft, for the most part, trending to the upside on top of a rising 20-period moving average. So I like this chart because we're showing the two dominant states that we're trying to capitalize on utilizing moving averages. We're trying to capture trends to the downside when our stock or market is trending downward, and we want to take as much of that trend out of the market as possible. We want to capture the trend to the upside as well, all right? And capture as much of that trend to the upside as is humanly possible. We're going to also superimpose a 200 period moving average on the chart, okay? Here's a 200 period simple moving average, the red line, right? Now, these two are two staple moving averages as far as I'm concerned. They are permanent fixtures on the chart, okay? They are permanent fixtures on the chart. These two moving averages should never be off of your chart, traders, never, okay? You should always, no matter what time frame you're looking at, have a 20 and 200 on your chart. Whether it's a 1 minute, 2 minute, daily chart, weekly chart, it doesn't matter. This is a staple. The other ones you can actually have off the chart, which I'm about to cover, but these never look at a chart without these two moving averages, okay? Now, I want you to take a look at the left-hand side of the chart and notice that your 20 period moving average, right? And your 200 and the price are relatively close together. Now look at the middle where your 200 and your 20 are not close together. And go all the way to the right and notice we come back to your 20 and your 200 and the price being clustered together again. So we go from together to apart, back together again. This is going to become very important as we move forward. Okay, let's go. The next thing we need is a 13 period simple moving average. Now we've got the 200, we've got the 20. We're going to add a smaller brother to the mix here, the 13. These are all simple moving averages. If you are in love with the sexier varieties like the exponential, then use it. I have just, in 33 years of professional trading and experimenting with virtually every single thing that you can ever think of, I have found no evidence that the sexier varieties of moving averages are any more superior than the basic simple ones. So whenever I get the opportunity to keep something simple, I keep it simple. Remember the KISS rule, keep it simple when you can, okay? So we've added the 13 period moving average, which is now moving averages getting closer and closer to your price. Now, something interesting about this moving average, notice that your 20 period moving average is not very relevant to the stock on the left-hand side. Why am I saying that the 20 period moving average is not very relevant? Here is the key to finding which moving average of our mix is the most relative moving average. You have to see when your stock has a counter bounce, where the bounce stops and resumes the trend. Whichever moving average is close to that peak is your key moving average. You see, at this point here, the 20 period, the 200 is not relevant. It's super far away. At this point, the 20 is not relevant either. It's too far away to be relevant. We have to find which moving average to operate on. Which is the most dominant moving average right now? Which moving average is the stock's trend obeying more? It will never obey all of them at the same time. It will rarely obey two of them at the same time. Most trends will pick a moving average to obey, and we've got to isolate which one that is. And I am giving you the secret to know which moving average to zero in on and put all of your attention there. In this case, we're going to put all of our attention on the 13 because its last pullback stopped just short of the 13 and resumed the drop. Okay, if we go to the right-hand side of the chart, we see that the stock rallies to the upside and then experience its pullback. Where does the pullback stop and the movement to the upside resume? Where does it stop and what moving average does it halt at? Does it halt at the 20? Does it halt at the 13? We have to find out which moving average is the dominant moving average. And this is how we do it. So on the left-hand side, that pullback halts right at or near the 13. It doesn't have to touch it, just become near it and resumes. This confirms that it is the 13 and not the 20-period moving average. And on the right-hand side of the chart, the stop jumps above the moving average, pulls back and halts, and then resumes the move to the upside. That halting area halts right at or near the 13, further confirming that the 13 is the dominant moving average, not the 20 on the way up as well. Now, knowing how to do this is extraordinarily important. Pick the wrong moving average, and your trading is off. We can't do that. All right. Now, we need one more here. We need to add the 8-period moving average, which is even closer to the action. Now, notice how we can tell that it's not the 8-period moving average that's the dominant moving average, because Microsoft's drop, then pullback, broke through the 8. So once it breaks through the 8, we now know we're not dealing with the 8. Let's see if it's going to obey the next moving average, which is the 13-period moving average. And boom, it obeys it. Okay? Same here. As I mentioned, stock jumps above the moving averages, pulls back. We're asking ourselves, is it going to halt at the 8? Boom, it breaks through the 8. Okay. Is it going to halt at or near the 13? Boom. It rallies, failing to deeply penetrate the 13, giving us the indication that it's not the 8, it's not the 20, it's the 13-period moving average. And we can actually drop the rest if we like. Now, here is something very, very beautiful, fascinating and beautiful. A lot of traders ask me, Oliver, should I keep all of the moving averages on the chart, or should I just drop those that are not dominant at the time? Once I identify my dominant moving average, can I just drop the rest? You can, but this is where I'm suggesting traders at the space between your 8-period moving average and your 13-period moving average, okay? Take a look at the space. This zone, if you will, this zone is a very interesting zone because it's telling us where a turn should occur. So as we slip between the 8 and the 13, we can utilize that zone as a very interesting possible turn. When the desired color resumes the trend out of that zone, we strike, okay? Look, notice how Microsoft slips back into the 8 to 13 period moving average zone, all right? And then green takes us out of the zone. Boom, we strike on that green. So we strike the bar, we jump into the bar, do you understand? That takes us out of the zone. And this can help your timing, it can help your accuracy. And if you help your accuracy, traders, you're going to help your profitability, the consistency of your profitability. Take a look at these zones. Zone. Look at the red bar that takes us out of the zone. Boom. Look at the zone and look at the green bar that takes us out of the zone. Boom. Now, how do you protect yourself? You protect yourself based on the bar that you just put your money in. If you put your money into this green bar, protect yourself under that green bar. If you went short on this red bar, protect yourself above that red bar. We're not going to lose the bar more than the bar that we jumped into. That's how you protect yourself. Now, remember, we have found that the 13-period moving average is our key moving average. So we're going to ride the trend out as long as the stock does not violate that moving average by 2 bars. It's not enough to break the moving average with 1 bar. We need a 2-bar break. Guys, got to bring some lights back up. My space concept. Let's talk about space here. Let's go back to this concept I started talking about just a little bit ago. Go to the left-hand side of your chart, right? And I want you to take a look at how all of your moving averages are clustered together there. Notice how when the trend starts, the moving averages start separating from each other. Now notice how we go when the trend is in its most powerful state. The 3 moving averages had this 3-finger-like power trending formation. 3 fingers spread apart. Okay? Almost like a highway with a middle line and outer lines. Now notice how these lines, as we get deeper and deeper away from the 200, the moving averages start to get closer together now. And so now we go from this 3 fingers spread in a trending way to our narrower spaces between them until they get small again. Now that's an indication. These 2 are indications. The indication 1, that your moving averages have pulled away from the 200. As they have pulled away from the 200, they have come together once again. This is one of the strongest possible scenarios that we're about to snap back in the opposite direction. This is always the $64,000 question in trading. It is, when does a trend stop and begin to reverse in the opposite direction? And I'm giving you some of the components to that answer, that 64,000, to answer to that $64,000 question. Some of the keys are your 3 moving averages wide apart from your 200? And are they now close together again? If you can get that combination. Now, if you get a pop above your moving averages, notice on the left that your stock wasn't able to pop above all 3 of them. It penetrated the 8 and then dropped again. But when you clearly, not in a feeble fashion, but the very next time you pop above those clustered moving averages, we need to read the next pullback. That's going to tell us what the dominant moving average is. Wherever it halts at the 13, as we mentioned. Boom, we buy the bar that takes us out of the 8 to 13 zone. And here begins our next play to the upside, all the way back to a narrow state again. So guys, markets repeat these 2 states over and over again. They go from narrow to wide, and after wide, back to narrow. Narrow to wide, wide, back to narrow. Now, there's another narrow. There's narrow on the 3 moving averages, wide, and then back to narrow again for your 3. And from narrow, we go back to trending apart from each other again until we repeat this narrow, wide, back to narrow, narrow, wide, back to narrow. And this is where consistency comes from. People need to understand that the market is almost trapped on rails. It repeats the same cycle over and over and over again. And I know it may not feel like it's the same, but it is exactly the same. The market's trapped on rails. This is where consistency in your profitability comes from. Understanding the repetitive cycle and understanding where you are in the repetitive cycle. And these moving averages can tell you, am I in a narrow state? If I'm in a narrow state, we're about to move into a wide state, a trending state. If I'm in a trending state, we will at one point, once we're wide away, we will at one point go back to those 3 moving averages, becoming narrow again. And now a reversal is more imminent than a continuation to the downside. Now, once you understand these concepts, it just becomes a numbers game from here on out. Narrow moving averages, narrow moving averages, narrow moving averages. Now, the thing that you have to, don't miss this point, the 3 moving averages are sort of like the children that operate and play together. The 200 is like the parent. The children leave the parent for the wide state and come back eventually to be with the parent, the 200. All right? So there's 2 dynamics going on. The 3 can be close together. Then when they start playing away from the parent, they separate from each other a little bit, although they stay within the same vicinity of each other. All right? Then they get close together, they huddle again and say, now it's time to go back to our parent. And then again, it is this cycle that repeats itself over and over and over again. And we play it this way every single day. This is Microsoft's activity today. Now, some people will say, Oliver, what about movements to the upside? Well, I can show you movements above the 200 as well. Let me just quickly say this. Look, 85+% of all trading losses come from the inappropriate use of moving averages. Here's the thing. Most people are trying to buy against the moving averages. So when you've got your 20, your 13, and your 8 all flowing in one direction, they want to be smarter than the market and try to pick a bottom, when in fact, you should just find a way to jump on board the stock on one of the pullbacks back toward the moving averages. All right? 85% of all losses are fighting the 3 moving averages, fighting the direction of the 20, fighting the direction of the 13, fighting the direction of the 8. When one of them is going in one direction, it's powerful enough. When 3 of them are going in one direction and you're on the other side of that, you're not only a losing trader, you're an unintelligent losing trader. It is unintelligent. It is not intelligent to go against all 3 of these. So one of the first things you should do is look for stocks that have all 3 moving averages pointing upward or pointing downward, and insert yourself into that trend. When the stock moves back toward the middle one, most of the time, when it moves back toward the 8 or the 13, then you jump on board the bar that starts moving you back away from the 8 and 13. Protect yourself with the bar. It's a rather simple but very powerful approach. Let me show you another stock, NVIDIA. Notice the same formula, the same type of scenario here. You've got NVIDIA to the left. This is activity yesterday and today, the 26th and 27th of October. You started off narrow. You went wide. Now look at this. Look at NVIDIA's bounce that did not break the 8. So NVIDIA is saying the 13 is not the key moving average. Neither is the 20 the key moving average. NVIDIA is saying that it's the 8. So now we jump on board the bar that moves us away from the 8. Boom! Protect ourselves above the bar. Okay? On the upside, it is the 13. We break the 8 and halt at the 13. So now it's the 13 that the stock is obeying. You've got this, traders. You've got the 4 key moving averages and how to use them. And if you trade the majority of time in the direction of the 20, of the 13, of the 8, you're going to instantly improve your profitability and your consistency. If you look for specific entry points to jump into that trend on retracements back to the 8 or the 13, sometimes all the way back to the 20, and then identify the bar that moves you away from the 8, the 13, or the 20, protecting yourself above or below that bar, you've got a dynamic moving average trading system. It sounds simple, it sounds basic, but most extraordinarily profitable things are, traders. One last thing I'll show you is one on the upside. I think we had Baba today. All right. And here, take a look at your moving averages. Look at when the 3 moving averages are relatively clustered together. Look at the move above the moving averages. Now, this move was so powerful that it got virtually no retracements back to any moving average. That's how powerful that trend is. Now, you can keep going down the line. If you're not getting pullbacks to the 8, then you have to go to the next Fibonacci number, which is the 5-period moving average. This is extraordinarily rare to get a move with this type of power, which means that we have to find alternative ways to enter, which I can teach you as well. Look at the left-hand side of the chart. Look at the drop and the move back into that zone I told you about. Right back in between the 8 and the 13, we jump into the bar that starts moving us away from the 13 again. We protect ourselves above that bar, and there's that beautiful sound again. Okay? If we look here, we can catch it early where we get above the moving averages. We pull back into the zone. I don't know if you can see that very clearly. We can jump back into the bar that moves us out of that zone. All right. Powerful trend here in Baba today. Very, very powerful trend. Traders, basic, simple. A 12-year-old can follow this. Most profitable things are just like that. We make the game more complex than it needs to be. We make the game more difficult. We bring difficulty to the market. We bring complexity to the market. We make it harder than it has to be. The market only goes up, down, and sideways. That's not a complex mechanism. The engine of a Ferrari is complex. The market is primitive. Up, down, sideways, repeat. Up, down, sideways, repeat. Narrow state, wide state, back to narrow state. Trending state, all moving averages down. Trending state, all moving averages up. Buy zone between the 8 and 13 sometimes. Sell zone between the 8 and 13 sometimes. Get into the bar, leaving the key moving average. Protect yourself above or below that bar. And that is your powerful, simple, profitable moving average trading system. Now, what I want to do today, traders, is I want to hold a rather informal talk with you today, an informal, brief training session, if you will. And I want us to talk about one very important key fact that I believe all market participants must and should understand. Number one, money rules the financial markets. That's the first thing we have to understand. And I know it sounds very basic and it sounds like a given, but I'm in contact so frequently with market participants who seem to lose sight of this very important point, that money is the driving force behind market activity. And so in order for one to play the markets or read the markets appropriately, not only must you understand that fact, but you have to know how to read the footprints of money. There is an old Sherlock Holmes axiom, if you will, that states, I believe he stated, that if you want to solve a crime, you must follow the money. Well, if you want to follow profits in the market. You have to follow the money. And so we're going to talk about how you read the footprints of money. I want to talk about how we read the footprints of money, and I want to talk about specifically now what we need in order to do that. Now, I am a technical trader, which means that while I do take a look at some of the fundamentals behind organizations and industries for the most part, I largely look for opportunities by what the price activity is doing. I believe that fundamentals attempt to predict what the future is going to be, which I think is virtually impossible to do. I believe that technicals help the trader understand what is happening now. Fundamentals try to take the past and predict what the future is going to be by looking at the numbers and the facts from the past. Technicals help the trader look at what is happening now. It is my belief that knowing what is going on now can in a greater way help you determine what is likely to be a future now, because a strong now begets an even stronger future now. So I am a technical trader at heart, and I predominantly look at the activity of the markets through the eyes of a candlestick chart. Now, we'll need a candlestick chart. The time frame is going to be your choice. Time frame of this chart is going to depend on what style of market play you play. So if you're a swing trader, you probably want to look at the daily chart. If you're a core trader, you probably want to look at the weekly chart. If you're a long-term investor, you probably want to look at the monthly chart. If you are a day trader, you probably want to look at a 5-minute chart or so. And if you're a micro trader, anywhere from a 1 to 2-minute chart. But the time frame doesn't matter. Your style of market play dictates the time frame of chart you should focus on. There is no right or wrong time frame, just a time frame that is specific to your style. We're going to put a 20-period simple moving average on that candlestick chart. We'll look at this in just a moment. And a lot of people ask me, Oliver, why simple? Why not exponential? Why not weighted? Why not triangular? Why not any of the sexier varieties of moving averages out there? And I will tell you this, that I have been trading the markets for 38 years. I've been trading professionally for 33 of those years. And I've experimented with probably every single technical indicator you can probably come up with. I've experimented with every possible moving average and moving average combination you can conjure up, right? And I will tell you that I have found no evidence that the sexier varieties are any more potent than the simple variety. So whenever I have an option of going a little bit more complex or keeping it simple, I keep it simple. So we're using all simple moving averages, the 20-period simple moving average, the 200-period simple moving average. Now, these are 2 of 5 dominant moving averages I teach my traders to utilize, okay? It's not the entire list of moving averages, but they are 2 of the most important moving averages we rely on. Then there are 2 types of bars, 2 types of candlestick bars that I want my traders to actually become very intimate with. We'll talk about those today. What I call elephant bars and tail bars. These 2 bars have 2 versions for the most part, a bull version or a positive version and a bear version, a negative version. We'll take a look at these 2 bars and how they help us read the footprints of money. Before I go to charts, let me just say this, traders. It needs to be understood that the only way that you and I are going to make money is to find out which way the institutions are stampeding. You see, I can't make Microsoft go up or down in any significant way. Neither can you. If you're watching me, pretty much you're in the same boat. You can't have a great influence on the activity of an Apple or a Microsoft or a Facebook or a Bava or a Twitter or a Starbucks or a JP Morgan. You can't have an influence. In order for us to make money, we must find out what the players, where the dominant players are and what the dominant players are doing. And we must jump on the coattails of those dominant players. Now, when I say follow the footprints of money, I am talking about institutional money. Those are the large institutions, the large hedge funds, the large mutual funds, the large family offices, the large money management firms, the large money out there that's basically making very serious multi-billion dollar commitments into our specific financial instruments. Now, when the vast majority of those institutions in a specific financial instrument are all going or stampeding in the same direction, that's what I'm talking about, capturing those moments, watching those footprints. And I call these institutions elephants, if you will. So these are the elephants of the market. They leave giant footprints in the dirt, in the sand. They wish they could hide from us, but they can't. They're too big, they're too heavy. They cannot leave the footprints of mice. They can only leave the footprints of elephants. And we can detect the footprints of elephants and where the vast majority of those footprints are going. Are they running to the upside or are they running to the downside? Or is there enough running to the upside as well as to the downside to cause the market to be trapped? That's all we really have to do, is to read the footprints of these elephants and to find out where the balance of these elephants are going. Are they equally balanced across their activity? Market goes like this. Or is there a slight advantage of the elephants running to the upside over the elephants running to the downside? That means your markets has a bias to the upside. Or are the vast majority of those elephants running to the downside, leaving, versus the elephants going in which case the bias is going to be to the downside. We must know how to read which way the wind is going, which way the elephants are running, and if they're running in one direction, are they running in that direction with a great degree of force? And that's what we're going to look at today. So this is a daily candlestick chart of an item called the Spiders, symbol SPY. It is an ETF that is designed to track or mimic the activity of the S&P 500 index. Now, every bar you see, whether it's red or green, represents a full day of trading. All right, green bars indicate that the stock or SPY or the S&P 500 closed higher than where it started in the morning that day. And if you have a red bar, it's clear that the market, the SPY or the S&P 500 closed lower than where it started that day. So very quickly here, for those of you who are not familiar with reading candlestick, I'm going to give you a very quick summary here. Green bars start the day at the bottom of the green and end the day at the top of the green. Red bars start the day at the top of the red and end the day at the bottom of the red. And that's, for the most part, all I need you to understand. When I say I need to teach you how to read elephant bars, I want you to take a look at this section of the S&P. I want you to note that the blue moving average is the 20-period moving average. The red one is the 200-period moving average. I want you to note that in this scenario, to the left of the chart, you have your stock, SPY, moving to the upside for the most part above the 20-period moving average. You have both of those items moving to the upside. This is key. Your stock is moving to the upside and its 20-period moving average is moving to the upside. Both item 1, your stock, item 2, your 20-period moving average, which are both rising. These two are above item 3, which is the 200-period moving average. I call this the 3-finger spread. It might be this way, this way, I'm not sure. Okay, the 3-finger spread. Rising stock, rising 20, both rising items above the 200. The 200 doesn't have to be rising. This is what I call the picture of power. And when you have this picture, for the most part, your elephants are on the green side. The elephants with the greatest amount of strength are green. They're not the red elephants. So the green team is the dominant team. The footprints on the green side are what we need to focus on. Now, I want you to quickly take a look at this whole section here. And I want you to note one very clear thing. Out of all the green bars and the red bars, the green bars are by far greater in number. And while this is something so simple, it is almost overlooked by the vast majority of market participants. You can gain an edge by simply counting the bars. There are two dominant teams, guys, in this game, buyers and sellers, green team and red team. There are two large group of institutions, the green institutions, the red institutions. They play on either side of each team, either of each team. Now, which institutional team, the green team or the red team, which ones are producing the greatest number of bars? Which ones have more footprints in the dirt than the other? Obviously, green. For every red bar, there's 3 or 4 or 5 green bars. Look at it. One red bar, green, one green, 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 one red bar. Green, 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 one red bar. Green, 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 green. You get the point. So one of the ways we can follow the money is just simply to count the colors. Which team is producing more of its own color than the other team? Obviously, if green is capable of putting its footprint in the dirt more frequently than red is able to put a decisive footprint in the dirt, then green is the dominant player. And that's the direction you should trade in or go in or bet your money in. In addition to counting which color is the dominant color, I want us to take a look at the size as well. It's not always something we can rely on. In the vast majority of cases, we can rely on size as well. So which side of the equation, which color is able to put in the strongest looking bars? Now, you have a strong looking red bar here, but followed by another strong looking green bar. So we can pull out all of your very solid, strong green bars. We want the really solid ones, the ones that are very decisive, unmistakable. These are the strong green bars. And if we want to go all the way to the right, we can continue to pull out the very solid ones, the ones that are mistakable. See, this one is not quite as solid as I'd like because of a little tail on either side of it, but we want the really solid ones. So we can do that. We can also take the red solid ones and pull out the really solid ones as well. If we take a look at this section, I am based on just this theory here, just based on how solid the reds are. I see a preponderance of solid red over solid green. And this makes sense that the market is sort of sideways, unlike it was before. So based on this second thing, solid bars and the frequency of those solid bars, I'm starting to get a little concerned in the sense that green is potentially losing its ability to produce consistency like it did before. The solidity, the oomph, if you will, the power of red bars are definitely stepping up in number and frequency. We've got some solid green bars, but there are a lot of extra little ones mixed in between. You see the little ones? Not quite as convincing as these. Here's a solid green one.
Yeah, those.
But the greens, even the ones that go up, have a little hesitant nature about them. They're not quite as ferocious. They're not quite as fierce as the red ones are when they show up. So I am reading now that the footprints of sellers, the footprints of institutions coming out when they decide to come out, they're coming out with greater force than the institutions that are committed to going in. This is extraordinarily important to be able to read. There are always institutions going in, and there are always institutions coming out of a market. Always. In the greatest of bull markets, there are times when institutions come out. They might be taking profits after gains after 5 years or what have you, but there's always a mix of institutions going in and coming out. You must be able to read which ones, when they do go in, and which ones when they do go out. Which ones seem to be going in? Are the institutions seem to be going in with greater power? Or when they show signs of coming out, are the institutions coming out with greater force? I am telling you that basically what I am reading is that institutions are coming out with greater force. And this is today's chart, by the way. This is today's daily data. And so this is me reading this second side. So remember, the first side is just to count the number of bars. Versus there on the left-hand side, you have far more green bars than red bars. So on that metric, in that metric alone, bulls are dominating. Buyers are dominating. Institutions going in are dominating the institutions coming out. Here, starting from here, I am seeing a different picture based on the second metric. Which bars seem to have more force? Which bars seem to have more power? Which bars seem to have more oomph, if you will, more violence, more ferocity? And it is the red bars. When the institutions coming out decide that today is the day we sell more than normal, they are really dominating the action. More so than when the institution's still committed to going in. When they say, okay, now it's our day today to hit the market a little stronger, a little heftier, they're not quite making the cut as far as power, oomph, and velocity, I should say. All right. If we take the count here as well, we're starting to see, I don't know, it's more salt and pepper. Whereas here, it was clearly dominant on the left, as you can see. Clearly dominant, where you just had streams of dominant green, only peppered by an occasional red. Here, you're starting to get a greater number of reds show up than red showed up here. A greater number of reds showing up. Okay? We're starting to get, here's this period is equal. We had some consistent green here. Okay. We had some fairly consistent green here, but we've got consistent red, consistent green, consistent red, consistent green versus just consistent green throughout. So we can see the change occurring in the balance of power here. There's definitely a change. The third metric I want to bring your attention to in terms of reading the footprints of money is follow through. I'm going to call this concept follow through. Follow through is when a strong bar leads follow through after the strong bar. And if a strong bar to the downside happens, I could draw this, let's say this is a bar to the downside, that bar produces fluid follow through after it. So follow through is very important to understand. When one team produces a fat, solid bar, are they able to follow up on it? Or does the other team come back so ferociously that they knock that one bar out? All right. And this is what we need to also keep an eye on. What's the follow through? So now look at this power green bar here. There's follow through after it. You see? Solid red bar here. See that solid red bar? Little to no follow through after it. Solid to green, fat, solid, concise, perfectly formed green bar there. And there's follow through. Let's take a look at this fat red bar. We look at this fat green bar, and there's follow through. But look at this fat red bar here. There's no follow through. So which side has more consistent follow through after a solid bar. Now, there are periods where your market can be in an equilibrium where both are displaying just the same number of metrics in their favor. That's a market that's like this. And we're seeing that kind of market environment now, although I am seeing a slight tip in the edge of power on the red side, just in terms of sheer number and frequency, and the less convincing green. When the green does go up, it goes up, but it doesn't have that same oomph that the red's having right now. And so it's these three metrics that I want you to keep an eye on. The simple color count, which color is more dominant? Sometimes your color is going to be equal, but there are many times where you have a clear color dominance, green or red, like we have on the left here. I want you to note the size of bars. Which side is producing the greater number of ferocious bars? Metric number 2. Metric number 3. Which side is failing more than the other side to follow through on their strong bars? That's the weaker side. And when you take these three metrics and put them together, you can come up with some very clear indications of who is dominating the market right now and what side should you be leaning toward, the downside or the upside, the green side or the red side. Let's take a quick look at a few others here. This is a popular stock that has not only been in the news a lot just because it is it's considered to be China's answer to Tesla, NIO. So I want you to take a look at the two moving averages again, guys. Notice that you have your 20-period moving average, which is rising. And we got the stock. So you got the stock, which is rising, the 20, which is rising. The two rising items are above the 200. Now, remember, when you have that scenario, it already gives the favor to the green bars. If we take a look at this period, we see, for the most part, equilibrium. We see a salt and pepper type scenario. We see just as many red bars as green bars. Whenever I have a period of salt and pepper, I need one side to either get out of that salt and pepper period to the upside, green, or get out of that salt and pepper period to the downside. And I needed to do it convincingly. And we can look right here. Boom. Neo puts a fat, green, powerful, bullish bar that comes out of that equilibrium period. That's all I need to know. I'm going with the footprints in this direction. Okay? Here's another period of equilibrium here where you see a salt and pepper like scenario. Just as many red bars as green bars, nothing really convincing on either side. And boom, emerging out of the salt and pepper period is the strongest, most powerful green bar in quite a while. That's all I need to know. I've read the footprints of money. The biggest footprint of all is on the green side. I'm betting on the green side. Okay? Same thing here. Period of equilibrium, small bars, no elephants. We didn't get a chance to talk about tails today, but no elephants. Nothing really powerful. There's a tiny little solid green bar here, red bar here, but it does no follow through. So the market's still equal. And then boom, convincing, irrefutable, unmistakable, fat, solid, almost perfect elephant bar to the upside. Now, if it were to the downside, I'd take the bet to the downside. But I would rather take the bet to the downside under the moving averages. We are above the 20 and the 200. So the better odds are to go with your footprints on the green side. All right? The red footprints are better underneath the moving averages. And if you can keep those basic concepts in play, you really shift the odds in your favor a great deal. Okay, a great deal. Now, what we can see this fat red bar, but no follow through. And then a fat green bar with follow through. Fat green bar with some follow through. Green bar with some follow through. Green bar with some follow through. Green bar with follow through. Green bar with follow through. Green bar with follow through. You get the point. Now we've got the biggest red bar on the entire chart. So what is this telling us? That all of a sudden, the red team or the red elephants are capable right now of putting a serious footprint in the dirt, in the sand. This is our first warning that things could be cooling off or likely to cool off for EO. That's reading the footprints of money. Okay. It's not rocket science, traders. We have to be able to do this. All right. Here's Uber wound up rocketing to the upside, but were there signs here to give us an indication that the buy side was just a bit more powerful? Well, we can pull out our really solid, perfectly formed green bars out of the mix. And we would have to do this as well on the red side. Now, I can already tell you that the solid green ones are greater in number. I can already look at the chart and tell you that for the most part, the green bars are more convincing than the red bars. Look at this period of red, not as convincing as this period of green. Okay? There's something also I see here that leads me to believe that there is more buying going on here. It's tail bars, which we didn't get to really discuss here today like I wanted to, but bottoming tail bar, power bar, bottoming tail bar, power bar. They are equal in importance to very powerful fat green bars. All right? So if I add those to the mix, fat green, bottoming tail bar, fat green, bottoming tail bar, fat green, you get the point, fat green. The footprints being put in the dirt here by green are very, very convincing. And when red gets its chance, every now and then there's a solid red, but then it's followed by tiptoeing by red. Look at the tiptoe. Not quite as convincing as the follow through after. And the follow through here is powerful. The follow through there is powerful. I am ultimately not surprised that the balance of power tipped and exploded out of this range to the upside as opposed to the downside. All right. Again, reading the footprints of money. What's the big money doing? What's the big money doing? I'm sure there are a lot of investors here. So as an investor, you don't want to look at the daily. Let's take a look at something like the weekly chart or so. If we take a look at Cisco here for a second, we can clearly see that Cisco from July, mid-July or so, has really had more of a bias to the downside. Somewhat different from what the stock was experiencing before. What kicked things off? What changed the nature of Cisco from going from this clear dominant bias to the upside to having a more predominant bias to the downside? Well, the first troublesome footprint that I see is not this, because the ability of Cisco to follow through on that bar wasn't there. It was not this red bar, if you can look carefully. Let me open it up a little bit so you can see it maybe a little clearer. Here's another solid red bar. It's trying to buck the trend of the green. But as you can see, it was not able to follow through. So this did not concern me unless I started to see follow through. This did not concern me unless I started to see follow through. Where is there a big fat red bar plus follow through? Now we've got trouble. You see, in the most powerful of all trends, there should be no great follow through by the opposing color. And the very fact that Cisco was able to produce a red bar, which is not odd, for the very first time was able to produce follow through on that red, would lead me to believe that there's more downside to come here. Fat red bar plus follow through. Fat red bar. I'll do this again. Fat red bar plus follow through. Fat red bar plus follow through. You see? Fat red bar plus follow through. This is somewhat troublesome when you start to see consistent follow throughs on the red bars for the first time in a while. And so, listen, institutions that drive our markets, traders, they're not owners forever. They are buyers and sellers. And we have to be able to read their footprints, because it is not your neighbors that's pushing your stocks up. It's large institutions. And so we must read the actions of these large institutions and the items that we want. It's not your friends. It's not your neighbors. It's not your family members pushing these stocks around. It's institutions with billions of dollars. They wish they could get into the market and out of the market without leaving their footprint. But they can't. They're too big. They always leave their footprints. And it's not just one institution we're looking for. We're looking for the family or the collection of institutions that are dominating the activity or the volume in this particular item. Now, what percentage of that family or group of institutions are moving green or moving red? Once you're able to read that with some degree of regularity, consistency, you can place the odds of future direction in your favor in a fairly substantial way. All it takes is for us to have a little bit of an edge. Little small edge is all we need. We don't need a gargantuan edge to throw everything in our favor, or most of the things in our favor. This is one of the edges I believe that you need. There are others that I'd like to teach you, but this is certainly one of them. So traders, there you have it, reading the footprints of the market. I want to thank you for joining me today.
There is a specific talent or skill, or shall I say technique, that can help you do this with a high degree or relatively high degree of consistency. Now, there's this idea that picking tops and bottoms is not possible on a consistent basis. And this is not entirely true. It has a little kernel of truth, but it's not entirely true. There are some things that you can put together, some things that you can utilize intelligently to at least get a high degree of accuracy in the area of a bottom. Now, the technique that I'm going to share with you today, I've been using for the past 25 years or so. It has proven to be not only reliable for me, but it's proven to be reliable for hundreds and hundreds of my traders. And if anyone who's followed my work for even a little bit of time, you know that, there have been some fairly accurate calls for market tops, such as back in February, March of 2020,
as well as major bottoms in the market, such as the Bitcoin bottom in March of 2020. And so I'm going to share with you the very same technique that I use to grab the secondary component of a bottom. And I'll explain that in a little bit more detail as we get into the presentation. The inaccuracy comes at picking the first part of the bottom, but the second part of the bottom, you can have a very high degree of accuracy. So we're going to focus on the second part of the bottom today. How to pick bottoms in the market. Now, the first thing we have to cover are the tools that we need, okay? We need some very basic tools, 3 in general. We need, number 1, a candlestick chart. Now, there are a variety of different styles of charting, guys, but I believe that the candlestick form of charting really appeals to the trader in a more powerfully visual way. And if we're charting or approaching the markets from a technical perspective, a lot of what we rely on is visual interpretation. And I believe that no other charting form offers the benefits of that of getting your visual interpretation correct more than the candlestick form of charting. Okay, so we're looking at candlesticks, right? The second thing we need a simple 20 period simple moving average of that chart. Okay. Now, I will say that for this technique, I will be showing you predominantly the technique off of a 2-minute time frame, which is a short-term oriented time frame, right? Each bar represents 2 minutes of trading. We're looking at Tesla now, and each bar represents 2 minutes of trading. Now, a 2-minute time frame is predominantly for a very active, almost micro form of trader. We're looking to take gains anywhere between over 8 2-minute bars to as many as 16 2-minute bars. So 8 to 16 bar time frame. I will say that the technique I'm going to share with you today is applicable in every time frame. So if you prefer a 5-minute time frame, the technique works. If you're a longer term player and prefer a daily time frame, it works. Or an even longer term time frame, a weekly time frame where you're more investor style, it works. And I'm going to show you briefly that today. But for the benefit of teaching you, for the purposes of teaching you, I will be using the 2-minute time frame where I have hundreds of traders each day applying this technique to the 2-minute time frame, okay, for daily market gains. So we need the 2-minute chart, a 20 period moving average, simple, all right, of that 2-minute chart. And we need a 200 period moving average overlaid on that chart as well. So these are the 3 primary things: the chart itself, the 20 period moving average, and the 200. All right, there are many things. I could literally talk for hours on this one chart. There's so much to see and benefit from. All right, but that's for another time. We're going to keep to the topic of picking bottoms. Now, a lot of people ask me about volume. Volume is optional. I believe that if you want volume on your chart, you can put it on there for visual appeal. You won't really be truly using volume if you're following my trading techniques, because my techniques help you become the volume that other people read. And let me give you a quick example of that, okay? My traders know that this bar right here is what I call a clearing elephant bar. That is a buy, all right? So it's a powerful green move that is trading above a chunk of former price data. So here's your former price data, and we're moving out of a chunk of former price data, almost like a flagpole or a taller building than the rest of the buildings to the left of it. That's a buy. Now, my traders are taught to dive into that bar, that they're not to wait for that bar to finish, that as soon as this bar clears, they're to buy there, okay? Now, if you look at the volume here, the volume surges, which is a powerful sign. However, you don't know what that volume bar is going to be unless you let that bar finish. Well, as far as I'm concerned, buying after the bar here, it's okay, but it's definitely less beneficial than buying as soon as the break occurs. And so we can't wait for volume all the time to confirm our buy. We look to actually help form the volume that other traders look at after we're already in, and their subsequent buys help lift us higher. All right. So we're not big, heavy reliers on volume. And in addition to that, traders, I will tell you that volume used to be incredibly more important when I first got in the game back in the mid 1980s, early 1990s. But gradually, volume became more and more irrelevant due to the fragmentation of the markets. Black pools and gray pools of liquidity now are responsible for a lot of the volume, where the volume gets reported much later. That's why they call them dark pools of liquidity, gray pools of liquidity. Institutions push their orders through those pools. Those pools don't report the volume until much later, so that during the day, you're not really getting a true representation of volume in the first place. Okay, now that we have the tools, the chart, the 20, the 200, volume, if you like, let's go over the technique, the 20, and I call this technique the 20 period moving average halt technique, as in halt, who goes there, as in stop, okay? Now, the first thing in order to pick a bottom is that you need a decline. You need a stock or any item that you trade to be declining, and you preferably want a very thorough decline. This tactic is less reliable if we're talking about mild pullbacks. I'm not talking about picking local bottoms. I'm talking about picking the bottom, okay? The bottom after an elongated move down, the bottom after an extended downtrend, not the local bottom within an uptrend. There are two types of bottoms, local bottoms and the bottoms. We're talking today about the bottoms, okay? There's a very, very steady move to the downside. So we've got the decline. I'll explain something here about the declines. When I see a thorough decline, a multiple bar after multiple bar after multiple bar decline that has distance from its moving average, I start getting interested in possibly looking for the bottom. What do I mean by distance? I am talking about distance from, okay, let me grab my pen here again, distance from the nearby 20 period moving average. Now, if I were to draw a line straight to the chart to the actual price now, there is great distance between the two. The best bottoms form from a distance away from that 20. Not all of them, but the very best ones statistically are far from the 20. Now, I'm going to even improve on that. If the stock itself is far from the 20, and the 20 is also relatively separated from its mother, the 200, we have what I call dual space. Space 1, space 2. A dual space bottom is the most powerful bottom of all. It is the number one technical sign that the sellers have largely gotten all of their selling or most of their selling done. Now, if you look to the left very, very, very quickly, you'll see that if you try to pick a bottom too early and you don't have that great distance, the odds are much lower for you. But the things that I look for is an elongated drop. So here's the beginning of the drop, and here's the drop to here. So we've got an elongated drop. This is not a short drop. It's an elongated one. And so if the sellers had ammunition, bullets to sell, you have to imagine that their guns that they're selling with, boom, 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 can't still be that full of ammunition. That the move is so deep and so elongated that most of the selling is probably done, okay? And we confirm that it's highly likely with dual space. Now, we don't need dual space. The dual space is the optimal situation. You only need really one space. But if you've got two, wow. The first thing is the decline. That same decline, the next thing we need is a move up through the 20-period moving average. So remember, the first thing we need is the decline, elongated decline, preferably with space, preferably with dual space. Then we need, number two, a move through the 20-period moving average, not to the 20-period moving average, through the 20-period moving average, okay? We need this, the move through the 20. Now, you can come to the 20 and drop, to the 20 and drop. That's not what I'm talking about. We need the move through the 20. That's the second criteria. First, we need the decline, elongated, preferably with space, really preferably with dual space. That's one. Number two, we need now to see if the stock is capable on its next rally of going through the 20-period moving average, okay? So Lucid did just that. Now, the third thing we need is that the next pullback after going through, we want to see if the 20-period moving average halts it. We want to see that now that the stock is above the 20, does the 20 catch the stock on the way down? That's the 20 MA halt. Or does the stock just ignore the 20 and continue lower? If the 20 catches the stock, that's when we start to salivate. This is catching the secondary bottom. You see, the first bottom is here, the dual space. And we have techniques, I have techniques with my traders to try to capture that first bottom. But the second bottom after the bottom is far more reliable, okay? And that's what we're focusing on today. In this case, the 20-period moving average did catch it. There was a brief slip, but that's okay. That's more like leaning on the 20-period moving average, like boxing ropes, but not breaking it. We come right back. We lean against the 20 and come right back. So the 20-period moving average caught it. After the catch, what you need is for a green bar to take out the high of a solid red bar. What's the most recent solid red bar? It's right here. You see that? Now, now that we have the halt, as soon as the first time a green bar trades above, I'm going to erase this so you see it clearly. Once a green bar trades above the high of its most recent solid red bar, boom, no questions asked. You don't wait for that green bar to finish trading. You don't doubt. You don't hesitate. You don't call the psychic hotline. All right. You don't seek for anything else. You just hit the darn buy button and immediately protect yourself. Here's how we protect ourselves. We're going to go under that halt. We're going to go under that halt. So wherever the halt happened, we're going to put a protective stop under the halt. Okay. Now, it should go without being said that you should know how much you're going to lose should it not work. This you should know before you take the trade. But that's a different topic. But just to mention that, no professional trader goes into a trade without knowing I'm not going to lose more than this. So you got to know where that stop is, and you have to be able to calculate if I buy here with X number of shares and it does not work, I will lose X, which is okay because X is not more than what my plan dictates is my maximum loss per trade. Every trader needs a maximum loss per trade. We've got the halt. Remember the items. We need an elongated decline. That decline preferably should have space, one space, but really preferably two spaces. If we've got an elongated decline with either one or two spaces, the next thing that needs to happen is the stock needs to move to demonstrate its ability to not move just to the 20, but sear through the 20. Now, once it sears through the 20, now we're watching closely. How does the next pullback fare? And if the 20-period moving average catches that next pullback, the plan goes into play. We grab the most recent red bar, we mark off the high, and if a green bar takes out that high, boom, protect ourselves under the halt. Now, some traders might ask, well, Oliver, what if it just sears through the 20 and keeps going? Well, that's life. You missed the train. Have you ever missed a train in life? Yes. Missed a bus, miss a taxi, miss your ride. It happens. It's life. Move on. It's not yours. We only want the ones that demonstrate a 20 MA halt. All right. My father used to tell me, many of my traders know this story. My father used to sit down at the dinner table and tell me when I was a teenager, Oliver, stop chasing every single dollar in the world. Every dollar is not yours. There are some dollars that belong to other people. You have to carve out which dollars in the world are yours. This keeps you focused, Oliver. This keeps you knowing what to do. This prevents you from being distracted, because if every dollar in the world you want to chase, you'll never get roots. You'll never settle down. You'll never focus. And this is what I'm constantly telling my traders. This move is just not ours. The dollars we've carved out for ourselves are the ones that come back to the 20 and halt. Those are our dollars. And there are plenty of them to take advantage of. Okay, good. Thank you very much, Dad. Thank you. We've got the halt. Boom. Now, the initial run. I'm not finished. On this initial run, if it's decent enough, if the move is decent enough to, let me show you, if the move is decent enough, I have no problem with my traders taking profits. What's decent enough? If you get a decent enough space away from the 20 that halted the stock in the first place, there's nothing wrong with taking profits. But I want us to try to take advantage of the secondary play, which is the next 20 MA halt. You see, the first one often leads to the second one, and sometimes the second one is bigger. So we've caught the first halt. There's another halt that's highly likely. Highly likely. I have no problem with taking profits. I try to tell my traders, if you're going to take profits on that first one, don't take it all, because we really want to add to the play if there is a second halt. So the halt play is not just one halt, it's two halts. Keep that in mind. It's not just one halt, it's two halts. Now, let me clear the drawings here, and boom. Now, boom. I don't know if you can see that, but we shoot really nicely high from this 20 MA halt. This is today, guys. I always try to show you things relevant. I don't want anyone to accuse me of going back in the past and cherry picking. This happens all the time in the market. So we get that first halt, boom, trade above the red, protect ourselves below the halt, and I love that sound, by the way. Do it. Do it for me. You know how to do that? No, I know you don't know how to do it. That's why you're here, but we'll get you there. Okay. Teasing it. Here is where I do want you taking profits. If you're going to take, remember, space in the market is an action. We had space to the downside, an action. Space to the upside, away. You've got to act on these wide spaces, right? If you're not a wide space actor, the odds are against you for success in this game. The secondary drop, here's the pullback to the 20. If the 20 halts it again, you're in likely for the secondary run. Now, sometimes it's the secondary run that's bigger than the first one. This is going to be hard to match because this first one run here was big, but oftentimes it is your second run that's bigger than your first run, which is why I don't want my traders not taking advantage of that second opportunity. It might not present itself. That second drop might just shoot through. Okay, it just shot through. But if it doesn't, I want us ready. And in this case, it doesn't. Boom. We halt at the 20 for the second time, and green takes out its most recent red. Boom. What do? Protect ourselves under the halt. And as you can see, boom, That's the second halt. This is the second halt. This is the first halt. Here's the second halt. And there's your space. Space above the 20, you must act. Anytime you have space, wide space above the 20, you must act. It's relative. I understand, but if you're intimate with the stocks you play, you'll know what's wide for those stocks or the financial items you play, because this strategy works on every financial instrument out there. Let's take a look at one more here, Roku. This is from today as well. Okay, Roku opens up today, briefly moves to the upside, and then goes into this elongated, there it is, the elongated trend to the downside. Now, remember when I told you we just need space? We need an elongated move down and we need space, but preferably dual space. Well, here is no dual space, but we have space. What do I mean by one space? The separation between 20 and 200. So that's the first space. Remember on the previous slide, right? I showed you that here we have space. We have two space levels, and I made this one and that two. That's on purpose. It's not inverted. The first space is always the space between the two moving averages. The second space is between the stock and the 20. Okay, keep that in mind. It's very important. All right. It sounds like it's not important, but it is. And I'll explain it to you right now. So here we have an elongated move to the downside. That's criteria one. Part of that criteria is we need space, preferably dual space. But if we don't have dual space, we need one space. One space, remember, number one is between the two moving averages. Number two space is between the stock and the 20. Okay, so here's number one space here. One. We don't have wide space between the stock and the 20. So we only have one space, but that's okay. Right? Two is super ideal, but one is workable. So we've got one space here. Now, what's the second criteria? Once we have this elongated move to the downside with space, we need to see the stock demonstrate its ability to sear through, not just come to like it did here. It came to and dropped, came to and dropped. You see, came to the 20 and dropped. No, this sears through. So the very act of searing through the 20 is telling you that the stock is demonstrating qualities of change. It's suddenly gathering some extra ability to do what it wasn't able to do. How many times? 1, 2, 3 times before. So why is it all of a sudden that this stock is now capable of doing something that it failed at 3 times? It's going through change. It's ready for change. We sear through. The next thing we need to do is we need to carefully monitor that pullback. Now, remember, these dollars aren't yours if it does that. Okay? Remember my dad's lesson. Every dollar is not yours in the market. Don't chase every dollar. Focus on defining your dollars. The dollars we're going to make is if this stock pulls back to the 20 and halts. Okay? And let's see if that's what we have here. Boom. We get that pullback. Beautiful. This looks beautiful. Pull back to the 20. We halt. And the first time a green takes out a solid red. Now, some traders do it above the little reds. The best ones come when they're taking out somewhat of a solid red. Your solid red here is here. Look at this. This took out the solid red too, but it wasn't enough lift above the 20 for me at that point. It needed more lift. This is the lift. This is the searing through. Now, this pullback is the ideal one. Wow. See that green take out that red? Boom. Don't remember what I told you. Do not wait for this green bar to finish. As soon as it clears, it could still have another minute left in the bar. Who cares? You're in it already. I don't want you waiting for that bar to finish, because what if that bar finishes up here and you've missed the trade? We're getting in right above that red line. You don't doubt. You don't check something else. You don't try to seek verification. You don't roll bones. You don't call up the hot psychic hotline. You don't call up your trader friend to ask him to look for it. You just hit the button, all right, with certainty. I like bold, certain traders that when the action, I want to see who you are when the moment that calls you into action. I want to see who you are at that moment. Do you hesitate? Do your palms get sweaty? Does butterflies start or elephants start jumping up in your, do you seem uncertain? Do you shy back? Do you play ostrich? Do you put your head in the sand and pretend that it didn't happen? Or do you become bold? Do you leap into action without a shudder of doubt? Is your action pure and full of power and certainty? These are the things I want to see when the market calls you into action. What kind of soldier are you? And so I want it done with certainty. Now, once you're in, stop. Your protective stop is below the halt. We got a very low risk opportunity here. Now, I'm always saying the minimum target you should try to go for, you might not get it, is the 200 period moving average. All right. And sometimes we can break through on the secondary one. But let's see if we can get to the 20, back to the 200 period moving average there. And so if that happens, your profit is this and your risk is that. How many of these little risk amounts fit inside of this profit amount? And if you can keep the ratio like that, you will stay in this game forever. You're going to do extraordinarily well. Boom. What happens here? Something interesting happens here. All right. The stock flirts with your stop. Let me talk about this. My traders are taught to take a 2-bar stop. So their stop would be there on the second bar. So oftentimes a stock might slip marginally below your stop level and come back. So we have a 2-bar stop rule. All right. But we do get some sort of lift here after the buy. Boom. Now, don't think that that's small, guys. That move there looks like it is, it's like $1.20 or something like that. That's not a bad move. 1,000 shares gets you $1,250. We pull back, we go through the 20 again. But do we, on the next attempt, do we at some point get a secondary? Do we get a decent, see, this move is not decent enough to consider a sear through, see? But this move gets height. I need height above the 20 and then come back. Give me some height above the 20 and let me watch that come back. You see, we got height here and it's seared back through, okay? But we get height again and we get another halt. And here is your solid bar. And there is your buy. Once it clears, once any green bar clears the solid bar, you don't see, if you wait for this bar to finish, you're going to buy here. And that's wasting too much money. That's giving too much money to the market. We're going to buy here. Plus, the closer you buy to your entry, the closer you are to your stop. So it's actually safer than waiting. Some people think that waiting for confirmation is safer. No, it's risky. Extra confirmation costs money, just like extra insurance costs money. You want extra security costs money. You want something extra in life, it costs you money. We don't need the extra with this. So we're going to keep the cost small. The cost here is small because my stop is here. But if I were to enter here, my stop has to really be the same. So that's my cost. It's too big for me, okay? And we get lift. All right? We should be taking some off the table. Anytime you get lift, you can take some off the table. I have no problem with that. Anytime you get lift away from the 20, we can act. You can never go wrong doing that, okay? So that's the 20 MA halt, guys. Elongated decline plus space, preferably dual space. Then we need to see the stock get sear through the 20 and get lift above the 20. We watch that next pullback. If the 20 MA halts, we grab that most recent solid red bar. Boom, we buy above the high of that red bar. We protect ourselves against under the low of the halt, and we look for moves away, and we monitor to see if there's going to be a secondary halt in the play. Okay, beautiful, beautiful strategy. I've been using this for 25 years, guys. Now, just to quickly show you that this is not just a micro trading strategy, I want to show you a couple big time frames, and then we'll close out, right? All time frames work, all right? Here is an example of, I think this is the oil index, right? So we're below, look at the stock trend down a bit. Now we're not under the 200, but we're definitely trending down from this local top here. We're trending down. The stock gets below the 20 with some degree of space. We get above. I would really have liked to have seen this get a little bit higher above the 20, but boom, we pull back, and this solid bar clears these multiple reds there. So sometimes when I don't have a solid bar to work with, I want to see a green bar clear 2 or 3 of the little ones then. So this green bar clears all 3 of these little ones. So I'm looking at those little ones as one solid bar chopped up into 3 pieces. Okay. And so boom, buying into that bar, protection under the halt, the rest is history. That's looking at, this is a daily time frame. This is a daily chart. Now, if I go to a weekly time frame, you can see it in snap. Now, sometimes in the weekly, the events that you're watching happen a little further apart in time, right? So here we're under the 20, we get lift above the 20, we pull back to the 20, and this bar right there clears out multiple little reds. So when I don't have a local solid red, I'm okay if the green bar clears out several little reds. That's the same event to me. Boom, right there, 20 MA halt. Protect yourself under the halt. And as you know, when you start to get distance away, you want to take profits. And there you are on the weekly time frame. All right, the same thing. Get rid of these things here. Boom. You can do this. This is not rocket science. I believe that there has been historically this false narrative that has been promoted in terms of market play to the general public in particular. And it was a tactic to sort of keep regular people out of the game, to deny access. This was an historical way to create separation amongst people, right? To deny access to my private club, to deny access to my market, to deny access to my neighborhood, to deny access to my schools, all right? It's just part of history. The markets had this, where it was sort of like a private club, and the barriers to entry were high. Technology helped to bring those barriers down. The lowering of interest rates helped to do that as well. A variety of things helped to create. The advent of the internet came into existence to lower barriers. But this notion, despite the fact that now virtually anyone can gain access to the financial markets, gaining access to the proper knowledge is still not very easy. And also, despite the fact that most people can have this access, most people are operating in the markets without the proper training, without the proper guidance. And I'm here to tell you guys that you can't do it that way. It doesn't come out of the sky. It doesn't come from watching YouTube videos, even mine. They can be helpful, but you can't learn how to trade from YouTube videos. You can't learn how to trade from reading books. You can't learn how to trade from going to traders expos. Those things can serve as a really solid foundation for learning. You can't learn how to be a doctor in medical school. The medical school, the education, sitting in lectures, taking notes, memorizing Latin, taking exams, those things are necessary for the doctor, but they don't make the doctor. And so I find that a lot of people are stuck in trading medical school and they think that's enough. It is never enough to know what to do, because knowing what to do is no guarantee that you do it. Most people think that education is all they need, which is knowing. But you have to make the knowledge yours through training. And it's the training part, not the education part. Education today is free. The advent of the internet made it free. The demonetization of value today that's going on, this era, has made education free. Today, I can hold an entire library, multiple libraries in the palm of my hand. So education has become dematerialized. It's become digitized. Education is free. Certification is not free, but education is free. But if you need a certification, you're going to have to pay for that. But the education being taught to get the certification, that's free today. Knowledge is free today. Thank God for the internet. Thank God for this new digital era. But what can't be digitized, what can't be dematerialized, what can't be skipped is training. A doctor needs training to become a doctor. Medical school doesn't cut it. The education is not enough. And so many people are out in the markets thinking that, why am I not doing well when I know what to do? But that's the knowledge part. You're missing the training part. And the training part is the experience building part, because your success is on the other side of your experience. It's not before experience. Any success you get before experience is luck. Your success, real success, comes on the other side of experience, and experience takes time. How do you gain experience? Through training. You have to take the knowledge and grapple with it, fall with it. You have to work with it. You have to make it yours, because one thing I will tell you is that you can't trade my knowledge. You can't trade my experience, but you can take my knowledge, you can take my experience and make it yours through your training. Training is the process of converting knowledge into experiential power. And it is only after that transmutation occurs that you can start to see the fruits of your labor. It will never come by just simply knowing. It is not enough.
I am going to take 45 minutes and I'm going to change the way you see the markets and hopefully the way you play the market from this day forward. I got 45 minutes to do that. I got 45 minutes to do it in such a way that you'll never be the same as a market participant again. Now, I'm going to take the first 20 minutes of the trading day. We're going to slice out the first 20 minutes of the trading day. I got 45 minutes to teach you how to master trading that first 20-minute period. Now, traditionally, trading the first 20 minutes has been taboo in the markets. When I started my professional career on Wall Street, December 1986, I was told that no traders trade the first 15 to 30 minutes of the trading day because of the excessive volatility. I would go on eventually to break that rule and set records on Wall Street for being the most profitable trader in the first 20 minutes of the trading day. My fame on the street grew because of this talent. That instead of the first 20 minutes being taboo for me, it was where I made 80% of all my money, even though I traded the vast majority of the day. And so my skill of being able to pull money out of the markets utilizing this first 20 minutes, I travel the world transferring that skill to others. In addition to me transferring that skill to others, I do not do that for free. I do it in the form of an exchange, in the form of you trading my capital. So if you are willing to trade my capital, I am willing to teach you how to do this without you risking a single penny of your family's money ever. So I travel around the world giving my money to other individuals, teaching them what to do with that money, and we split the profits. Zero risk to the trader. If they lose my money, I kill them. No, if they lose my money, it's my fault. It means I did not do my job well enough. My top trader has over $30 million, and all the baby ones start off with $50,000. So today, I'm going to give you all $50,000, and I'm going to show you how, with $50,000, you can grow it. Trading 20 minutes a day, just 20 minutes, the first 20 minutes, you're going to grow. I'm going to show you how to grow 50,000 into 100, into 250, into $500,000, into $1 million. I'm going to do it. I got 45 minutes to do it in. Do I have the clicker? Okay, let's go. We're going to need several tools. 5, in fact. $50,000 to start. Number 2, we need a 2-minute chart where every bar on the chart represents 2 minutes of trading. So we're going to divide the market's activity into 2-minute slices. We need a simple 20-period moving average running through that data, and we need a simple 200-period moving average running through that data. And the last thing we need is what I call a tight picture of power, and I'll teach you what that is. Now, here's a 2-minute chart of Facebook. Every bar represents 2 minutes of charts. Obviously, the green bars mean that the stock opened at the bottom of the green and rose to the top of the green. All red bars mean that the stock opened at the top of the red and fell to the bottom of the red, okay? So green bars are up bars, red bars are down bars. Now, we need a 20-period simple moving average, which is going to average the last 20 bars so that we see a 20-bar average, and we want to see a 200-bar average. So there's a short period moving average, a short one, and a long one. Moving average systems, you always want to use a short one in conjunction with a long one. I've superimposed the 20-period moving average and the 200 on that same chart of Facebook. Take a look. The one sloping downward is the 20. The one sort of flattish is the 200-period moving average. Let's talk about the states. When these two moving averages are close together, we call that a tight state. Your stock or Facebook, when those two are close, the market or Facebook is in a tight state. When those moving averages are far apart, Facebook is in a wide state. So I want you to understand that the markets have two states. We flow from narrow to wide and back to narrow to wide. And that's it. It's almost like the market is a breathing mechanism. It breathes in, tight, and then it exhales out wide. And after wide, we go back to what? Inhale. And then after inhale, wide again. Now, we judge these states by the moving averages, the 20 and the 200. So you can have a tight, narrow state with the 20 above the 200, but tight and narrow. Or you can have a tight, narrow state with the 20 a little bit below the 200. Here's a wide state where the 20 and the 200 have separated, but separated to the upside. The 20 is above the 200, and you have from this wide state, you are expecting your stock to drop. from a wide state because the drop brings you back to narrow. Now, if you have the wide state to the downside, the 20 has declined away from the 200. You're looking from that wide state. What should your stock be ready to do now? To back up, to go back to narrow. So if you can start by knowing the stock's state first, you've got 85% of this game already figured out. Most problems come from playing the wrong state. Buying after this, after a wide state, or doing the reverse. So get the state right, and you've got 85% of your problems in trading are gone. Okay? Now, let's go back to the Facebook chart. Look to the left-hand side of the chart. Look at the left-hand side of the chart. What state is the left-hand side? Narrow. Your best opportunities come from a narrow state. I'm going to repeat this. Your best trading opportunities come from narrow states. From narrow states, there is usually an explosion out of the narrow state, and there's flow, there's follow-through, there's trending. Your second best opportunity comes from where? The wide state. And in the wide state is when you become what kind of trader? A contrarian. You see, a contrarian. You become the contrarian trader in the wide state, but you are not the contrarian trader from the narrow state. You go with the flow from a narrow state. You go with the direction from a narrow state. After the stock has achieved a wide state, you start to think reverse. I know the stock's down, but we're wide. I'm now thinking up. There's a time to be a contrarian and a time not to be a contrarian. Let's talk about positions. Above the moving average, so you've got a tight, narrow state. Above the moving average is bullish, positive. When your stock opens in the morning, the first bar opens above a narrow state, the odds of follow through to the upside are like 87%. So you've got an 87% chance that if you open above a narrow state, there is more upside to come. If you open below a narrow state, the first bar of the morning opens below, there's an 87% chance of follow through to the downside. Now think about this. That means that out of every 100 trades, you're going to be right 87 times. You're going to be wrong 12, 13% of the time. That's how we're going to always have to protect ourselves when we're wrong. So let's talk about power bars. There are 13 bars the market repeats over and over again. 13 bars. It's like a language. So instead of 27 letters in a language, the market speaks one language with 13 bars. And it repeats these bars over and over again. It doesn't repeat them in a specific order. It might give you bar 4, then bar 6, then bar 1, then bar 13, then bar 10. But there's only 13 it can throw at you. Out of all the 13 bars, these two are the most important. I call them elephants and tails. Elephant bars are sizable, solid green bars that are larger and taller than the vast majority of the green bars before it. Power bar, green. Or you can get a power bar to the downside, red, boom, solid power elephant bar. You see, the institutions move the market. You don't move the market. Your family doesn't move the market. Your neighbors don't move the market. Your friends don't move the market. Institutions with billions of dollars move the market. When they go in, they wish they did not leave they wish they could go in without leaving a footprint behind. but they can't. They're too big. Their footprint, these elephants leave behind, boom, big footprints. This is the footprint of a giant elephant getting out of the market. That top one is a giant elephant bar, a footprint of an institution or institutions getting into the market. The bars at the bottom, the bottoming tail bars, are similar in power to the elephant bars. They're also footprints that the market institutions are getting into the market. So in all four of these bars, the market has moved up. So the bottoming tail bars are an indication that the market was at the bottom of the tail and moved toward the top of the body. All right? The green bar as well, from the bottom, moved to the top. So these four bars indicate money going into the market. And the next four bars represent money coming out of the market. Now, let's take these two power bars and let's start our trading day. Your goal is to take a list of stocks. Let's say you've got 10. Out of 10 stocks on your list this morning, you're not going to play all 10. You're going to, just before the open, select the 3 or 4 that are in what state? You want to say, oh yes, that's right. Out of these 10, these 4 have the moving averages close. Now you've got your 4 to focus on right at the open. Now, you're going to determine, out of those 4, which 4 opens above with an elephant, or opens above with a tail bar, or opens below with a red elephant, or opens below with one of the topping tail bars. So we want these bars below and these bars above the narrow state. And so all this becomes is a waiting game. You select which stocks have the narrow state, then simply watch and wait which ones open with an elephant or bottoming tail bar above, or an elephant or topping tail bar below these narrow states. And when none of your stocks do it, you drink coffee. You let the first 2-minute bar finish. No action in the first 2-minute bar right now. Once that first 2-minute bar has completed itself, you're going to mark the high of that bar off. 1 penny above that bar's high, boom, you're going to put $25,000 of your money, or my money, in the stock. That moment, that instant, you're going to take literally half of your account and boom, pile it into the stock. Now, you let the first bar finish trading. You do not let the second bar finish trading. So the moment, the instant, the second bar crosses the high of the first bar, boom, your $25,000 is in, and I want you to protect yourself 1 penny below bar 1. Now listen to this. This is your most important act. Your most important act is to protect the money. Your protection is 1 penny under bar 1, which means that your loss will be limited to the size of 1 bar. But get this, when you win, you might win 20 bars. But every single time you lose 1 bar. But you might win 8 bars, but you'll lose 1 bar. You might win 4 bars, but you'll lose 1 bar. You might win 40 bars, but every single time you lose for the rest of your life, you limit your loss to 1 bar. This is how you stay in this business forever. This is how you almost guarantee success. Most people enter this game thinking that their responsibility is to make money. That is not your responsibility. Your responsibility is to cut the stock when it's not performing. The market's responsibility is to make money. It's a partnership. If you buy Microsoft and it goes up, what did you do except pray? Nothing. You didn't push the stock up. You didn't call Warren Buffett and say, can you buy a few billion shares so the stock can go up? You did nothing. The market's job is to go up. Your job is to sit and cut because the market can't stop itself. Do you understand? The market can go up without you, but it can't stop itself. So it needs you to stop it when it's failing. Your number one job is to be a cutter, not a money maker. You see, money shines on everyone, whether you're talented or not. It's like the sun. You can be a criminal and the sun shines on you, or you can be a saint and the same sun shines on you. Prophets are like the sun. They just happen, whether you're talented or not. What you can't mistake is professional losses. Limiting your loss to 1 bar is a professional loss. That's your job. If you do 10 of these, 10 of those, and every one that hits that red line, boom, cut, out of 10, 8. You'll only cut probably twice. You'll have 8 that just go without your help. Only 2 you'll have to cut, maybe only 1 every now and then. You're looking for one of these too. Same thing. No difference whatsoever. Let that first 2 bar form, and you see it forming. It's 1 minute and 45 seconds, 1 minute 55 seconds. Wow, this is a bottoming tail bar. It's above my moving averages. The moving averages are tight. Saliva begins to drip down the corners of your mouth. Mark off the high, 1 penny. Get ready. Boom! 25,000 in, and your protection goes where? Under which bar? The first bar. You're limiting your loss for the rest of your life to 1 bar. The market will give you 8 bars, 6 bars, 20 bars, 15 bars, 3 bars, 2 bars, but you will not allow it to move more than 1 bar against you, ever. Do this and you will be in this business forever. Look to the left-hand side of this chart. Look at your moving averages. What state are we in? I know you know it. Amuse me. Narrow. Look at the first bar of the morning. Gap up above the narrow state. Solid green bar. Which bar do you see where you enter? Once that first bar finishes trading, mark the high of the first bar off. Whichever bar is the next bar to break above the high, boom, gets your 25,000. You're entering, it looks like, on bar 3. Do you see that? Bar 3 is the one that pokes through. Where's your protection? Under bar 1. 2-minute chart of Disney here. That dotted line is the first bar of the day, marks the first bar of the day. Solid, fat green bar, moving averages tight. Mark the high of that bar off. Which bar gets your 25,000? The second one, your stop, below bar 1. All right, good. We got it. Now, that's the foundation. Trading is not a complicated thing. I want you to think about it. You got 3 directions, up, down, and sometimes sideways. That's complicated? That's primitive. You know what's complicated? The human body. Billions of processes are going off right now. The engine of a Ferrari now, that's complex. The market? No. You know what the essence of trading is? Kicking out those not performing and then staying out of the way of those that perform. That's at the core of everything. But if you get the states right, if you start adding the states to your overall analysis, and you start playing the right bars that indicate this is not a normal buyer, this is an institutional footprint. Institutional footprint in the right location, in the right state, and you stack the odds in your favor. This is how I broke records on Wall Street. They said that it couldn't be done. Biggest gain in 20 minutes, $80-something million. 20 minutes. Said it couldn't be done. This has an 80+% follow-through rate. I've been doing it for 33 years. I've been trading for 38 years. But I've been doing this for 33 years. And it works just like it did 33 years ago. All right. Look at this bar. First bar of the morning. All right? Your moving averages are relatively close. They're not far apart. What are you doing right now? Salivating. Don't wipe. You might miss the trade. Do the trade, then wipe, okay? All right. All right, mark the high off. Boom. Get ready. Boom. 25,000 in. Your protection. Bar 1. There you go. That circle would represent a short-term move up where I'd start taking some profits. My general profit-taking thing is I'm looking for the stock to make 3 pushes. So push 1, like it pushes my profits. Push 2, and then after push 2, I start throwing sell orders ahead of the market so that the market comes to push 3 area and executes me. That's a more professional sell than waiting and then selling when it gets there, getting your order there in advance. Let's take this. Here's another example. First 2-minute bar of the morning, you've got a nice tight state. Now remember, you know before the market opens which stocks have tight states. So you're pulling out of your list. You have a list of 10 stocks. You're pulling out the small few that have a tight state, focusing on that. Now, boom, mark the high off. First 2 minute has given you a nice solid bar. Here's your entry, $25,000 in, protection under bar 1. Boom, 3 push, take some profits. I think we've got this part down. You've got another 25,000. Now that 25,000 in your pocket doesn't do me or you any good. We've got to put that in the market too. So now I've got to teach you how to add to your winning plays. Every master trader adds to winning plays. Every big trader is an adder. You can never be a big trader if you're an ABC trader. A in, B out. No. You want to go in and then in and then in your winning plays. Usually 2 adds. Why do you think we don't put all 50,000 in? Why try it with half and not all of it? Because if this is going to be one of the ones that don't work, I'd want it to not work on half, not work on all of it. So let me put half in. Let's see if this thing gets some momentum, and then I can add the rest. That's why we only put half in initially. The add. Let's talk about the add. Now, we're going to play the color game on the add. This is very basic. The very first red bar that occurs, a red bar means that the stock kind of softened, went down a little bit. The very first red bar, you're going to take notice. If that red bar does not produce another red bar after it, and a bar takes out the high of the red bar, boom, you're going to add more. So you're going to add when the market removes one red bar. How does it remove it? By trading past it. All right? So just like that add arrow is 1 penny above the high of a single red bar. Now I want you to think of this as like 2 soccer teams. Or 2 football teams, whatever, basketball team, whatever. There's a green team and a red team. And so you've only seen the green team have the ball in bar 1, bar 2. Now the red team gets the ball and produces what? That's it? That's all you got? Now do you see where I'm going? When red shows you that it is very weak because it can't give you, not only can it not give you more than one, it gives you a little one. Now, boom, add when that little one is removed. Now, it doesn't matter whether or not your first bar is elephant, your first bar is tail. Now we're adding the color game. Your entry can be the first little red bar that gets removed. So even if you don't have an elephant or a tail, your first play can be the first little red bar that gets removed. So now you've got three things to play: elephants, tails, and little red bar takeouts. Elephants, tails, and little red bar takeouts. Play these three things in the right location, in the right state. You've got a money-making machine in the first 20 minutes of the trading day. All you need is money to do it. And I've got the money. So listen, people say, Oliver, why do you travel the world teaching this? Why do you do this? Why don't you just trade? You don't see this. When I'm trading this on Microsoft, what about the elephant bar in the right location in Twitter? What about the tail bar in Facebook? Or the red bar being taken out in Apple? But I'm playing Microsoft. I want not just Microsoft. I want the Twitter one. I want the Facebook one. I want it all. Do you understand? So, listen. But check this out. If I gave you 50,000, you 50,000, you 50,000, let's say you have Facebook, you've got Microsoft, you've got Apple, you've got this. Now, don't miss these three things. Now, I've got them all. So what I do is I multiply me. You understand? I give you my capital and multiply me, and we both win. That's why I do it. There's power in numbers. I can't be in every spot and every stop that is producing an opportunity, but we as a team can. All right, guys, look. Bar opens above. Don't be overly concerned with the gap. The only thing is if that gap is too far, then you're already starting at a wide state. So too far gap, what's the best play? Up or down? This is not that far. That's not too far. All right, mark the high, boom. 25,000 in, stop below the low. There's your first red bar. It's not that big. It's rather small. Mark the high of that bar off. Boom! Whenever that bar is taken out, that's your add. Now, I suggest that you take that 25,000 and divide it into two parts. So you put 12 or 13,000 in and then do another one. There's your profit take. You've got three pushes. Push, pause, push, push, out. I'm not marrying stocks off the open. All right, you understand? I'm in and out. This is 20 minutes, 18 minutes or whatever it is. Out, finish, done, go to the beach, all right? Or the park or whatever it is that you do. I do have traders that will trade a good portion of the day, but I want every trader to have my specialty. My specialty is the first 20 minutes. There's your moving averages, relatively narrow, solid, fat. That's an institutional bar. You and I can't produce a bar like that in Microsoft. It takes billions of dollars to produce a bar like that. We know that's a footprint that's going in, and it's a big one. Mark the high off. We got the right state. We've got the right location. Remember, the location and the state are different. Location is above or below. State is narrow or wide. So you want the location and the state correct and the bar correct. Get those three things correct, you got a money-making machine. All you need is money. All right. Boom. Enter. Stop. Look at that first little red bar. That's all you got, red. That's it. Mark off the high. Boom. There's your add. Playing the color game now. Three pushes. Push one. Push 2, throw your order above the market, let the market come to that push 3 area, out, go to the beach. Can you play again if you want? Yes. You see these series of reds going down? The very next time a green bar eliminates red, starts the game again. Boom, boom. But you must be near the blue 20-period moving average. You can't do the color game that after the first one, you can't do the color game after that unless it's kind of close to the 20. No away from the 20. If it comes back toward the 20-period moving average, the blue line, you can start the color game again. Green takes out red, boom! Where's your stop? Always under bar. There's red. Start the process again. There's your add above a little red bar. 3 pushes up, out. Why 3 pushes? The market has a strong tendency to pause, rest, or reverse after 3 to 5 pushes. But you get 3, obviously, a higher percentage of time than you get 5. So that's why I'll always teach traders, start coming out on 3. All right, you might get 5, but you'll certainly a higher percentage of time get 3. I live where things happen, certainly. This is short-term trading, guys. You're trading the first 20 minutes of the morning. You're trying to earn your living in 20 minutes. You're trying to grab $3,000, $4,000, $6,000, $8,000, whatever it is, in that first 20 minutes of trading. And it's short-term. And its accuracy is, the reason for its accuracy is because the term is short. The shorter term trader has a greater chance of being more accurate than the long-term trader, right? And I'll prove this to you. If I were to ask you where you're going to be 10 years from now on this very day of the month, 10 years, you'd have no freaking clue. If I were to ask you where you'd be 1 year from now on this very day, you'd still probably have no clue. If I were to ask you where you'd be 1 month from now, a little bit better, 1 day from now. What about if I asked you, where are you going to be 2 minutes from now? You would get that right every 2 minutes of your life. You will never be wrong. So what if you just lived the market 2 minutes by 2 minutes? If your accuracy is the highest in this 2 minute period, why not live your market life 2 minutes at a time? Because your ability to project what flow up or down over the next 2, 4, 6 minutes is extraordinarily high with what I've just given you. But if I were to stretch that and say over the next week, it would break down. So we live in this high probability, highly consistent window, and then we just put big money behind it. What if, boom, you get a red bar up there? What do? I want to see. You've got narrow state, stock opens above bullish territory, but boom, bearish bar. What do? Drink coffee. Nothing. But if the market removes this bar, you're going to mark the high of that red bar off. If a green bar eliminates that red bar, so if you get this scenario, boom, if the problematic thing is removed, that's your endpoint. Stop below the low. Now, that may not happen. That red bar might produce a second red bar and a third red bar, and it's a nothing trade then. You don't do anything on that trade. But if that red bar is taken, boom, that's your entry right off the open there. Okay. Now, that's that scenario. Look at the first bar opens above the moving averages and produce a red bar first. The second bar removes the problem, and you're in right at the high, right as the green bar eliminates the high of the red bar, stop below the low, 3 pushes out. All right? And then you can start playing the color game again as it comes back in. Look at the series of red. When does green eliminate red again? I wish I had a pointer, but. And then the move up, out, done. Now, these are not just perfect examples, traders. I can show you thousands upon thousands of charts. Red bar starts off the morning. Green bar eliminates, second green bar eliminates the high. In, stop below the low. 3. Let's follow this trade. You tell me. Which bar is your entry bar? The second one. Where's your stop? How much money do you have in the play on bar 2? 25,000. Okay, what's your next act? Eliminates the first little red bar, add. And then what's your next action? After the push, out, right? And then let's continue. Do you see your next act? The second green bar after that final red bar that dips, right? You got it? Boom. 3 pushes up, out. Most people are overcomplicating this game. They're looking at PE ratios, sales ratios, company management, product sales, product this, projections. It's too complex. When I left the street, every firm began sending me their top traders. I charged them $25,000 per trader per week. And I was booked because I did a maximum of 10 traders a week. I trained Wall Street. 10 traders a week, $25,000 per head. I was booked for 12 years. I perfected how to simplify this game and turn an individual into a money machine. It is not by mistake that I have over 10,000 traders worldwide today, spread all over the world. That is not. Women traders, yes, they are some of the best traders. Do you know why women make the best traders most of the time? Ego. They have less of it. It's not that they don't have ego. They just have less of it. So when the stock doesn't work and the stop is hit, the woman says, Oliver says, get out here. Okay, I'm out. But men are like, shoot, man, maybe it'll come back. Maybe it'll rebound. Maybe I should add. And so there's less of that. And so women tend to be more disciplined as well, naturally more disciplined. There are certainly personality types that can make trading a little easier, but you just have to have a reliable set of items that repeat themselves over and over and over again. Reliable set of items, proper trade management, knowing when to cut, when not to cut, when to add. In just a short period of time, you can now look at any chart in the world off the open and say, this is where I'd enter, this is where I protect myself, this is where I add, and this is where I'm taking profits. And that, imagine if you gave me 6 months of your life where I could take you. Now, I have to add one more thing here. You can't leave your original stop at the bottom of bar 1 as the stock progresses. You got to move that protection up. You don't want to lose a tremendous amount of your profit in the form of a sudden collapse. So we got to learn how to move that stop up. So I want you to look at all the big fat green bars on that chart. Look at the fat sizable ones. Look at that fat bar, look at that one, and then look at that one at the top. Every fat bar, you move that protection right under the fat bar. You see, healthy stocks don't eliminate their fat bars. Move that stop under. So right after you add above that little red bar, that bar starts growing. Boom, big bar, move the stop under the fat bar. And you can fat bar by fat bar your way to the promised land. Boom. Boom, fat bar, fat bar, fat bar, fat bar, out. Now, while you're raising your stop, you're also taking profits on 3 pushes. Don't think you have to be stopped out. The stop is just in case something bad starts to happen. But you want to take profits on the way up, not on the way down. On the way down is hitting your stop. That's just in case. But the ideal way to get out is with the momentum on the way up. And then you cancel your stop. You should know this by now. First fat red bar gets taken out by a green bar from a narrow state. Moving averages are tight. Your entry is above the moving averages. So you're doing everything in the right position. You get your 3 pushes, you're out of this. This is boring now. Boring. This is my favorite. I love going short. I love betting to the downside. By the way, guys, that's not what I predicted in Orlando. One of the biggest falls in history, I predicted this at a time when the market was at all-time new highs. So the reason that you can do this now, where were the moving averages on the NASDAQ or the Dow or any major index? How do they look? Together like that? They are so far apart, they can't see one another. The state is too wide. That's not the time to buy. The time to buy is when your state's narrow, right? I taught you that. But now you can apply that to anything and know you got to know your state. Then you got to know which events in the right state, in the right position. Remember, if you get those 3, your odds explode. All you need is money. So now we're going to bet this to the downside. 25,000 in, boom, short. Protection above the high, bar 1. Everything is in reverse now. Yes, we make more money on the downside than on the upside. Why? Because items fall faster and harder than they rise. Give me a short over a long any day and twice on Sunday. Boom. There's your entry. Look at the narrow state to the left of the chart. First bar is solid red. Under the low, trigger 25,000 in, protection above the high. Look at your first little green bar that forms, gets taken out. Boom, that's your ad. And you've got more money to the downside. All right, look at this. You guys know this. Right now, you can tell me to the penny where you put 25,000 in. Where are you to the penny, where your protection is, to the penny where you add, and now to the penny where you adjust your stop. Walk this stock down. Do it now. Fat bar by fat bar your way to the promised land. You got it? You see it? First stop on bar 1. Where do you walk that thing down to? The next big bar. See the next big bar? The next big bar. The next big bar over here. So I'd say something like boing, boing, boing. Okay, now there's one more I want to add. We're going to add one more stop adjustment and we're done. You're going to add the color stop adjustment, not just the big bar. You're going to add this. So every time you get the opposite color, when we're betting down, green is the opposite color. When you get the opposite color green, followed by 2 red, green, red, red, adjust your stop on top of the green. Green, red, red, adjust your stop on top of the green. Green, red, red, adjust your stop on top of the green. So now you've got big bar, adjust, color, adjust. You do them both, whichever one happens next. So your stop adjustments now go from the original stop at the top of bar 1. See the green, red, red, move the stop on top of green. You got it? Then what happens next? A big bar happens next. Move your stop from the green to the top of the big bar. After that, what happens next? Green, red, red. Now move your stop on top of the green. What happens after that? Big bar. Now move your stop on top of the big bar. And you can walk. This is professional trade management. Very few people This is the highest level. Very few people know how to manage the trade in between the buy and the final exit, or the sell and the final cover. They don't know what to do in the middle. They don't know how to walk the dog. Now you do. Boring now. Eh? And it's supposed to be. If you are really excited, you're probably doing something wrong. Right? You want entertainment? Go to Disney World. But this is the same thing. It's not exciting. It's not supposed to be. What you do with your money should be exciting. But the same boring thing every single time, every single day, every single trade, that's what it takes. Being boring. I want to show you something interesting here. What if the bar is green under? What do? Your first bar under the moving averages is green. What do? Wait, drink coffee, right? All right, take a look at this. If it's green, boom, that's your entry, the removal of green. Now check this out. Check this out. This is cool. You're watching this 2-minute bar form under a narrow state. It's not full 2 minutes. Let's say it's a minute. Let's say it's 1 minute into its 2-minute life. You're watching this. You're just like, oh, green bar. But if that green disappears, boom, I'm in, right? Now, watch. It produced green in the first part of its life, 1 minute, but then 1 minute and 15 seconds less green. 1 minute and 30 seconds less green. And at the end, at the end of the green, boom, that's your new entry price. So now I'm teaching you how to actually go into the first 2-minute bar if it produces green first and then wipes the green out inside of the first 2 minutes. Do you understand this? So you are watching the market open, green, 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 then less green, less green, less green, boom! Once the green is over, you get in at that point, stop above the high, and this is your drop. So normally, you would be getting in under the low of bar 1. No, you're now getting in higher because the first move was green, giving you the bottom of green as a reference point. And any time, whether it's the same bar or the next bar eliminates the green, you're in. It doesn't matter. We call this hidden green plays. The green is hiding from you. You start to add the hidden plays. Wow, the opportunities explode. There's that green movement first. Mark the low of the green. Boom! This green did not get erased the same bar, nor did it get erased bar 2, but it did erase the green bar 3. It doesn't matter. Boom, there's your entry. There's the first green bar. After your original entry point, mark the low, there's your add, boom, and the rest is history. What should you always do when your stock goes from narrow to wide if you're in the play? You were in the play from narrow, now it goes wide. Should you still keep it? No. So you see where I have the circle? Look at the distance now from the move. Look at the left when everything was scrunched together, and look at the move away, you should be getting out. So the best time to get in is near, and when you get away, you should be exiting. Get in near, away, exit. It's not complicated. It's simple, not easy. Because see, the bars aren't moving on this chart, right? So it's easier. When the bars start moving and your palms start getting sweaty and butterflies start moving in your stomach and stuff like that. But it is simple. We go from a wide state, we go from a narrow state to the left to a wide state back to a narrow state. Can you play the wide state back to narrow? Yes or no? Yes. What kind of bars do you play from a wide state? Same ones. Elephant, boom. Bottoming tail bar, boom. So Which bar did you get here? Bottoming tail bar from a wide state. You can try that. Look at the elephant bars. Look at this elephant bar. Long as you're playing the right events and the right state, 87% chance of making money.